not too early. Come on, wake up now. Pour that coffee down your throat hole. It's hot. Now you got a hole in your throat. Oh no, just call your boss. Take the crust from out your eyes. So tasty, not a coffee.
Head singular. I am joined today. We've never had this iteration. If you're into permutations and probabilities, I don't know if we've ever done this, but it's just me and Chris Vecchio today. You're welcome. Good morning.
Wow. This feels like, should we open up a bottle of wine? We could do like the whole morning talk show thing. Is that a thing?
I love it. I love it. How are you, Chris? How have you been? How are things going? The holiday season with a new baby in the house. How does that go?
Oh, it was delightful. So perfect. And like got the kids in matching pajamas.
Aww.
And then definitely watched a very disappointing end to Stranger Things, which I think I'm going to write my own TV show to prove how you can wrap up a beloved series. That might be my villain arc, my starting point.
Yeah, I stopped
really
watching. I stopped watching. Like, I was so into it. It had such promise, but then I was like, it's taken, like, the kids are 30 years old now.
Yeah, I mean, the directors noted that like part of the reason for their motivations for the 5th season was like they felt like they needed to bring in a younger cast of characters to reconnect with season 1. And yeah, we noticed because all of the children from season 1 are now parents, have kids of their own.
Yeah, Millie Bobby Brown, best name ever. Like, she plays 11. Yeah, she's married and she has a child.
Cool, great timing. But you know, COVID did it. The writer strikes, all this stuff added up over the years. So anyway, it was great. It was great. Great seeing family. Family was here for a few days. The Jets ended a miserable season, which I know that I'm just getting ahead of the bullying, Vanetta, right? Because John and James, I'm getting the texts, I'm getting the tweets. Even people who listen to us, Tasty Nation's tweeting at me stats about how bad the Jets were. So this is like a running joke.
Did they fire their coach?
No, of course not. You know, he's a rookie head coach. He's just doing the best that he can with a bunch of losers.
Oh, no. Wah, wah, wah. I mean, to be fair, the Bears could not beat the Lions yesterday, inexplicably. So there's that.
Sure. At least you guys are in the playoffs.
That's true, but we have to play Green Bay again. I can't.
Yeah, but that's the best. It's a legitimate rivalry. It's going to be great TV, great entertainment. I'm looking forward to it.
They are going to burn this city to the ground. Either way, no matter what the outcome, I'm concerned. But I really do want the Bears to turn things around. But what are you
not here in New York. You're not going to do that here in New York. And my Knicks need to get off the schneid. So I suppose we have some better things to talk about than complaining about New York and Chicago sports here. We could do that for the next 3 hours. I mean, I have that in me, Vanetta. And I know you do too.
Well, I will tell you just briefly, but I spent my time, I went on a brief adventure that was an incredible demonstration of what you can do with free will and a credit card.
Tell more.
I decided, Chris, the Sunday after Christmas, I flew into Las Vegas. I used my airline miles. The flight cost me $11. I was like, very good. So I used my miles. I fly into Las Vegas. I rented a camper van, and then I just drove around Nevada, Arizona, and Utah, and I had myself a grand old time by myself in a van down by the river. Look at your face.
As you know how alluring that sounds as the father of a 4-month-old to just like get into a camper and drive off into the desert?
It was amazing. So I drove to Zion National Park from Vegas. Mm-hmm. It's only 2.5 hours. It's just beautiful. Oh, it's so majestic. I'd never been there. It was great. I then drove up to Bryce Canyon. I spent New Year's Eve in Bryce Canyon, and there were 8 people at the campground, and it was so peaceful and quiet and literally the darkest place I've ever been. Like, you can't even see your hand in front of your face because you're in the middle of nowhere. It's dark, but it's beautiful. And then from Bryce, I drove down into Arizona, to Page, Arizona, around like Lake Powell. And I went to Antelope Canyon, Lower Antelope Canyon, and Horseshoe Bend. and then I ended my trip in the Grand Canyon. So
sounds lovely. Did you see Frank while you were down there?
I did not. I was in northern Arizona, again, real close to the Utah border.
That sounds absolutely incredible.
Yeah,
I
had great weather.
Oh yeah, I mean, I'm thinking about the night though. I mean, I love the fact that there's no light pollution in places like that.
Yeah, these are all dark sky. They're all dark sky parks. It was cloudy, so I couldn't see a ton of stars. But over the Grand Canyon, I was on the shuttle bus getting back to the campground, and a bunch of people were gathered around, and the bus driver was like, "What are you guys looking at?" And I think it's going to be this really majestic bighorn sheep or something at night, and they're like, "It's a Starlink satellite." Launched from Southern California, but you could see it at the Grand Canyon.
But as a Tesla shareholder, you're looking up and you're just, that's beautiful.
I'd never seen one though. So, because obviously I live in the Midwest, you live on the East Coast, so I'd never seen a Starlink satellite. It's a common occurrence in the skies over Southern California, but I'd never seen one.
We see, you can see them sometimes on a really clear night here. They appear as dots in the sky. In a straight line, you're like, what? It
looks like a
satellite.
UFO. It was a really bright, intense, focused beam of. I wouldn't have known what it was if the people that were standing around hadn't explained. But it was just funny. So it just goes to show you can never truly unplug or escape.
Oh no, I tried unplugging this weekend, Vin, and I do a little digital detox whenever we have a holiday. Just shut off my phone notifications for 24 hours. Don't go on the internet. Yada yada. So color me shocked when I woke up on Saturday morning and saw that we had captured Nicolas Maduro in Venezuela.
I woke up in the Grand Canyon and I was like, I got to get out of this van. I was like, we did what? Because I had cell service and I was like, okay, that's fine.
Yeah, sure. Well, it was, for me, I'm sitting here thinking, oh gosh, another CME margin hike, right? My gold and my silver. This is going to be another punch in the face. And alas, the world had better plans for the geopolitics of it all. Vanetta, we can take a brief look at markets here. I know that we want to get into the daily dose.
Go ahead. No, go ahead.
S&P 500 here, up about 0.25% on the other side of the weekend's headlines. Vanetta is going to go through them shortly. But the big news, of course, is that the U.S. Decided to intercept Nicolas Maduro in Caracas. More interceptions than the Jets had on the season. Officially, President Trump won, New York Jets 0. NASDAQ up 0.7%. ASML here, strong out of the gate. Semiconductors having a nice little performance pre-market. The Russell up less than 0.2%. And the Dow is basically flat right now, a little bit weaker on the session. Bonds a bit firmer across the curve. We do have notes and bonds, ZN and ZB, up about 6 ticks each here on the other side of the weekend news. But it's gold and silver once more that are back in focus. It's been a really volatile week and a half with those CME margin hikes. We do see that silver is up 5%. Gold is up around 2% or so. The weekend's headlines not pushing anyone out of the metals despite those margins going up. You would think that there'd be a big reaction in energy markets, Vanetta. Oil's up barely 1% here. Barely 1% here. It's natural gas that's taking the bigger hit. The weather looks like it's going to be warm the next few weeks when we look at the forecast. Yeah, I guess that's great, although not here in New York. So we're covered in snow, down 6.25%. The currency markets, they're slightly weaker in favor of a stronger dollar. Vanetta, though, I think for most people, we were on First Call yesterday, most people are probably looking at oil today and they're shocked by not only the lack of move, but there's just no volatility coming back.
I was going to say also mentioning the VIX, it's just not doing much of anything this morning.
Not doing much of anything this morning. Volatility futures themselves, 1610 here in the front month contract, the F26, after hitting a fresh cycle low overnight. So much for the geopolitics of it all. Same thing for the February expiration. Volatility coming into the new year was already low. Unlike the past few Decembers where the VIX actually closed the month higher than where it started. That was not the case in 2025. VIX trended lower throughout December, so did vol futures. And we're starting the month of January, starting 2026 with vol effectively on the mat.
We have a good show today. I am super glad that we have Chris because we have a lot of geopolitical stuff that's happening. He's our macro guy, so we're going to get into a bunch of stuff today. Hopefully, we will also be joined by Mike Butler, which it's a surprise. It's a choice. We're going to see. But at the top of the 8 o'clock hour, we will have Research Corner with Kai coming in, giving his outlook for the week. Then at 8:40, we're going to have an options jive that is TBD. It says on my schedule. We're just really cooking with gas here in 2026 as a company and as a concept. And then at 9 o'clock, we have a market measures, a weekly 0 DTE breakdown. And then 9:30, Quentin and Ryan will be in. Quentin counting down the top trending tickers from the trade desk, and Ryan giving his insight to probably his 2026 crypto outlook. So that is going to be the run of show for today. Mr. Vecchio, do you want your daily dose?
I would love my daily. I've been having this side pain here. I think I need a daily dose.
It's a little sciatica. Hey, okay. Hit me with my theme music. Let's go.
Our leading story. Breaking news.
Across the wire.
Leading story. Top story. Just in.
In today's headlines.
This just in.
Breaking news.
All right, everybody. Today is a magnificent Monday. It is January the 5th. Oh, my goodness. This is 2026. This is the part of the show we like to call the Daily Dose, where we talk about today's financial news and headlines. My name's Vanetta. I'm joined by Mr. Chris Vecchio. Are you ready for the news?
I need it.
Are you a resolution guy? Do you make a resolution, or you like have an intention or something that you do as a reset for a new year?
I'd like to think so. I like to tell myself that I'm that kind of person, but now that I'm rounding into my 37th turn around the sun, Vanetta, I just got to be real with myself. I'm going to tell myself I'm going to get up in the morning, and I'll work out sometimes, but I'm the same person I was last week.
I just resolved to get weirder. Just going to get weirder in 2026. That's
Amen.
it. Amen. Hey, let's get into just a little look back. The S&P 500 rallied 16.39%. That's the number that was going into the books for 2025. It fades in comparison to like global markets, like European markets and other emerging funds. But the prize for the Mag 7 goes to Alphabet. Only 2 of the Mag 7 stocks ended up positive for the year. Gold was up 64% in 2025, but silver surged 141%. Google up 65%, Nvidia up 39%. And what were your takeaways from 2025?
I recall the major problem over the course of this year was that there was concentration risk in the indexes.
Yeah.
And yet the Mag 7 did not really have that strong of a year outside of those 2 names. And, thinking about your Google, your Nvidia, Meta wasn't great. Microsoft wasn't great.
Yeah.
Blah, blah, blah.
Yeah, they were up positive, but yeah, not great.
Yeah. But the NASDAQ was still up 20%. So breadth was improving. I know that people are going to look to the PE ratio right now and say this is astronomical. PE ratio on its own doesn't mean much of anything. And in fact, the PE ratio was higher in 2020 than it is right now. And clearly we've had better returns over the past few years. The S&P is almost doubled at this point in time. I think what people should be paying more attention to is something like a price to earnings growth ratio, a PEG ratio, which is still at a modest 1.22 coming into this year. Historically, if that gets above like 1.35 for the index, you start thinking a little frothy. Are we getting value for the growth that we're paying for effectively is what that metric is measuring. So there's not much to dislike. If vol's on the floor, the technical momentum's high, why not continue to push higher as we sort through continued margins growth and this AI revolution, even if it seems like it's overcooked?
Some interesting insights as we head into January. Some notable stocks that are near their 52-week lows include Home Depot, Costco, Lululemon, big brands like that, Target, Starbucks, PayPal. What are maybe some opportunities that you see? Chipotle. Poor Chipotle.
Poor Chipotle. Target's a mess.
Target is a hot mess.
It's just it's a company is in just such bad management situation right now. They are dealing with their COVID problems. I mean, the COVID problem is that they overstocked their inventory and expected everyone's spending habits during COVID to continue as if they were in COVID. And
Not
that obviously didn't occur.
Right.
Not sustainable. And Peloton made the same thing. Everyone's going to have bikes at home forever. And then ultimately when the economy opens up, oh yeah, we're social creatures. And I guess we don't want to, I guess we have a fancy coat rack now. So I'm not going to be bargain hunting in any, like a retailer, for example, a retailer that struggled in 2025, one would have to think is going to have a difficult time in 2026 just because of the economic headwinds.
Sure. Something to look forward to. We're going to get December job numbers to get data back on track during the first full week of trading. We're also getting some other economic reports and news coming out this week. Mr. Vecchio, this is your wheelhouse. What are your feelings about the numbers that are coming out on Friday?
I am very torn between this mattering a lot and mattering nothing at all, because I look to the S&P 500's options chain right now, Vanetta. ES is giving us through the end of the week. When we talked about it on first call, is 78 points, and now it's 76.
Okay.
Now that's barely over 1%, maybe 1.3% we're talking about priced in terms of a swing in either direction through the end of the week. That's almost to say that the market is telling you when non-farm payrolls comes on Friday, does it really matter all that much?
Oh,
the market's
okay.
giving us a 15% chance of a Fed rate cut this January. And as longtime participants in futures power and overtime know, one of my favorite stats to reference is how stock markets perform in the wake of specific types of Fed cuts. We bucket them out as maintenance, recession, or emergency cuts. Recession cuts are the worst variety.
Right.
And if we get the kind of data on Friday that pushes up those Fed cut expectations, after having a 4% plus growth rate for the third quarter in that GDP release, is that going to give us an inclination towards a maintenance cut or a recession cut? I would think it'd be more recessionary if January cuts become favored just because of a single data print. So for me, nothing happening as a result of non-farm payrolls is probably the best path forward. And the stock market doesn't think it's going to disrupt much of anything at all. So
Okay.
The contrarian to me says, okay, maybe Friday could be something big then, right? And this is where I go back and forth.
What do you do in bonds, and like what is your bond outlook for 2026? Just be bold, I guess.
Bonds returned 1.4% last year. Bonds were not a great trading vehicle for me. We're going to talk about some of what worked and what didn't work in 2025 on Futures Power Hour today. But so I would take my own perspective on bonds with a grain of salt. That said, oil prices were down 20% last year, Vanetta.
Yeah.
In what world are bonds not moving when oil prices are down 20%? So that leads me to think that there are other factors in play that I'm personally not understanding well. But when you look at the MOVE index, when you look at the volatility in the space, directionally neutral has been the best thing to do the past few months, even though it seems like it's a really unappealing play when IVRs are in the teens or single digits or even negative. So for me, I would take my own 2026 bond outlook with a grain of salt. I'm treating this more as like a trade by trade basis. I don't have an overarching view for this year.
White House and State Department officials have told U.S. oil executives in recent weeks that they would need to return to Venezuela quickly and invest significant capital in the country to revive the damaged oil industry if they wanted compensation for assets expropriated by Venezuela 2 decades ago. Of course, Saturday, the U.S. government took action to apprehend Maduro in Venezuela. He was swagged out in a Nike tracksuit. What are we doing? Let's talk about oil. It's kind of a nothing burger in the oil markets.
It is. Nike, by the way, unchanged here in the pre-market, 63.28, like it closed on Friday. I think one of the major reasons why you're seeing oil not jump significantly on the other side of this, first off, Venezuela is about 1 million barrels per day at its peak right now in terms of supply for the global economy. And the global economy is about 100 million barrels a day. So it's a 1% disruption that we've seen coming. There's been a military buildup in the South Caribbean for weeks, as we've been talking about for
and it's heavy crude.
Thanksgiving. There's also this heavy crude. It's not easy. The Orinoco patch that they have down in Venezuela is not easily accessible. It's difficult to get this stuff out of the ground. It requires a lot of processing, right? There's a lot of sulfur in this crude. And so you could do thermal cracking to bring it up. You can mix it with a better grade of crude. Either way, it requires a lot of effort. But the infrastructure
isn't there in Venezuela, really.
And it's not there right now at present time because of so many poor decisions in the early 2000s. Chavez was basically raiding the state oil company after they nationalized Western assets to pay for his social programs. They did not invest in any of the infrastructure upgrades or the upkeep required. And so when oil prices tanked and everything fell into disrepair, the money pit disappeared, and obviously the country fell into a series of economic issues. Vanetta, it takes about $30,000 of investment to get a single barrel of oil out of the ground sustainably in a place like Venezuela, which means to get even 1 million barrels additionally out of the ground per day, we're talking about tens of billions of dollars.
And the price right now is so low for oil.
And exactly. And you think about how in the United States, the Dallas Fed does a great survey that they put out every few months in terms of what the break-even costs are for people to build new wells in the U.S. and to keep running wells up and running. And to keep wells up and running, it's like $40, $45 in a lot of cases. So you imagine in a place like Venezuela, you're sitting in terms of the capital improvements needed. $55 or $60 a barrel is really not going to be the most economically appealing thing, which is why on the other side of this, you look to an ETF like XLE and some of its components, the Exxons, the ConocoPhillips, the Chevrons of the world, which already have existing infrastructure in the area.
Yeah.
Their share prices pre-market are up 5-10% or so. And they're the ones who are standing to capitalize on this.
That's what I was going to ask is like, what is the actionable way to play this now?
It's probably not going to be through a smaller type of driller that would move into the region. Those smaller drills, the smaller refiners, they like to operate with lighter grades of crude because they're easier to process, easier to extract. So it's going to have to be one of the giants. It's going to have to be an ExxonMobil.
Or Chevron, yeah.
Or a Chevron, right? And some of these companies, they said, no, you're going to nationalize us. We're not interested in working with you. I believe it was Chevron that said, oh, we can do this. And so
I know ConocoPhillips was like, look, we've been trying to get $12 billion that Chavez owes us for like years. They're like,
yeah,
they're like, we're not, like, it sucks.
This is kind of a bailout for the oil companies in many regards, if that's the lens with which you want to view it. So it's more about, it's less about oil itself and more about like the, Conoco, Exxon, Chevron.
Let's look to currencies just real fast as we kick off the first full week of trading. The dollar seems firm as traders look past Venezuela to a flurry of U.S. data. What is going on in the FX markets this morning, Mr. Vecchio?
Not much of anything, in fact. The dollar's a little bit stronger here. So is the yen. Outside of that, though, it's probably a move just driven by demand for liquidity in the short term, probably emanating from emerging markets, given some of Trump's language the past few days. He said that Colombia, that Mexico, that Cuba could be next on the list. And so, seeing a little bit of a reach for liquidity in some sense today is not a shocker. There also could be a repricing here on the other side of the holidays, right? We just had 2 weeks of very low trading volume. So people are finally getting back to their desks today. And we are on the other side of some very strong, or at least stronger than expected economic data on the GDP side for the US. Maybe there's a little after holiday repricing going on. But outside of that, the volatilities, that's the North Star here in the euro, the largest, most tradable component of the dollar index. IVR is only 6.9. You go over to the yen, the second largest component, it too is 6.9. These are not that appealing of trades right now when you have IVRs in other markets that are substantially higher, even on a single stock basis.
And I think I read there's like third year in a row, kind of not really any Santa Claus rally. Where's Santa?
I don't know. Good question, because my 7,000 calls in ES that expired on December 31st obviously didn't get the bell rung. Santa Claus rally is supposed to be the final 5 days of the year, first two of the new one. It's interesting because I feel like I've talked about this every year.
You do, yeah. Because
it's never materialized.
I just thought it was always just like the whole month of December, but you're like, no, it's actually this really specific period.
Go ahead. 1.3%. 1.3% those final 5 days, first two of the new one. And outside of today, it has been a red end of December, start of the new year. So today's the last day.
Come on, Santa. Bitcoin had its first yearly loss since 2022 as macro trends continue to weigh. You would think crypto would be set to, keep printing its own money after just a massive amount of legislative and regulatory wins in 2025. What is your crypto outlook for 2026, Chris?
Part of me thinks that if it couldn't rally last year, why would it rally this year? It's really difficult to peg a narrative to Bitcoin right now. It feels like it lost a lot of that narrative flexibility that it had for so long. Fed's cutting rates. Buy Bitcoin. Oh, the Fed's hiking rates because of inflation. That's the dissolution of the dollar. Buy Bitcoin. That's not really what's going on here today. So I'd like just to see some stability up front. 95,000 is a key line in the sand for me.
Okay.
Obviously, what's happening with Michael Saylor and strategy, that's going to be a very fascinating story as a tail wagging the dog here. I mean, Vanetta, like, as I don't know how involved you are in the crypto space per se, as someone who's maybe heavily involved or not heavily involved, but certainly someone who engages with it, at least in content form on a near daily basis. What do you make of the fact that Bitcoin wasn't able to rally last year?
I mean, it just seems like it had its whole, it started on third base, to use that analogy for 2025, because once the election results were in November, it seemed like its fate was set for it to just massively have all of its regulatory hurdles magically removed. And I really did think that it was going, as the kids say, to the moon. But it's a concept and premise, like it's still, trying to figure out logically what its place is in the markets. But now that you can add it to your 401k, like, I don't know, man.
There are a good deal of research out there that shows that, obviously hindsight being 2020, but even having something simple like a 2 to 4% allocation of crypto in your portfolio reduces your beta weighted deltas, believe it or not.
Okay.
It reduces the overall correlation of your portfolio. It reduces volatility of your returns. So I still think even with Bitcoin having done what it did last year, if I'm thinking about just building out a broad spectrum of strategies, timeframes, yada, yada, there's a piece for crypto, just like there's a little piece for everything.
Is that what you're telling your elderly parents, though? You're like, hey, mom, dad, 2 to 4%, got a YOLO.
I did a Fox News interview about Bitcoin in 2013, in April 2013, when it was just getting off the ground. And my parents were like, what is this internet money you're playing with? Okay.
Nvidia is sounding out TSMC on new H200 chips order as China demand jumps. Nvidia is scrambling to meet strong demand for the H200 AI chips, and so they have approached contract manufacturer Taiwan Semiconductor to ramp up production. Semis are moving and grooving this morning. What are you doing in the space, and what's your outlook for Nvidia 2026?
Semis are looking really good. In fact, is that going to be a new all-time high today? I think so.
Probably.
I think we're going to be at a new all-time high when the market opens. Yeah. Pre-market, we're at 380 and change right now. The former all-time high is 376.33.
Oh, we got it.
Yeah, we got it. I mean, so like there's still obviously a big bottleneck right now in the semi space. People can't get their hands on enough GPUs. And the world's probably becoming a less stable place where supply chains are falling apart. So
I'm real concerned about the memory crunch and crisis, but no one wants to talk about it. So I was like, okay, that's cool.
Yeah, where did Micron come from all of a sudden at the end of last year, where this was a $100 stock at the start of September, and now it's trading at $324 here?
Yeah.
From my understanding, and I'm very much a macro tourist in the space, trying to learn more about it, but from my understanding, some of the things that you can do in the computational space with respect to AI are so backlogged that now going over to something like these memory chips, this is actually a little bit more cost effective, which is bad news if you're a personal computer hobbyist. I've seen a lot of people on Reddit complaining about how there's no available supplies for them to do any of their, personal PC upgrades.
Yeah.
But like that's one of those little canaries in the coal mine, Vanetta.
Like
right?
Micron straight up is like, we're getting out of the consumer market, and people, it should have, I think, been a bigger red flag, but there was other stuff that was like going on. But yeah, like you're going to be real surprised at how much, laptops and phones and things are going to start to cost. But nobody cares. Which
reminds me, I am in my Verizon cycle upgrade window, so I probably should
do it. Yeah, just do it. Get it out of the way. Hey, SoftBank has completed their $41 billion investment of OpenAI, deepening their bet on AI. SoftBank chief Mayoshi Son has said he's made an all-in bet on OpenAI, and they're expanding their investment. Any thoughts on OpenAI and I don't know, its outlook for 2026, or just AI in general, I guess?
AI is moving ahead, whether we like it or not.
That's true.
Every technology, there's an inevitability to it where it progresses, and it may not iterate in the final form and fashion in which it first appears. There could be a bubble along the way. I think internet is a good point. Like the internet didn't go away. It was just the valuations of all the stocks and the finances in the late 1990s and early 2000s had to be readjusted.
Sure.
But the internet's stuck around. This is like the adapt or die year as far as I'm concerned. If you're not using it in professional capacities, you should start using it now. It's not going to replace, I personally don't think it's going to replace that significantly many jobs if you learn how to use it and enhance your productivity and your workflow.
Right.
Easy for me to say, right? Because we're humans on air. And so that's like not something AI
But we could be
holograms
like by Q4. I don't know.
Listen, they want to upload my consciousness onto like a laser beam and shoot me across the galaxy. Like I'm totally cool with that later in life. But for now, I'd like to stay gainfully employed. So I'm going to be optimistic and think it's not going to be that jobs displacing in blue collar jobs. White professional jobs going to have a bigger problem this year, though.
Sure.
Definitely a drag. But again, if you can margins up, lower headcount, lower overhead, every company is going to go after this, particularly publicly traded ones that have a fiduciary responsibility to their shareholders. So I say it's inevitable. Whether or not we're in a bubble is a different story. I don't see it bubble yet.
What is your favorite way to trade AI? Is it just straight up Google now, or like what Microsoft? Like what?
Yeah, my exposure is in the Google flywheel right now, personally speaking, and there's a Google position in the Tasty Follow account as well. Nvidia, OpenAI, Oracle. There's a lot of debt out there, and when economic cycles are predicated on debt expansions, it leaves them exposed to what ultimately could be that withdrawal, so to speak, that contraction in the issuance where all of a sudden the funding dries up. And I would point to the fact that when we look at the Meta, the Oracle, the Nvidia side of the equation, there are some signs that maybe the funding is drying up. And when you hear Sam Altman, who is clearly a brilliant guy, maybe a master showman, a P.T. Barnum of sorts, they're talking about data centers in space. I mean, I recall Robert Schiller's 2000s book about castles in the sky and, eyeballs per click, about these ridiculous stories and valuations we were talking about in the dot-com bubble. And so when we hear these, sci-fi too good to be true, we're going to be building Dyson spheres to capture all the sun's energy in order to power the AI revolution. Like
a Lex Luthor death ray. I don't know.
Yeah, like cool. That's dope. I'm all for it. Probability wise, is it happening within our evaluation window? Unlikely. So that always alarms me.
Meta has acquired an intelligent agent firm called Manus, capping a year of aggressive AI moves. The deal highlights Meta's continuous rapid push to secure AI talent and technology. Manus will continue operating its subscription service after the acquisition. The deal terms were not disclosed. What are your thoughts on Meta and how it's trying to sort of aggressively position itself to just suck up all of your information?
I really enjoy the fact that the company is named after a business initiative that they just killed.
What is Manus? Is that what Manus is?
No, Meta. They're getting out of the metaverse.
Oh, the metaverse. Right? Yeah. No more legless Zuckerberg flying around. Yeah.
So, the fact that he's able to pivot, what did they waste? $80 billion on the metaverse?
It's a write down, Chris. They just write it down.
But this, Vanetta, I think the point I'm getting at is if I'm an AI company and I'm Meta and feeling like I've fallen behind because the LLM at the tip of everyone's tongue these days, it's either ChatGPT, it's Gemini, or it's Grok.
Yeah.
I don't really think anyone is thinking about Llama at this juncture, at least from the circles that I travel in. The easiest way for Meta to get back in the game is to bootstrap by acquiring a lot of these companies.
Yeah, I think that's true. Baidu's semiconductor unit Kunlunxin, is filing for a Hong Kong listing amid an AI chip boom in China. Baidu seeking a Hong Kong IPO for its AI chip unit as China accelerates self-reliance efforts. What are you doing in Baidu? And let's just talk Chinese tech stocks overall.
I don't have a position in Baidu. I haven't traded it in quite some time. Today, though, it's 150 right now. And the close on Friday is a little bit lower now in the pre-market, 145. Listen, as much as I want to say how ridiculous is it that a search company is getting into manufacturing semiconductors and chips for the AI revolution, then I go, well, that's like the main part of my Google thesis these days. So it all seems like it's reasonable enough. I don't have any issue with the Chinese equities. I know a lot of people do, but if you're looking for individual equities that have high volatility, Baidu is certainly up there. It's at 51.1 right now.
Okay.
Baba, on the other hand, is only 11.2. So you can see how there's a little, I thought Baba was the AI name in China that we were paying attention to. Evidently not.
No.
I wouldn't say I have a great read. I always like to think, like, if I can't muster something together quickly like this, Vanetta, I know that I shouldn't be trading it.
Oh, that's a good credo. That's what I was looking for. That's a good credo to live by. They say if you don't know enough about it, maybe sit on the sidelines. Palo Alto Networks is in negotiations to acquire a 1-year-old Israeli startup called Koi for $400 million. If the deal goes through, it would mark a rapid and lucrative exit for Koi's investors and founders. The startup had raised just $48 million to date. The cybersecurity giant Palo Alto Networks showing no signs of slowing its acquisition spree. PANW, what you got?
This is a white hat hacking firm. They basically go in and they expose vulnerabilities for corporations, for sovereigns, and then they help them patch them, right?
That's awesome.
Black hat hackers are the folks who like go in and steal this stuff.
Sure.
But the white hat hackers are like, hey, we found these vulnerabilities. You better patch them before you expose all your customers' social security numbers. So it is clearly very important. And quite frankly, macro-wise, I would think that with the world that we're seeing right now, if it's the Eastern European theater or the South American theater or the Middle Eastern theater, Iran, Russia, China, Venezuela, these, and I only say Venezuela because I know that the RuneScape gold has been flying off the shelves this weekend. That is a really niche esoteric reference. But like the fragmentation of the global order means that there's going to be more of these pressure points. And so having security is incredibly important. Knowing your vulnerability is important. I've had a CrowdStrike position for years since the Russian invasion of Ukraine. It's had some really good days. It's had some bad days. Immediately after the invasion, it basically did nothing for a little while. And in fact, I was sitting on a big loser. But broadly,
and then they almost bankrupted Delta Airlines, but we're not going to talk about that.
I'm not a Delta Airlines shareholder. That's not my problem. Okay. Not my business. Right? I'm
a United girl. I don't care.
Yeah. Exactly, right? Who cares?
Cisco is in advanced talks to acquire a cyber startup called Axonius. All these names for $2 billion. Again, talking to the general theme that you just mentioned, Cisco is acquiring, again, another Israeli cybersecurity company, but this time for $2 billion. What are you doing in Cisco?
Nothing. I have a personal grudge against Cisco, so I don't trade their stock. Yeah, I tried. We several years ago, we had a startup of mine. We invented we're working towards building a digital whiteboard. And as we were doing our product testing, and building hardware is very difficult, Cisco came out with their digital whiteboard. and
they crushed your dreams.
Tried negotiating and like getting in, like, okay, maybe we could sell out to them or like, do something. It just disinterested and stepped on us and threw us into the trash bin, which again, we're not entitled to anything. But
screw you, John Chambers. No, I don't know.
No, it's I don't know enough about the company because they're in my personal, they're in the same box that I put Andrew Cuomo in for people who have slighted me and cost me money in the business world.
We're going to keep it moving. Tesla has lost its EV crown to China's BYD as competition tax credits expiring have hit demand. Tesla reported their delivery figures as well a couple days ago, and they have now ceded their crown to BYD with global EV sales rising 28% last year. BYD outsold Tesla for the first time on an annual basis, helped by rapid growth in Europe, where the Chinese automaker has been widening its lead. I don't know if you've ever seen the TikToks of all the Chinese EVs and the capabilities that they have and the amenities and everything. And they're like, oh, by the way, this car's $25,000 American dollars. And you're like, what the, not exactly, but it's astounding, the technology and capability that we don't have access to.
It really is. And I see a lot of these videos on YouTube. I'm not on TikTok. I think that's a Chinese spyware app. But I do YouTube shorts,
sure.
Okay, which probably just as I like my propaganda American, Vanetta, not Chinese.
Same as my 75-year-old parents. They love YouTube shorts. I'm not kidding.
I don't know. Like I put them on when I'm like doing the dishes with my
Yeah.
AirPods in, and so they're entertaining. But I mean, God, I'm just getting so wound up about TikTok. Yes, the Chinese EVs. This is probably one of the main motivations for why Trump is doing what he's doing in the Western Hemisphere right now. We've heard a lot about the Monroe Doctrine in recent days. This idea that this is our backyard and no one else can play in it.
Right. Because if it's in the Western Hemisphere, like we got to take care of it. And then, yeah, go ahead.
Right. And that's not a new policy. That was basically American policy up until World War II. The policy wasn't like no one can play in our backyard. It was Europe, stay in Europe was the gist of it. And then once Europe was decimated, their industrial base is destroyed. They now become the allies. It didn't really become our concern. And then World War II ultimately leads to the end of colonization and the schism of these relationships between the former colonial powers. So right. Then you get this new alliance that forms. So in Latin America now, Chinese firms have been able to come in, and same thing in Africa. We can build out your infrastructure at a cheaper cost, at more reliable. You don't have any historical baggage with us, like you do with the Western powers who colonized your countries. Work with us on the cheap. And it's been really, really appealing, which is why you look at these maps over the past quarter century. And while America and the West were the number one trading partner for the average country on earth, if you look all around the world today, it's China. So why do I bring this up in the context of EVs? The US does not want EVs flooding Latin America, Central America, Mexico. Those are markets that our cars are, we want to export into those markets. And if we're continuing to flood these markets with this dumping, it's going to hurt ultimately our labor markets here, because car employers are tremendous employers in this country. So yes, it's very protectionist, but the EVs in China, those TikToks that we're watching, they are a small detail in a much bigger geopolitical game that's being played right now.
What is your outlook for Tesla for 2026? Obviously, it was heavily involved in the markets of 2025, just how inexplicably it was tied to our political system at some points of 2025 and affecting the stock price in that way. What do you think happens to Tesla this year?
I recall Dylan and Ilya dunking on Tim Walsh a few months ago. What was it, back in April or June? I forget. Whenever he came out and said that, Elon Musk's Tesla's share price was XYZ. Since
I don't remember. Yeah.
It's more than doubled. The
point
that I'm getting at is like, unless it's, Nancy Pelosi or Marjorie Taylor Greene, don't take financial advice from your politicians. And I'm looking forward to that unusual whales report, by the way. They do their annual report for the politicians that have made the most money.
Oh, yeah.
Tesla's probably in great shape, jokes aside. At some point down the line, it's probably going to integrate XAI. Maybe that's this year.
Okay. And also, there are other plays of getting into robotics and like you said, XAI and the expansion of that. That's going to.
Yeah. Musk to me is a P.T. Barnum, and I've said this for years about him. But the fact is that if he's able to deliver on this $8 trillion market cap for Tesla so he can become the world's first trillionaire, a lot of things need to go right in the business world. And that could be acquisitions, mergers. That means deployment of these self-driving networks to rival Waymo and then getting the robotics off the ground. So if AI is, unlike the Nvidia flywheel, Tesla is doing everything internally. It's kind of like Google. It's not reliant on the outside money the way that an OpenAI is. And that gives it a little bit of an edge in this marketplace.
Skipping a story here, John. Drug makers announced they're going to raise U.S. prices on 350 medicines despite pressure from Trump. We did it, you guys. Drug makers are going to still raise price on medications, including vaccines against COVID, RSV, and shingles, and blockbuster cancer treatment, Ibrance, even as the Trump administration pressures them for cuts. The number of price increases for 2026 is up from the same point last year. What are you doing in the pharmaceutical space? Like a Lilly or like a Pfizer. Lilly obviously had a very good year.
I've been a longtime Lilly shareholder for 8 years now at this point in time. And I have no real reason to get out of the game. As just like a general investing thing here, and less of a commentary on the specific stock, whenever a company is name checked in popular media as being particularly evil, it probably means that it's a really good company to make money on.
Yeah, and we're going to get pill form Ozempic, so going to get skinny pills in 2026. So, hey.
Wonderful.
Hey.
Just wonderful. Yeah, no more shots. Although, Vanetta, I think that's going to be my 2026 resolution, getting into Chinese peptides.
I want to get into Chinese peptides, right? It's good for focus. I think you and I are reading like the same things on Twitter, but I was like, I want China.
Yeah.
I mean, I use peptides like on my face from South Korea because I love Korean skincare. But I was like, I want Chinese peptides. Yeah, give me all the peptides.
Yeah. We should talk when I'm out in Chicago in a few weeks.
Yeah, yeah. Who's your supplier? I'm skipping another story. Here's just a funny story and a funny commentary of where we are in life. Influencers and OnlyFans models are dominating extraordinary artist visas. The O1B visa, reserved for exceptional creatives, has the amount of people who've successfully applied has exploded since COVID. Obviously, a very easy way for a government administration to be like, okay, how good of an artist or creator are you? To be like, hey, I have 10 million followers. And they're like, oh, do you do foot stuff? And they're like, yes. They're like, here's your visa. Welcome to America. But now it's
Quentin Tarantino running immigration now.
The number of O1 visas have increased by 50% in the past decade. It's, of course, a fraction compared to the H-1B visa, which is like for technical workers. But I think it's funny that there's now just specific law firms that are set up to grant these work permits. Like back in the day, they would go to like artists like Yoko Ono or, Sinead O'Connor or things, they were trying to get resident. Anyway, what are your thoughts on this?
What's the old Chris Rock joke? Right, Vanetta? Like, what's the?
There's so many. I don't know where you're going with this.
I think that we've had a lot of interesting conversations. This is like more philosophical. What's with the rise in gambling and people looking for quick hooks and quick fixes to prosperity? Is the American dream that dead that instead of buying into the system, people think something like OnlyFans or, poly-market betting is a better use of their time and energy than simply building wealth through discipline and time-tested strategies over a number of years? It's kind of depressing.
I don't know.
have any good commentary on this.
Yeah, I don't know.
It makes me sad.
It does.
Makes me sad.
It does. But then you hear that you could make like $300,000 a month, and then you're like, yeah, okay, I'll take my top off.
But that's mainly Quentin Tarantino buying feet pictures on OnlyFans.
For you, Chris, Italian pasta brands, hey, they're getting relief from Trump tariffs after threatening to stop exports. Mamma mia, you can still get your spicy meatball. I'm so sorry. Americans can still enjoy Italian pasta in the U.S. as the Trump administration has rolled back an earlier threat of tariffs as high as 107% that would have hit 13 Italian pasta brands. So
all of them are bad. All of them are bad. The only pasta that people should be using is Di Cecco because it's bronze cast. It has little perforations in the pasta, so it absorbs the sauce better. Okay, and that was not going to be tariffs, so no worries. Don't eat Barilla. Stuff's garbage.
Barilla. I like protein pasta. I do protein pasta. Got to get those gains in. I am obsessed with the story. I don't know if you've been following this, but Canadian former Olympic snowboarder Ryan Wedding. Are you familiar with this case at all? He's a drug kingpin and he's on the lam. He's killed a bunch of people that were going to testify for him. Again, he was on the Canadian Olympic snowboarding team. He's in his 40s. He's a fugitive, right? I cannot wait for the Netflix documentary. Well, so federal authorities over the weekend in Mexico, in FBI, he had a rare collection of $40 million worth of motorcycles, which I'm personally interested in. So he's got these rare one-off MotoGP bikes, like Valentino Rossi bike, if you follow MotoGP. And so they have his bikes. They still can't find him. He's gone. But I'm just obsessed with this whole story. And I was like, please don't destroy these motorcycles. Sell them to me. And that's it.
Very relatable. I mean, who among us, right, Panetta? Who among us?
He competed in the 2002 Salt Lake City Winter Olympics, but he's in charge with multiple drug offenses and with running $1 billion criminal drug trafficking enterprise. And again, he's murdered a bunch of people.
Sure.
And he's also has a car collection and an art collection. And I'm just obsessed.
OJ did it better. Come on.
Oh, that's crazy. Normally at the end of the news, Chris, I like to show a funny video because I have free will and I can do what I want. Today's first viral video of the year gives new meaning to the term dog sledding. I don't know. I like dogs. Watch this.
Out of all the reindeers, you know you're the
So
mastermind. Run, run, Rudolph. Randolph ain't too far behind.
Nice, a good doggo.
Run, run, Rudolph.
Like if this dog could just entertain itself for hours, it's gonna sleep so good. Anyway, Chris, this has been delightful. I will get word on if I'm staying in here or not. I'm happy to do so. But we're gonna take a quick 30-second break. Happy New Year to everyone watching. You're watching Tasty Live. We'll be back with Confirm and Send.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
If your trade's not going how you expected, it's not necessarily that your assumption is wrong. Maybe it's just not right. Yet. Rolling is managing a trade by closing your position and opening another one like it for a credit all in one order. The cool part is that you can change the expiration to get more time, or you can tweak the strike for a higher probability. Usually we want to roll the expiration instead of the strike. Remember, duration over direction. Exactly when and how to roll trades is a learned art, and it can be a little bit subjective. Usually we only roll if we haven't changed our assumption, and we almost never roll winning trades. If you have changed your mind, don't roll. Instead, you probably want to close it if it has undefined risk, or just let the probabilities play out if it has defined risk. So before you cut your losses, consider rolling the expiration, or maybe even the strike. Pretty simple.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
What's up, everyone? Welcome back to the show. My name is Mike. I'm here with Chris Vecchio, and it is Confirm and Send. How we doing today, Chris?
Grateful that the Jets season's over.
Yeah.
How are you, Mike? Happy New Year.
That was tough. Happy New Year to you. I looked at the box score and it was like Ray Davis has 150 rushing yards. Trubisky has 4 passing touchdowns. And then I was like, oh, it's against the Jets defense. It's fine.
ESPN had this awesome graphic this weekend. It was like, which quarterback is this? And it's like, they're 14-3 this year. They've had 3,800 passing yards. They have 34 touchdowns to 0 interceptions, 109 passer rating. And you're like, who is this? And then it goes, the average QB against the Jets this year.
That is not fun. It's not fun. But guess what? The good thing about football is everything turns around. It's just like the Once it's low, it's going to pop at some point. So
no, I got to just like kvetch about this one more thing for New York sports. You know, the Giants have gone 8-30 over their last 38 football games played. Okay. 4 of those 8 wins have come in weeks 17 and 18 in the past 3 years. I mean, this team can't even tank properly that at the end of the season, they are losing their top spot in the draft. So what is going on?
Yeah.
They get what's that? Whatever's in the water here gives us great bagels and pizza and leads to the dumbest sports owners.
I feel like I do remember seeing that. Like Vegas was the example this year where they were trying to lose, and they did in fact lose by just pulling all their starters. I think it was. I remember seeing that a couple of years ago. I was like, "What are they doing? They're just like shooting themselves in the foot." But here we are. I think
do that right.
I think they'll be okay in time. Just need some time, you know.
That's it. Always time. Time solves all.
Yeah. Not much has changed in these here markets. Do you want to dive into some questions? See if we can get a little spark plug with what we got going on?
Sure. Before we do that, a quick brief look at these markets. S&P up about 0.3%, a little bit more than that now. NASDAQ up about 0.8% here. The Dow, the Russell, those are both back in positive territory, up by 0.11% and 0.27% respectively. The big news over the weekend, of course, what happened with Venezuela and Maduro. Oil is only up about less than 1% here. Natural gas, by far the bigger mover, down over 6%. Gold and silver continue to stay bid. Gold up now 2.26%. Silver up another 6%, surviving another CME margin hike. Over in the world of bonds, a little bit firmer, although gains have been eroding here the last little bit. And now we're back down to 115 in ZB and 112 and 8.5 ticks in ZN. Mike, the big mover pre-market has been ASML. Got a nice little upgrade here pre-market that effectively implies a 30% price target at year end from here. Closed on Friday at we'll say 1163, currently at 1207, up around 3%. One of the top performers, a little bit more than 3% now. One of the top performers here on the other side of the weekend.
Yeah, up decently. I'm actually surprised, to your point, in general, to see the market green today. I thought we would open red for sure, but yeah, we'll see what the open has for us in about 30 minutes or so. But yeah, I'm looking for some upside moves in crude, or at least staying above 57 from a future standpoint. But it is nice to see Bitcoin catching a little bit here for the new year.
Confirm and send today, Mike. We have 4 questions queued up for today's show. You want to get into them?
Let's do it.
John, we can keep going. What do you think about the dogs of the Dow idea and getting long the worst performing Dow components? Mike, do you know what the dogs of the Dow is?
I feel like I've heard this phrase historically. It's not something I latch onto, but I like the idea of it. I mean, we talk about all the time with the Mag 7 stocks. And when you think about like when you consider how can these benchmarks continue higher up and to the right every single year, while you have these single name stocks that eventually have their heyday to the upside and then crash to the downside and never see the light of day again. Well, there's a number of reasons, but first and foremost, if you are buying into stocks at lows in a sector that is benefiting or rallying, like that can be a nice strategy. You can find ways to get bullish when you have the Mag 7 or the dogs of the Dow and you see that they're depressed relative to their counterparts that should have a higher correlation. Same thing with the reverse. Like you could see something rallying abnormally relative to its peers and you could get short that product. But yeah, I think from a bullish standpoint, it's definitely something that I look to do when we're looking to get bullish delta in a bullish market, but we're uncomfortable buying at highs, for example. Like right now, you can find a handful of Mag 7 stocks or chip stocks that are not at highs where some other highly correlated products are. So I like the idea of it, but the Dow isn't, for me, it's not the place I would go. Like I would rather just go to the tech stocks. What about you?
Yeah, so dogs of the Dow, basically, you're looking at the 10 highest dividend paying stocks in the Dow Jones, and you're putting your money in them. And because the idea there is if they underperform in a mature, stable type of index like the Dow, where these are long-standing companies with long histories, strong balance sheets, right? If there's any material weakness there, it's not because of something that's going to formally or fundamentally impede their operations. It's probably something cyclical in nature. And so you buy, right? Last year in 2025, the dogs of the Dow actually outperformed the broader Dow Jones. Dogs of the Dow are up 17.8% in my math here, which was above the Dow 30's 14.5% gain. So is that going to continue into the future, right? Well, the dogs of the Dow, they change because the dividend payouts and the stocks change every year. So you're looking at the dividend yield and the stock performance for 2025 being the guiding factors. Those 10 Dow companies this year would be Verizon, VZ, Chevron, CVX, Merck, MRK, Procter & Gamble, PG, United Health Group, UNH, Amgen, AMGN, Coca-Cola, KO, Home Depot, HD, Nike, NKE, and then Johnson & Johnson, J&J. So there's obviously, these are not fundamentally AI names. They're not part of the major zeitgeist narrative right now that's going on. There's a lot of individual risk. We know UNH had a very difficult year at times last year. Same thing for Nike around the tariffs themselves. But at the end of the session, right, if you're an investor, it's a different calculus than if you were a trader here. Okay, so when I see a question about dogs of the Dow, maybe these are stocks that go on a watch list, and if they have sell-offs and high volatility, they become interesting pickups, knowing that other people adhere to a dividend-building strategy in their portfolio. But I wouldn't just be blindly buying out-of-the-money calls on these 10 names simply because. We don't treat them any different than we would any other stock, single stock name, Mike, as far as I'm concerned, even if they fit the dogs of the Dow criteria.
Agreed. And yeah, I think from an investment standpoint, the longer your time horizon, the easier it is to be right about your thesis. So definitely agree there.
We can go to the next question. Should we go to the next question here? Do you have a goal for your returns each year? Mike, I kind of do and kind of don't. I like to beat the market, right? If I'm not beating SPY, then what's the point of actively trading? I should just passively invest, not pay the fees, not worry about the headache, the heartache, the sleepless nights, the checking silver quotes in the middle of a 5:30 a.m. bottle this morning, right? I could avoid all that.
Yeah, that's what I was going to say is just beat the S&P, beat the benchmark, because your alternative is the benchmark. So, and it doesn't necessarily mean being profitable every single year. Like some years you're going to have, and we haven't seen it in a while, but some years you're going to have the S&P down 30% or 40%. And that's your annual year-to-date return. But if you're only down 10 or 15, like you are still beating the S&P. You're outperforming the buy and hold strategy. So yeah, I think that is that should be the goal if you're just looking for a blanket statement. Now, if you have different strategies and you're only trading certain sectors, then your goal should be different. But if you're trading a broad number of names with a broad sector diversity, then I think, yeah, it's likely something like beat the S&P or beat the NASDAQ, something like that.
Yeah, and it's different as a trader versus someone who's investing, so to speak. And I think that's the fine line here. As an investor, I may have a specific goal in mind, right? I have a portfolio worth X dollars. I need to make this many withdrawals over the course of the year. I'm paying for my kid's wedding. I'm paying for my kid's college. I have to get a new car. I'm buying a new home, right? And so I need to outperform the market by 5% in excess of inflation in order to keep my portfolio growing. What kind of assets do I need to own in order to achieve that? But it's not guaranteed, right? Setting a fixed return goal as a trader, like you're not guaranteed to say, well, I'm going to get 12%. So if I just trade these products, I'm guaranteed to get my 12% return. It's not like that. I mean, beating the market is the goal, of course, right? Being an active trader, the goal is to not be passive. And if you're going to underperform a passive market, there's no point in actively trading. But it really depends on what's happening, I think, broadly speaking. I mean, if it's a bull market, I'm obviously looking for growth. If it's a bear market, I'm thinking capital preservation. The only things that I care about, not a fixed return goal, am I sizing correctly? Am I avoiding forced trades? Am I staying liquid enough? Am I staying solvent when the market's going through a period of volatility? Am I allowed to keep playing the game the next day? And if I can accomplish all three of those things and make money along the way and stay in the fight, I believe, given how I've performed over time, that I will learn and become a better trader. And so don't set a return goal, in my view. Stay alive, adhere to a process, tweak the process, grow it over time.
Yeah, I think that's a good call out, especially when you start to look under a microscope and you're like, well, I lost this month, or I lost the last 2 weeks. Like, it's too short of a time frame, especially when we talk so much about number of occurrences and getting over that hump. But yeah, over time, if you can survive and withstand the storm that is the market, even in calm VIX times, you'll be okay.
John, let's go over to the next question. Mike, retail traders. Ooh, this is a good question. Retail traders. With so many retail traders now trading options and selling premium, do you worry it will negate our edge?
No, not really.
I'm at the same place, but why not?
Well, first of all, you have so many people trading 0-day stuff now, and there's a lot. I think there's a lot more people buying options than selling options in that space. But you can kind of see, there's a give and take of everything. Like there's opportunity, even if people are selling options, but realized volatility stays bid. Like implied volatility has to reflect that. So like IBIT is a good example. Last year sold premium the whole year, and IBIT barely moved. In that situation, even if a lot of people were jumping on board and selling premium, it's not going to compress implied volatility so much to where it's such a low number relative to realized volatility. And I think over time, as you continue to do this, you'll start to get a feel for what feels right and what feels wrong. Like I kept talking about the gold move to the upside, and in that big realized volatility move, gold implied volatility was still at like 20%. So I was like, okay, I'm not selling premium here, regardless of whether I know or don't know who or how many people or how many contracts are being sold. It's more about, does it make sense to take risk in this product with short premium? And I think that's where I hang my hat versus knowing whether a lot of people are involved or not. Like it's more of a matter of how much premium is being offered, and am I willing to accept that premium for this risk?
The edge that we're operating by, in my view, is that volatility risk is mispriced relative to the actual realized outcomes that we've seen over time. So more market participants don't eliminate that. In fact, I would make the argument that it could actually reinforce it, because retail tends to cluster around similar storylines, similar expirations. I don't want to say it's basic, but when you look at where like retails are trading the S&P, you're more likely to find retails like sitting at a 7,000 strike compared to like a 69.75. Okay, and so there's a crowding effect that occurs as more participation occurs on the retail side. But even then, that participation doesn't lend to the idea that there's any sort of edge being lost, because the edge is that volatility, thanks to our human emotions and our inability to predict the future, is mispriced relative to what actually transpires. And as long as that remains, retail, no retail, that's where we find ourselves at the crossroads of trading an opportunity.
Indeed.
John, let's do the last question here on confirm and send for this Monday morning show. Is there anything different you do at the beginning of the year that you feel helps position you for a more successful year? Mike, the answer for me is just a resounding yes. I go back and I spend time looking through all of my trading activity from the prior year. I want to see what products I traded. I want to see my win ratios in those products. I want to look at the time frames that I held trades, right? What if, it's not because I was really good with gold and silver, but it was any trade that I held for more than 4 weeks was a winner for me? Well, then it's not the problem that I've been trading natural gas. The problem is that I was only trading natural gas for a 2-week cycle and not a 4-week cycle, right? So I want to pull out some of those insights. And before I dive in and start thinking I've got to remake the wheel and reconfigure everything, Generally speaking, I will trade a little bit lighter for the first week as liquidity comes back into the market. If I've had strategies that are working, I stick with them. But the start of the year, those final 2 weeks into the first one, it's all about reviewing what I did. That way I can identify what I did wrong. And it's not that I need to get better at doing those things. I could just maybe even stop doing those things. Case in point is when I did this exercise a number of years ago, I couldn't help but notice that my scalping was just hurting me. If I held a trade for less than 4 hours, it was basically a loser all around. My losers were twice the size of my winners. My hit rate was less than 50%. So by cutting out a bad habit, my performance improved. And I was able to use that capital towards strategies and timeframes that were actually working for me within my trading style. So spend the time reviewing your log. It's a worthwhile endeavor.
Yeah, couldn't agree more. I think my answer is relatively the same. I think when it comes to the year-to-date P&L reset, you can take that however you want, but I think it does bring a natural end to what you did last year, and you can review on the transactions tab. That's what I like to do, is just look at the biggest loss from a name perspective, look at the biggest win from a name perspective, and then dig into that name and see, what I did. I'm sure I would have remembered it anyways if it was a big loser or a big winner, but just to be sure. And then, yeah, I don't really change too much, but I am deploying a new year-long trade in the micro E-mini futures. So, and I'm going to basically be doing the same strategy that I did for IBIT, which is sell premium on both sides, but don't accept short delta. So if I get tested on the upside, I'm not under hedging, which is typically what I would have done by just rolling up the put and rolling out the call and keeping the call the same. I'm just shifting the whole thing up for a scratch or a small credit. So that worked really well for IBIT. And it was kind of an aha moment for me because if you're doing something like that, you don't get caught in the big bullish moves to the upside. And if you are sized correctly, you're already going to be better off to the downside relative to the buy and hold strategy. So hitting those two marks, I think, is super important. And like the IBIT thing, I had a 65 straddle at the end of the year and IBIT closed at 50, and I still kept 50% of the premium that I collected. So that's a big testament to IBIT's implied volatility relative to realized, but you can really manipulate the strikes and where your risk is if you kind of just tweak a couple of things that we've talked about over the years. And there's nothing wrong with being perpetually bullish. I mean, yes, it's going to bite you at some point, but that's where sizing correctly comes in. So for me, that is going to be the adjustment for my year-long strategy, the core strategy, and we'll see how it goes.
Sizing correctly is just the most important thing that new traders can get around. I know a lot of people are focused on being right or wrong and like punching that lotto ticket, but if you trade off a slightly, a smaller gain profile and a potential trade for, 1 or 2 more points on probability of profit, and you size correctly, you stay in the game longer, gives you more time to accumulate and to build. And quite frankly, when that big opportunity comes around, right, Mike, you have everything squared up to take advantage of it. So, good confirm and send here to start the new year. 4 questions that I think, Mike, you and I both care a lot about. Quite frankly, I'm thinking a lot about how things that I did wrong or right last year. I got to tell you, my number one mistake, when I got below 21 DTE and I'm like, 5 points off of my ES target, I should just get out of Dodge, take the money and run. Stop being greedy and waiting for those last 5 points, because it bit me in the ass a few too many times this past year.
Yeah, that'll happen. But hey, you live and you learn, as they say.
All right, you know what? We got to take a quick wrap here. We're getting ready for the opening bell here on First Call. We'll be back in about a minute's time. You're watching Tasty Live.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
It's option. Jive.
Mike, we are back. We are getting ready for the opening bell here, but we need to take a quick detour because we are running through the show already. Can't believe it's 9:17 a.m. here in New York. We have options jive around the corner, and it's time to do our year in review. What defined 2025? Great thanks to Kai and the research team for putting this together. Mike, take it away.
Yeah, so similar to what we were just talking about, reviewing 2025, let's do it with some data. April, Liberation Day tariff shock. Who forgot that? I certainly didn't. VIX hit the 60, markets fell 10% in 2 days, then rebounded. Three straight years of double-digit gains, S&P 500 16%, only the sixth time since the 1940s. That's kind of surprising to me. So maybe I should take some short delta. Bitcoin's reversal, 126K peaked to 87K year end, down 6%. That was one of the big surprises of 2025. I remember talking to Jamal about that. Magnificent Seven, top 5 stocks drove 45% of the S&P 500 gains. Yeah, concentration can be fun, but it can be a risk as well. And international market boom, the US ranked 20th out of 23 developed markets, Japan 24%, Korea 76%. So kind of a little taste of everything there. But if we move to the next slide, we can dig in a little bit more. So index monthly and annual performance, except for the Dow, indices barely moved in December. 2025 delivered strong returns, but lagged to previous years. Yeah, those Santa Claus sleigh bells weren't really ringing, for me at least, in the end of the year here. Yeah,
today's the last day. Waiting.
Yeah, technically, yeah. So yeah, normally we get some kind of big rally. I mean, we've been conditioned to believe that it's coming, but didn't really happen at the end of the year here. Next slide, please. Holiday weeks market summary. Santa Claus rally appeared in the first week, but the momentum faded in the following week. Gold and silver are trading near historic levels with unusually high volatility. Good call out there. Gold, silver, platinum was the story of literally the last couple of weeks. But when you look at implied volatility, gold still is the lowest out of those three. Platinum can't really trade direct options on that, but silver implied volatility was at like 80%, 85%, which is a big number. Natural gas price dipped below 4. Yeah, that was another story as well. So it was really more about those products, less about the equities. Next slide,
how you got there in
please.
2025 without trading metals, personally.
Hey, that's a win, unless you were short. If you're short, painful. Week ahead highlights U.S. non-farm payrolls on January 9th, so just a few days away. ISM Services PMI and ADP private payrolls on Wednesday. Capture of Venezuela's president could lead to higher oil output, impacting global oil markets. And as of right now, oil is up slightly, but yeah. What do you think? I mean, general market being up, I came in thinking we would be down 20, 30, 40, 50, but here we are moving to the upside.
I think that gold and silver have looked as good as they've ever looked, Mike. You know, that was I was having a conversation with a fellow dad this week, and he's like, "Oh, what do you think is going to happen to oil and markets this week?" And I went, "Well, oil's, probably going to go sideways. Stocks probably don't care. I think gold and silver are probably going to moon. So we're not up 8% here in silver. Yeah, as someone who owns some silver and gold, whatever's happening is working for me.
Yeah, silver cannot be stopped. Again, sitting at, SLV, 80% implied volatility.
What if they
Gold.
didn't hike margins the past 2 weeks? Where would it be now?
That's a good question. Yeah, because we did have that big sell-off in a lot of those names, but we'll see how the day ends up working out. Next slide, please. All right, so week of the 22nd, so just before Christmas, had a nice little micro rally here, and then end of the week down a little bit. But yeah, it really wasn't about the equities. It was about the metals and natty gas to end the year, interestingly enough. Next slide, please. If we look at the weekly expected move, we're looking at slightly higher implied volatility for this week, plus or minus 77 points, about 1%. The actual move last week was, resulting in a 1% sell-off, VIX at 14. But when the VIX is so low, like I expect to have some boring periods of time, just because historically that's how it's worked. When the VIX is in the low teens, it can tend to cluster at those low levels for quite some time. So just something to consider as you strategize for this week. And maybe you take Chris's stance and stay light until we get more liquidity, until we get some more volume coming in here. Because right now it seems like it's still potentially a lower implied volatility week. And I think that's reflected in SPX expected move for the rest of this week, which is only 76 points based on current implied volatility.
Nothing, especially considering it's a non-farm payrolls week.
Yeah. Next slide, please. Major asset IV rank. So looking at the difference between the second to last week and the last week of the year, S&P 500 kind of unchanged, bonds increased, euro kind of flat, gold went down, crude oil down a little bit, natty gas down a little bit, and Bitcoin was pretty flat. So IV rank, implied volatility, you have to look at both of them. You can't just look at IV rank. But yeah, I think the story is silver, platinum, gold. Actually, at the end of the year, gold was kind of the one that wasn't moving, where silver and platinum were still ripping around. So interesting to see that continue through the beginning of this year. But gold right now is up quite a bit here. So something to keep in mind, but still big difference here between gold's 2% move to the upside and silver's 7% move to the upside. And if we look at platinum too, platinum is up 6% as well. So silver, platinum, still the story here, and gold is trying to knock on the door and join the party.
Gold is trying to join that party.
Next slide, please. All right. So biggest S&P movers in December. None of these really surprised me too much. Micron, SanDisk, Moderna, CCL, LRCX to the upside, and then to the downside, Hood, Coin, Netflix, CrowdStrike, Hewlett Packard, everyone. Yeah, but I mean, this for me, the end of the year, really the last couple months of the year was really all about the sector rotations. I feel like I saw a lot more very obvious sector rotations when it comes to like your AMD, MU, Nvidia. Like you could see these things moving with big liquidity while other sectors were moving the opposite direction. Do you have any thoughts on that?
I mean, the fact that you're seeing the rally in tech broaden out, right? Only two of the Mag 7 names really had good years last year. Breath was up. Yeah. I mean, I'm a bull still on the stock market. I think that we still have a leg up here before the bell gets rung. I'd be more surprised at seeing S&P 500, S&P 5,000 than I would be seeing like S&P 9,000 this year.
Interesting.
Hey. Yeah, but like, hey, utilities didn't have a good second half of the year. We obviously see a lot of the AI names in the energy space, like the Oklos of the world. That bubble kind of burst. This is still going on. Okay, there's a lot. We're probably in the middle of the inning still.
Yeah. And I think if we go to the second to last slide here, biggest S&P 500 movers in 2025, this kind of tells that story that you're saying. I mean, we have huge moves to the upside in a ton of names that, you know, I don't want to be rude to these companies, but like a lot of these names are not names that I would expect to stay elevated for a period of time. Like maybe we do see the reversal out of some of these names. Like half of these names are not even products that I necessarily trade. Where the bottom 10, United Healthcare, PayPal, Target, Lulu, TTD, DEC, like the list goes on. They're all down 50% or around that mark. So yeah, could be some interesting times here to begin 2026.
If you couldn't do well last year, why on earth would a company like Lululemon do better this year?
Yeah.
Just same thing for Chipotle or a PayPal or a Target, right? If you couldn't capitalize in the last 2 or 3 years when the market's doubling,
yeah,
why would 2026 be any better? Ugh.
Lulu has to sue all of the competitors and take over that space again. That's slide here.
A strategy. Sure.
Last slide here. Q3, 3,500 companies, 48% were winners, 52% were losers with an average return of 0.4%. Yeah, I mean, nothing really stood out to me. I remember during the quarterly earnings report for a lot of the Mag 7 stocks, the general market was in turmoil. So I think if I remember correctly, only Amazon was the one that had a real big rally to the upside, but a lot of other products were muted or had weaker earnings or weaker guidance for whatever reason. Plenty of reasons to call out, but yeah, I think for us to have a real strong earnings, given the state of what we're seeing now, I think we're going to need, a lot more bullish sentiment, a lot more euphoria around these parts. What say you?
I think that we need to take a quick break because we're getting ready for the opening bell, Mike. That was a good options jive segment here. Opening bell coming up next on tastylive. See you in 30 seconds.
Gonna go to Florida. I got Rob. Rob in Florida. What's up?
Very proud of your son. He is doing a great job. I really didn't know anything about years and years ago and learned all about it. And we've been trading actively since February and just couldn't be more pleased.
Awesome, man. Thank you so much for the kind words.
Thank
really
you,
do
Rob.
appreciate it.
Mike, we're back. It's time. It's that favorite time of the day. It's time for the opening bell here on Tasty Live. You're watching First Call. I'm your host, Chris Vecchio. He's Mike Butler. Mike, we're starting off the new trading year, first full trading week of the year here in 2026, and it's a strong start out of the gate for stocks. The S&P 500's up about 0.5% right now. NASDAQ up around 1%, led higher by some of those semiconductor names, by those tech stocks, ASML in particular, 25,666. That's ominous. The Dow Jones up by 0.27%. The Russell up by about 0.5% or so. Of course, as we make our way through this opening bell, all eyes on a name like Nvidia, which is stretching to a multi-week high here, looking to go up to its highest level since the middle of November. I mentioned ASML coming strong out of the gate with an upgrade now, $1,220, 4.9% to the upside. Overall, Mike, semiconductors, the ETF SMH, that is a fresh all-time high here to start 2026. Outside of that, oil, all eyes on oil still now up 1.3% in the wake of the U.S. action in Venezuela this weekend. Mike, it's day one of the new trading year. Is this enthusiasm jumping into the market, kicking things off? Does that surprise you given how we ended 2025?
I guess it's not that surprising, but we just talked about this. I think we're seeing a lot of sector strength in AMD, Micron, Nvidia, SMH, great call out. But yeah, I think as long as the VIX stays depressed, in the 14 handle, 15 handle, I expect the general graph to be up and to the right, with some volatility here and there. But yeah, I mean, we're also seeing some big moves in silver, staying bid here, gold catching up 2%, silver up 7%, platinum up almost 7% as well. So the precious metal frenzy continues on into 2026. But yeah, it's nice.
It does.
Yeah. Nice to finally see Bitcoin catching a little bit here. We'll see if it stays above 90.
I need it to stay above 90. I really want to see it get through 95 before I really get constructive on this. I see a break of a downtrend here in recent weeks and months. I see the swing highs up near 95. If we could punch through 95, we're also north of our 50-day moving average, which we have not done on a closing basis since October 27th, which is incidentally the last time that we closed above our 1-month moving average until, Friday in Bitcoin futures. So maybe a turn here is coming. Mike, I think I've seen enough. I was wrong on my 7,000 calls on the S&P 500 for the end of December. Definitely should have sold out of them right after Christmas. Alas, the best laid plans of mice and men often go awry. But we are breaking the downtrend that we've been in since the day after Christmas. We've just cleared out the swing high that we had from last Friday morning, and the market here with its 13.5 IVR. Oh, low volume, low volatility, technical push to the upside. I think we should be looking long here at the start of the show.
Yeah.
How short should we do? 25 days, I think. 7,000, 7,050. I like a little long exposure here, risking 2 to make 3 kind of setup. Not the best risk to reward, but it's something that I can work with.
Yeah. I mean, anything that reflects a bullish movement, it should not be surprising to see it. I think it's hard for a lot of traders and investors to envision like what takes us from 6,950 to 7,000 to 7,500 to 8,000. And it doesn't really take that much. Like over time, it's the continuous pour into the markets, it's sector strength, it's a number of different things. But like if we have new products being added to the S&P, laggards being removed from the S&P, like all these things play a role. So yeah, I don't mind placing a bullish trade, especially when you look at the VIX right now, sitting at 14, VIX 1 day sitting at 8. So yeah, depressed implied volatility could last for a long time. We could see this thing move up and to the right.
I feel the pull. I feel the pull. I feel the market telling me, get in, get back in. You didn't hear no bell last week. You just bad timing, but you're still right. Well, look, the market, Mike, I think for the past year, 2 years, maybe going on 3 since the lows of September, October 22. If you've been in a place where you have positive technical drift and volatility staying low, the market has liked to move to the upside. And historically speaking, that is the ball game. We've shared the research here on air. I don't have it handy at this present moment, but maybe we bring it up for later today. There we go. When you have a VIX below 15, the most efficacious thing that you can do is not to necessarily sell strangles, be short iron condors. It's to simply be long the market. And I look at a market right now where that VIX is 14.92. And that just says I have to be long the market.
Yeah. Could not agree more. And I think the only thing in my portfolio, I have a number of bullish positions. I do have some bearish positions, but really it's just like high reward, low risk. Like I have a butterfly in SPX to the downside for February. That's 100 points wide, but it's $500. And it's actually up a little bit right now because of last week, even with this rally today. So I like having those things on, like risking $500 to make 1,500 or so if you get the timing right and you get a big sell-off. That risk can be completely offset by the number of other bullish positions I have right now. Like right now, I'm making a couple $100 today, even with the loss on that butterfly. So always thinking about if you want to hedge, just make sure it's a small hedge and you're not eating up all of your profitability to the upside if you're wrong on that hedge.
No, and that's where the sizing comes into play, where if you make a mistake, right, how many times can you make that mistake before you go bust?
Mm-hmm.
And that's why I like some of these, I call them reaches, but if you're getting in that neighborhood of, you have your yeoman's work, oil, it's been trading directionally neutral outside a period of geopolitical event risk. You collect the volatility, right? You move on to the next month, the next cycle, stay directionally neutral, stay, the short iron condor, short strangle, et cetera, et cetera. But then you sprinkle in some of these out of the money things, as I like to call them, like the kicker, if you will. And if 1 out of every 3 trades works and it's a 33% probability of profit, you could break even, and you just got to find that edge to get a little bit more juice out of there, right? Can I bump that up to like a 45% win ratio? And if I do and keep my risk to reward the same exact levels, what does that mean for my P&L? So I just, volatility staying low right now. I've been bit in the ass before about this. We didn't get that run to 7K earlier, but these charts, Mike, as a technician, first and foremost, I see a triangle here, bottom left to top right in the NASDAQ. How many times have we seen this story play out? I've seen this movie before. It usually resolves bullish. If we break last week's low, then I'll change my tune and flip short. But until then, we're at support right now in these stock markets, and the volatility is staying in.
Yeah. And all those points I think are, something we're leaning on. And at the end of the day, when the VIX is in the low teens, sometimes you just gotta, even if you want the market to sell off, you have to realize it may not. But if it does, and you see that big VIX pop, then things can change. But until that happens, I'm with you. I'm leaning long here.
Mike, before we hop off here and get past the opening bell, just a quick look at some of the sectors that are outperforming here out of the gate. It's all about the energy names, the oil companies, OIH, XLE, both having significant performances. No surprise, you go over to something like a Chevron. This is trading higher by 4.28%. You could look over to the Exxon Mobils, the ConocoPhillips of the world, COP. This is up now 3.82%. Exxon, XOM, up 2% right now. Is that a new all-time high for Exxon? Exxon, really? Really, ExxonMobil? Huh. Okay. That's quite the stock chart there, Mr. Butler. So Exxon here pushing into a fresh high today. The volatilities, though, you see a 9.9 IVR with an Exxon, a 13.4 with ConocoPhillips, and then only a 15.6 with Chevron. Even on the other side of the weekend news, the major energy companies that have operations existing in the region, in Guyana, maybe they have historical relationships with Venezuela themselves. They're the ones that are leading this market to the upside. Other than that, kind of modest performance elsewhere. Semis up 2.1%. Banks, which is really fascinating, continue to be one of the major outperformers here, Mike. I see an XLF that's as clean of a looking chart as I could see. You get a nice little breakout to new all-time highs. You pull back into the former highs, which is right where the 1 month is. And then you start to rally again. Well, banks, tech, those are up on the way down. You have utilities, you have real estate, you have biotech. IBB is the worst sector thus far here to start this full week of trading, down 0.5%. But you know what, Mike? We're going to take a quick 30-second break, 90-second break. We're going to be back. We have more to get through here on this morning show. Options Jive, more Options Jive coming up next.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
All right, so I've got some good news, and I've got some bad news. Let's get that bad news out of the way first. You are going to have some losing trades. Like every trade you place, despite your extreme optimism that it's going to work out, it's not going to work out. That's the bad news. The good news is at Tasty Trade, man, we are ready to adjust and defend and roll our positions if that's what it takes. And that's what this entire crash course is all about. A 5-episode crash course all about rolling. So I will see you inside of episode number 1.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
It's option. Jive.
Mike, we are back. We're about 15 minutes into this trading day. U.S. stocks have opened up. They're trading a bit higher. S&P up about 0.6%. NASDAQ 0.8% higher, led higher by those semiconductors. But it's time for another little bit of options jive. We want to talk about strengthening our market awareness here as we kick off this trading year. Mike, this is a topic that I actually find very interesting and important. We've discussed a little bit here at the start of a new year, reflecting on what worked and what didn't work in the previous year. I think this is a process people should do quarterly, quite frankly, but I understand with the new year, there's new resolution. So just before we get into this, tell me a little bit about what your process is. Do you do anything different fundamentally when you do your year in review? Has there been anything that you've noticed in one of these reviews to increase your market awareness that like the light bulb went off and said, oh my gosh, how come I was never doing this before?
The only thing that comes to mind wasn't necessarily in the year-end review. I guess maybe it was, but just shifting from like, I love doing earnings trades, but shifting from undefined risk to defined risk. But that kind of came with the market structure change, because when we first started doing earnings trades, you could see heightened implied volatility in the 30-day cycle, the 60-day cycle. Like it was still elevated there, where these days, a lot of that implied volatility is concentrated in the weekly cycle, and the 30-day and the 60-day implied volatility is depressed. So that kind of gave me the light bulb moment of like, why am I selling premium here when I can buy premium in the 30 or 60-day and sell the weekly against it? And that's really what started our diagonal spread, crab trade, calendar spread. Like that's why we do them so much, was because we saw that shift in implied volatility, and recognizing that shift made us move towards those strategies, which kind of hit on all those check boxes while still allowing you to participate, but keeping your risk defined just in case something goes haywire. You know exactly how much you can lose up front. Because historically, a lot of my big losers when I was selling undefined risk, selling strangles for earnings, a lot of those year-end losers were from earnings trades. So I'm like, okay, this has to stop. I'm not doing well on these things. I'm not picking these products very well, but I am consistently engaging in them. So shifting to defined risk there has made a big difference overall.
Yeah, you mentioned the earning trades. I find myself paying a little bit more closer attention to earnings, not because I learned my lesson at the end of last year, right? I typically don't trade around earnings. I'm a macro guy. I take a few stabs. I decide to, trade a little Oracle. What's the worst that could happen? But it was obvious to me, as one of the things that we're going to talk about now, that like very clearly as I've developed over time, I know that I don't have a good sense of market awareness about individual stock names as it pertains to earnings, because I think in a macro worldview. And I think that trying to develop that muscle a little bit more this year is I just want another strategy, another tool in my toolkit so that I can continue to diversify and layer in different assumptions and hopefully have a lot of different things that are working to offset the things that aren't working here. So I do think that we start this year, we go through today's segment here in Options Jives. How do we develop a sense of market awareness? Like what's going on around us as we make our way through the day? How do people like Tom or Tony, or even you and me, Mike, how do we know what's important versus what's not? And that's not because we've sat down and, went to college and got our degrees in finance or economics or, studied for the CFA charter, or it's because we've experienced things and we've learned to figure out what's important and what's not, depending upon the context in which they occur. So John, we can go to the next slide here. As we get into this new year and reflect on what happened in the most recent trading year, we want to figure out ways to improve our strategies and our trading outlook in order to be more successful. Now, one such way that you can do this is through market awareness, right? Market awareness refers to our ability to assess the entire stock market, the options marketplace from a 30,000-foot view, from that top level macro perspective. When you have that market awareness, it at least helps you avoid bad decisions. It's not that you're necessarily going to take trades, Mike, on some of these top line observations you have, but they may keep you away from doing the bad things up front. And for me, the bad thing would be trying to scalp around an earnings report. So, John, we can go to the next slide. Why do we care about strengthening our awareness? There is a prime benefit here of strengthening your market awareness, and it's that it can lead to improvements in 3 specific areas. 1, how we form our assumptions. 2, where we choose to get into the market. And 3, is this something that I've seen before? I just made the joke, Mike, that this triangle in the NASDAQ right now, it's a movie that we've seen play out. Why do I say that? It's because of my market awareness. It's recognizing a particular type of movement in the market. It could be the price action. It could be how volatility is evolving. But you get that spidey sense, that deja vu. Oh, this is not normal, or when this occurs, I have experienced this before. You have to file those things in your internal library to help build out your understanding of what happens for why and what reasons. John, as we move on to the next slide here, we talk about the process of building out these assumptions, and it's really helpful to have that longer term opinion of a market direction. You and I say we're bulls. We think the market's going up. Why? We can have our X, Y, Z reasons. Maybe they're different from yours. Maybe yours are ABC. But as long as we see those pillars of our rationale remaining in place, how do we approach our strategies? And so for a bull, for example, the market's dipping. We're into our 1 month. This thing is probably a little cooked on the downside. I'm going to buy here. I'm going to buy the dip because the market still is probably going up. So how do we get those assumptions in place? Well, you have to look at interest rates. You have to look at currencies. And as a tasty trader, you're, of course, looking at your volatility curve analysis. Mike, you and I frequently talk about this, and I like to question you and Jamal and Nick whenever I can. What do you think about the shape of the volatility curve? What does this backwardation mean? Why are we in contango? Why is the front month kinked when the rest of the curve is appearing normal? All of those things help inform me for how I want to approach the market. I'm assuming it's the same for you too, because after all, we are both tasty traders.
Yeah, I think the volatility curve is something that everyone should understand. You can make your own watch list. I actually need to make my own watch list for this year. But yeah, that's one of the things where it's like, if you know that historically speaking, the market is not going to crash unless we are in backwardation, or at least hasn't crashed more than 10, 20, those are the times when it's going down 20%, 30%, we are in backwardation, and on the way back up we are in contango. So if you can just take that from a simple sentence, like if we're in backwardation, that's your highly probable or more probable chance of continued volatility to the downside. And for recovery standpoint, we have to move from backwardation to contango. If you understand that those can be true, and they can be true, they have been true, they can be true in the future, then looking at the volatility curve, especially into big sell-offs, can help develop assumptions. So like we talk about this all the time, like we'll see the market down 60 points, we'll look at volatility, we're still in a steep contango. Volatility is not really reacting. And we're just like, well, if volatility is not reacting, why should I react to this? So we might take a bullish stance into those sell-offs where in the same situation, maybe you get a 100-point sell-off, 150-point sell-off, and we look at volatility and we've gone from contango to a flat curve or maybe a slight backwardation. That's a different environment. And that's like, okay, wow, we actually have moved from contango to being flat or from contango to being into backwardation. We might have more selling on our hands here. Let's wait and see if we're trying to take, a bullish stance, or if we're trying to lean into the downside. That would be the environment I would want to do it in. So that's an example of market awareness, something we've developed over time. But yeah, the volatility curve, if I were to pick one of these on this list, it would be the volatility curve because we have it on our watch list. We check it all the time.
Yeah, you mentioned the watch list. That's one thing that we can do here on the platform. And I think fundamentally, that's one thing every trader should do. You can go over to the platform. We have a bunch of preset watch lists here. But if you're trying to develop your market sense, I personally like looking at futures more than the ETFs, for example. What happens overnight in the S&P 500, it still counts. Same thing in the bond market, same thing in gold or oil. So instead of waiting for like a GLD or a TLT or a USO to open, which is perfectly fine if you're only a cash equity trader, but for me, it's looking at things like ES and GC and ZN and ZB, which is why on the platform, we can go to the next slide there, Mr. John. You'll find that we have this and one more slide thereafter. In fact, on the left-hand side of the platform, you're going to see that there is an ability to tailor out your watch list. Just one more slide. There we go. Okay. So you can choose a watch list. You've seen me tinker with this on the platform. I like to keep the futures CME tab open, but you can also go into things like the high options volume. What's moving today? What's happening there? Is the volatility going up or down? Is there news, right? This is also how you can develop the sense. Hold on a second. I notice all these names in the high options volume list, Mike. These are all semiconductor names. What is that telling me about where the market's attention is today? Or what if it's all random and the indexes are flat, right? That's also informative unto itself. So just being aware of the different sectoral relationships, the asset relationships, you don't even need to trade them to start off. Today is a really good example of this. If you weren't with any skin in the game coming out of this weekend, right? You weren't trading oil, you weren't trading gold, you didn't have any stocks or bonds on. What about today surprises you or doesn't surprise you? Right? How come we're not seeing a bigger move in oil? Why is most of the action in the metals? How come stocks are floating to the upside? Is this challenging your assumptions? So test your awareness in real time with what you think would have occurred provided an event happened and see if you're right. And if you're right, then maybe you should start building a strategy around it. And if you're not, maybe assess your worldview and your understanding of how the markets operate.
Yep. Couldn't agree more. And I think from a watch list standpoint, I really like to just look at, from a day-to-day standpoint, if I'm trying to see what the market is focusing on, I just look at stuff over 1%. So like right now, I can tell you, just looking at the futures watch list, there's only a handful of products that are up over 1%. And there's only one product that's down more than 1%, and that's natural gas. So that eliminates like half the list right there. If you're just looking for a quick and easy way to see what's going on in the market, I like to do that, is to look at what's up or down over 1%. Everything else in the middle is kind of just that expected chop, and there's not much to glean from that. You're muted, Chris.
Thank you. We can go to the next slide here. John, as we get ready to wrap this up, what's the point of all this? Market awareness is generally trying to improve our ability to have good awareness. If it's on the future side, the ETF side, we want to have the fear awareness, the VIX products. It could be VIX 1D. It could be VIX itself. It could be /VX futures, right? Maybe even it's VVIX. You want to be aware of the participation going on. Are trading volumes higher or lower than they've been over the past week, the past month? Are volumes higher today because of an earnings report, an economic data release like a CPI non-farm payrolls? Wait, today was a CPI report day and volumes are lower than they have been over the past month? That means something. These are things that really can be improved upon, right? Your market awareness can be improved upon through just spending time in the market. You, of course, can read research and bootstrap that episodic knowledge by ultimately going and living through other people's lived experiences. And that's one of the things that I think, Mike, you and I have both done, and a lot of successful traders have done over time. You read the books about Jesse Livermore or the hedge fund wizards, for example, the Jack Schwager books, and you could see what's worked and not worked, and you begin to test your own ideas out over time. So if I'm a new trader, I want to absorb as much information as possible. And that's to say, I want to learn from other people how they develop their market awareness. And then I want to figure out how to do it on my own. So you can only improve upon these things by actually sitting and staring at the charts and looking at the tape and creating hypotheses and writing them down and seeing if the market plays out the way that you thought it would. But having a good idea of events and the changes in volatilities and the liquidity, it's important to have a deep understanding of the underlyings of the industries we're trying to trade. And I know it seems trite, but ultimately having an idea of what's happening in the products that you're operating in, it's not the worst idea in the world, Mr. Butler.
Yeah, and I think, it's a necessity of sorts. Like, even if you're not trading these products that are moving, like I have a position on in silver, but I don't have a position on in gold right now. But like, I know the story is silver, gold, platinum. So my eyes are locked on there. And if I see something that I like and I want to take a stab at it, like I will step in then. But it's good to know, like, why are the end of last year, why are the equities not moving? Well, it may be because everyone that's trading is just focused on these precious metals, and that's it. But and you're seeing that continue today. But I think at the end of the day, like, you could see silver prices rallying and be like, ooh, maybe this isn't so good for the tech stocks or the chip stocks. Like, you can take an assumption however you want. But I think the market awareness piece and just having a pulse on what's going on in the market will help you develop the assumption, and at the very least, ensure that you're not just shooting in the dark and, placing these assumptions, whether they're bullish or bearish, without having a holistic view of what's going on in the market.
We can go to the last slide here, John. Developing market awareness is easier said than done, right? It's a skill that has to be developed over time. Quite frankly, I think it's a skill that's constantly a work in progress, because economic regimes, financial regimes, the relationships between assets, they change over time, right? We've seen this with bonds and stocks over the past few years. We've seen this with gold and stocks over the past year, where gold kind of became more of a risk asset than anything else. And so it's never a finished process. There are broad overarching frameworks that I abide by. But in terms of, well, if X is happening, then Y should occur. Maybe that's true today. It may not be true tomorrow. It can be mastered and strengthened through practice. It's honing. It's doing your reps. It's going to the gym. If you stop paying attention to the market today and disappear for 3 months, who knows where we'll be? So it is a recursive, constantly updating, constantly trying to improve. I just think it's an important skill to have, Mike, and it gives us a better chance of success in 2026 if we're focusing on what motivates the things that we are trading, and quite frankly, what to ignore, how to figure out, separate the wheat from the chaff, ignore the noise and focus on the signal. Market awareness is incredibly important, and I think it's a skill that all of us can work on, even if we think we're really good at it still.
Indeed.
That's it for Options Jive. And we're at 10 Eastern, 9 Central right now, that's a good time for a quick little break. Hey, on the other side of this, we have more great programming coming down the pipeline. You know what? Let's just take the break. Get a cup of coffee. Come back. You're watching Tasty Live.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, 2 female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IB rank, and more tools. Tasty Trade. Download today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Today's episode of Market Measures is brought to you by SIBO. SIBO is partnering with tastylive to provide educational opportunities for traders at all levels. Did you know index options like these can provide opportunities for diversification, lower volatility, liquidity, and other benefits? To continue your education on some of the mechanics learned in today's market measures, check out SIBO's Retail Trader Suite at www.sibo.com/minis.
Mike, we are back. Hope everyone's having a good start to their trading week, trading month, trading year. You're watching Tasty Live. This is First Call. I'm Chris Vecchio. He's Mike Butler. The Batman will be back tomorrow. Have no fear. This is not a regular occurrence, but you will have to deal with us for the next 20 minutes or so as we talk about the Santa Claus rally. Mike, where is the Santa Claus rally? Is this it today? Are we finally getting the Santa Claus rally?
It may be. It might be the extended Santa Claus rally. You know what's funny about the Santa Claus rally? I watched a Santa Claus movie with Kurt Russell, and can't say I'll ever watch it again. Christmas Chronicles. Have you seen this?
No, I got subjected to a movie called Christmas Again on the Disney Channel, which is basically Groundhog's Day for kids.
Got it.
But this
Same
little girl's
concept.
a brat. But this little girl's a brat who's having like the best Christmas ever and doing everything she wants to do every single day, and like it never gets boring for her. So there's
Great
no
message.
lesson learned. No lesson learned.
Yeah. Then your kids turn to you and you're like, why am I not doing this every day?
Yeah, great. Like, this isn't First Call, by the way, Mike. What show are we on?
This is Market Measures.
This is Market Measures.
I heard you say it, but I just wanted to let you roll with it. See where we went with it.
Maybe you should take this one then.
Well, I missed the first hour of the day, so maybe not. Maybe not. Weekly 0-day breakdown, trading into the Santa rally. Let's dive in, people. All right, SPX and the VIX one day. So we literally just talked about this, how volatility can be a nice guiding light, at least for near-term movements. But during the Christmas week, Santa rally pushed the market to new highs, while implied volatility declined. Heading into the new year, intraday trading ranges widened, accompanied by elevated trading volume during the final trading days of 2025. And yeah, the story wasn't necessarily the S&P. Again, it was the precious metals, which is a first for me. Normally it's the S&P and the NASDAQ just ripping higher, trying to create the narrative. Like I was shocked that we didn't get to 7,000 SPX, but hey, there's always next year, or I guess this year. There's always this year. Let's.
We're waiting until next year for 7K, Mike. I've got a
I think we'll get there in a couple weeks. At this rate, couple weeks. Let's pop over to the next slide. Take a look at the VIX levels during the holidays. So the VIX reached its lowest level on Christmas Eve, spooky, closing at 1347. The median VIX during the holiday period was 14.5, well below both the 2025 median of 17.2 and the long-term median of 16.7. And I like for this one, so this is a good example of another shred of market awareness. So it's not always the market ripping higher resulting in the VIX getting depressed. Sometimes it's the market not moving and the VIX getting depressed. So sometimes you'll see markets selling off, VIX is elevated, and then not necessarily the market rebounding in a big way. It could just be the market cooling off and having a narrow intraday trading range, which results in the VIX being compressed. So the volatility, or the VIX, is the volatility forecast of the S&P 500. And if the S&P 500 is not moving, even if it's moving a slight bit to the downside or a slight bit to the upside, you can and should expect to see the VIX compress a little bit. So that was, for me, really the story of the end of the year. Do you have anything to add to this? Or are you on board with that?
I mean, I'm on board with it. Again, the fact that Santa Claus rally really hasn't played out, even though vol declines at the end of the year and it's below both the 2025 and longer term medians, I would think that the S&P should be at 7,000 or 7,100. Maybe I have some interest over there, Mike.
Maybe. Well, you definitely do now because you were filled on the show. So
yes. Oh, that's true. I got to put that on the follow page.
There you go. Let's pop over to the next slide. Look at iron condor performance. We kind of talked about this a couple minutes ago about low VIX, S&P not really moving, but iron condor performance, low realized volatility during the holiday period, which was really just super narrow trading ranges, not much going on at all, created an ideal environment for premium selling in this example. So managed positions at 25% max profit resulted in a 100% success rate since mid-December. And yeah, I think when you take this into account and you look at how narrow these trading ranges were, you were consistently getting paid to take that risk. And this is a good example of implied volatility likely overstating realized volatility, because the markets still have to price in some kind of volatility. You can't just price in the fact that we're going to have, a 50-point trading range or a 40-point trading range or even more narrow than that. So it was a good end of the year. And specifically for the S&P, the attention was elsewhere. The S&P really wasn't moving too much. So created a nice environment for the daily iron condor for 25% profit. How about 50% profit on the next slide here? 50%, looking at the profit target, greedier profit taking at 50%, increased risk without improving returns. Interesting. Longer durations and higher afternoon volatility led to 2 losses and materially reduced overall performance. And yeah, when you think about this and you think about how these trades are deployed, with iron condors, when you place them, to get 50%, you're going to have to hold them more than likely into the early afternoon, late afternoon session, where if you're just trying to get 25%, that could come out in the first hour of trading, hour and a half trading. Like it could be as simple as that. So in this case, it's, risk on, risk off, trying to take a tiny chunk out of it. And in the case of lower implied volatility, when you have a narrow trading range, you can't absorb as much volatility against you. So I think in this situation, taking them at 25% really got you out of the trade a lot sooner versus the 50% target, where you were likely waiting longer, probably from like 9 a.m. to noon, I would assume, if we were to look at the timestamps on these. Yeah, here you go. The minutes from entry, you can see you have to hold these way longer than on the previous slide, where you were out on all of them by 11 a.m. So these ones, you're holding them into the afternoon, and a lot of them turn into losses because of it.
It's a great environment for scalpers, Mike. This seems to be like a holiday playbook more than something that would necessarily be great during normal conditions. But again, if vol's staying low and we don't have catalysts, that earnings calendar this week is really dry. There's nothing there until Friday for non-farm payrolls.
Yeah, and I think you could see a situation where we are kind of just in this lull period until the banks report, because the banks, to your point, you called them out earlier, they're ripping higher, and it could set the stage for a strong earnings report quarter. But they don't report until January 14th, 15th. So we still have about 10 days until that happens.
Banks make money when they get paid back, Mike. That's all I'm going to say to that.
Hey, we'll see. We'll see. Maybe they'll drum something up for us. Maybe they'll surprise us. Probably not, though, because they're banks. All right. Next slide, please. Exceptional performance during the holiday. This holiday period, zero-day performance significantly outperformed long-term results when profits were taken earlier and trade duration was reduced. So again, taking profits at 25%, really the story was the duration. You can see it here. 2 hours in the time in the trade, an hour since 12:15, 50% reduction in the time in the trade. So, and I think when you look at the way the markets moved or didn't move, in this example, taking the small shots when volatility is super low, I think this is a good takeaway for this market measures here is if we have the VIX in the low teens, maybe you reduce your profit target to 25% instead of 50 because you know you're dealing with more narrow trading ranges and you want to be out sooner than later because of that. And historically, with the Santa Claus rally, of course, we didn't really get one this year. So the neutral iron condors worked well in this period of time. And it did work well with the lower implied volatility and the lower profit target, to be sure.
The Santa Claus rally window officially, today's the last day, so it's the first two of the new year. That puts us through to we started this window on the end of the 23rd. That was 69, 61 in the S&P 500. We have moved 17 points, Mike, over that window here. So being directionally neutral around it was ultimately the right thing to do.
Yeah, for sure.
So far.
Next slide, please. Side testing analysis. So recent price action differed from long-term behavior. Instead of frequent call side testing, SPX more consistently challenged the downside, with the downside strike tested approximately 3 times longer than the call side over the past 3 weeks. This downside heavy price behavior increased the risk of bullish strategies. And yeah, I mean, while this is true, we're not being tested with 200-point moves to the downside. We're being tested with very small moves. And I think it's more of a reaction of the low implied volatility in general and the lack of interest in pushing this thing to the moon. Santa Claus was smoking cigs outside, akin to Bad Santa, not giving us. I see your reaction here. But I mean, it's true. We didn't get the rally. And I'm kind of upset. Now that I think about it, I'm kind of upset we didn't get it.
There's probably some deep childhood trauma buried somewhere in there, Mike.
Potentially. We won't bring that up on this show.
No, that's market. That's not for market measures. No.
Yeah, maybe for the opening bell at some other time. Next slide, please. 30 delta, 30 wide put spread performance. So keeping this in mind, traders who positioned bullish for the Santa Claus rally using a 30 delta, 30-point wide put spread managed at a 25% profit target with a 500% stop loss were still profitable, but with significantly lower returns compared to iron condor strategies. So yeah, I think when you look at the minutes from entry, of course, these are going to be longer term relative to the quicker profit targets, likely because you're collecting more, you're waiting for more, you're more directional. But yeah, nice to see that you were still profitable even with the more tests to the downside here in this 2025 year-end market. Last but not least, worst case day review. 12:15 and 12:17 saw large one-sided moves, leaving only brief early morning profit opportunities. This underscores the importance of mechanical execution and quick profit taking in low volatility markets, where volatility expansion can quickly increase risk. And yeah, even if you're not in the money or tested necessarily, if you see an implied volatility spike just for a little bit, you can see marked losses or extrinsic value losses until that premium is zapped back out of the market. So again, I think the easy takeaway from this is when you have super narrow trading ranges, maybe your 0-day profit target of 50%, you chop that down to 25. All things considered, you want to be out sooner than later. And in high volatility environments or implied volatility environments, because you have a much wider trading range that you can absorb, maybe that's when you're looking for that 50% profit target. And I think I can't emphasize it enough. It's because you have so much more space for that market to move. Although the market is projected to move more, it's easier to hold through that sort of period of time versus when you have, a 20 or 30 point range with a 0-day iron condor, where you're really just looking for that small kind of scalp feel.
Yeah, and I think the takeaway there, though, you staying mechanical is what defines the success here.
Mm-hmm.
And the second that you start saying, well, I've made 25%, let me kick this out to 50, and it falls apart, don't be surprised. It's a totally different risk profile. You need to hold the trade for longer. You need to take on more risk. But fascinating. Low volume, low volatility. You get a little bit of a sideways chop out of the gate. You can take your trade, you can move on and go back the next day and stay mechanical during that type of environment, but in that specific type of environment.
Indeed. Well, should we take a little quick break? We got some special guests that are going to join us in just a little bit here, but yeah, we'll be back in about 90 seconds. You're listening to Tasty Live.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Got trader's block? We've got the cure. Get data-driven trade ideas with cherry picks. Our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
What is theta? Options lose part of their value over time as they get closer to expiration. That's why they're called wasting assets. Theta is how fast the option's value changes in a day, not taking any other factors into account. Way far out, an option's price doesn't change as much as time passes. But at about 60 days till expiration, the time part of the option's price starts falling, and at around 45 days to expiration, it starts dropping much faster. If you bought an option, you'll feel time decay pushing down on that option's price. If you sold the option, though, time is on your side, and keeping the credit from the opening trade becomes more likely. Even though options lose their value over time, Tasty mechanics say to exit the trade near 21 days till expiration. Remember, gamma risk gets stronger in the last several days, and stock movements will have more of an effect on options prices. Again, theta is just the rate at which options lose part of their value. Pretty simple.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Mike, we're back. We're back. I love that intro music. Do you know why? Because it means that Quentin is here. Quentin,
This is true.
Good to see you. We are live from the trade desk. Quentin, you have... Oh, my producers are telling us we have important breaking news. Quentin, what's the important breaking news?
Fellas, how's it going? Thank you for having me. So we've got something massive here coming. So we've got a new promotion that if you are a new customer, we've got 4% cash match and 30 days commission-free trading as well. And so this is actually like, normally I don't like to, do ad reads, things like that, but this is nuts. We've got 4% cash match and then icing on the cake there, 30 days commission-free trading. So especially if you've been waiting to try Tasty Trade, if you've been stuck on another platform and haven't come over yet and have been looking for an excuse to come to Tasty Trade, this is it. I don't know what else would get you to come over to Tasty Trade if it's not this. I mean, so if you transfer $250,000, we'll give you 10 Thondo match. So, and then 30 days free trading. If you don't like it, you can always ACAT out back. But I mean, this is crazy. Any new account besides IRAs, so cash account, joint account, business, trust, of course, individual margin and cash account, you can transfer those over or just open an account and fund it however you would like. And then we'll give you 4% cash match up to $10,000. This is a massive promotion here.
Mike, dare I say this is competitive with and in many cases stronger than what else is out there for active traders right now?
I don't know what promotion beats this. I really don't.
Yeah, I mean, like if I'm a
This is
high
nuts.
intent trader in 2026 and I'm looking for a place to park my brokerage, listen, I'm a little biased here, okay, but this is a pretty good offer.
Yeah.
Couldn't
This
agree more. I
is
think
crazy.
the 4% match, 30-day commission-free trading. It's all the things you would want in a offer, especially if you're transferring over or just creating a fresh new account, shiny new tasty account. But yeah, I think if you're watching this show, it just makes everything so much easier when you have the platform in front of you. You can follow along, or better yet, you can fade everything we do. But yeah, check it out. tastytrade.com/big deal. I've got the link pinned in the top of the YouTube chat if you want to click it there, or you can take out your shiny new smartphone that hopefully you got from Santa Claus and scan that little QR code there. It'll bring you right there.
Yeah, hopefully Santa had some time to give you a phone in between cigarette breaks outside, Mike. Okay, Quentin, that's a reference to the last segment here. But you know what? We have you live from the trade desk today, and let's talk about what's going on in this market. The S&P is out 0.8%. The Nasdaq's up 1.15. The Dow and the Russell, which were lagging earlier, are now your leaders. The Dow's up 1.37%, Russell 1.26%. Crypto continuing to stay strong, 4% here. Quentin, tell us, what do you see through your crystal ball here now on the other side of this holiday, this first day of trading?
Well, I mean, really the crystal ball is, going to silver. That's what everyone's talking about. Everyone's trading the precious metals. Silver has had the craziest up move we've seen in a really long time out of any products, and also like platinum, things like that. But I mean, silver, that's the real tradable product. A lot of people trading the futures, a lot of people trading the micro futures, and then also like the options on SLV as well for the ETFs. And if you don't want to, trade those massive contracts, you can also trade the stock in SLV. But yeah, I mean, it's really been silver has been the big trading product that we've seen.
I was shocked to see that SLV was one of the top tickers on Wall Street bets in terms of most active and most discussed last week. But then again, it was moving as much as it did. There's the CME margin hikes. I'm looking at the silver market right now, Mike. It's up at 86.6 IVR. It's a almost 7.9% rally today. This feels different than what happened in 2011 when the CME hiked margins a handful of times over the course of like 8 or 9 trading days. And that ultimately helped kill silver's rally. What does it say to you guys? Mike, start with you and then go over to Quentin. What does it say to you guys that silver is still holding up despite this pressure on short-term speculators?
It's a great call out. I mean, we did see the washout a couple days ago, but I think it just speaks to the real volatility in this product. I mean, every single day for the last week and a half, this thing has moved over 2%. Like it's been a massive mover, and it's garnered the attention of anyone paying attention to the market. but I'm especially interested in the increase in implied volatility and increase in IV rank, especially when you compare it to something like gold. I mean, gold was the forgotten precious metal, for lack of better phrases, but last week it really wasn't moving around all that much. But gold's implied volatility is still only at 25%. I mean, this is dirt cheap in terms of premium relative to silver, which is reflecting 3 times more implied volatility, and it's moving more. So definitely fair, but interesting to see that it is kicking up and it's staying bid for sure.
Yeah.
Tell me, Quentin, what's going on with SLV here? Why do you think it's just the retail participation? You said it's a high uptick in activity across the desk. Is it simply because of the movement?
Yeah, I mean, because right now, like the broad-based markets are pretty boring, like the S&P, QQQ, things like that. People aren't trading those as much because that's not where the volatility is. Everyone's going to the movement, and as you see here with like the SLV charts, there's been nothing but upside here that we've seen. We saw like a little like hesitation around a certain level, and then it just went skyrocket back up. And so with all the movement, that's where all the traders are going. Wherever there's the volatility, the excitement, the big moves, that's what we see a lot.
I saw a lot of people on Reddit last week that are typically involved in crypto conversations talking about silver. In the Bitcoin forum, it was a lot of, I don't want to say jealousy, but how come Bitcoin's not going up if silver and gold are kind of conversation. I really love this chart. Last week when we were talking through the sell-off, the line in the sand was 70. If we held the swing low prior to Christmas Eve, then what we saw in that terms of the big pullback was just a deletion of the holiday price action. That uptrend from the lows that we have at the end of November, that's still intact coming out of last week. And now you have a break of the downtrend here. Silver's been really good to me today. It's my best performing position. It was the best thing that I traded all of last year continuously. I have if this is the market on the other side of these margin hikes, listen, more could be coming. This thing looks still very constructive in my view. $80 silver, $90 silver, $100 silver at some point this year doesn't seem that far-fetched. Ooh, $100 silver.
How do you think this would play out? So if we do get $100 silver, how do you think that affects some of these big tech stocks? Do you think that really like crushes their ability to do big things, specifically chip stocks?
Personally, no. I think if you take a look at all the components that go into various hardware, like it's I think 30 grams of silver go into GPUs. I mean, it's nothing. Big picture. The break even is really going to be when silver gets up to like $120, $130 an ounce. That's where industrial profits for a number of industries would be zeroed out. And you see that copper, despite the fact that it has differences molecularly with silver, it would become that a more cost-effective substitute. Whereas right now, it's still not the most cost-effective substitute, given how much more of it you would need to accomplish what silver can accomplish. So demand destruction is still a good 50% away, Mike. And that to me was what makes this story really fascinating. Why not test 125?
That's fair. I mean, one of my friends repairs cancer treatment machines, like the huge cancer treatment machines in hospitals. And he says that he's already had meetings with managers and people higher up than him that are like, what is going on with platinum? How do we offset this cost of platinum? Because they use it in a lot of their machines. And he's like, I just don't know what to tell you. Like, this is just what it is. So I think it's permeating through certain industries already. But to your point, for silver, if and when we get there, we might be happy about it if we're playing for this bullish move anyway. So we'll see.
Quentin, surely people are doing other things than trade silver. This feels like I can't believe silver is the most popular thing to trade right now. But then again,
it's up there.
Price action speaks for itself.
For sure. Yeah. Here, let's take a look at let's take a look at the top 20 symbols going through the system and their IVRs. At number 1, we do not have SLV actually. We've got Tesla, which is always the king of the top 20 symbols. You've got Tesla 11, SLV 87, IBIT 40, GLD 59, Nvidia 9, AMD 37, Micron 43, SoFi 16, Amazon 31, MSTR 26, Palantir 20, Oracle 44, Intel 32, Meta 29, Coinbase 11, Broadcom 17, Netflix 37, Robinhood 14, Oklo 37, and BE 42.
The only ones on that list that surprised me are Oklo and BE.
Yeah, Oklo will be
Trying
on
to
there somewhat often. BE, not a frequent flyer on this list.
Yeah, Oklo's up 13%, so that makes a lot more sense. But yeah, BE, interesting.
Yeah, good for them. Maybe there's like always like the weird companies with like earnings or something like that will always be on this list.
Fair.
Interesting. Netflix here. That surprises me. I haven't had. Have we complained about the Stranger Things finale yet? Maybe that's why the stock's down.
Not officially. What qualms do you have with the Stranger Things finale?
Basically everything. I mean, the writing was so, for if you're going to be a showrunner and a writer and you're going to tell us, pay attention to the details. And then so everyone pays attention to the details. Like, for example, the Mind Flayer, he's always cold and dark. Well, then why in the final season is he like living in an arid desert? Like just little inconsistencies like that. Also, what happened to the Wheeler's parents? Why was Ted? Does no one die in this? I just okay.
Get him, Becky.
You know what?
Get him.
So you wanted more death and destruction. Got it.
No, I just like wanted like some stakes here, but like thematically, if this is an homage to 1980s movies, the whole thing about 1980s action movies was that the good guys always won and went home happy and lived happily ever after. So, I guess they accomplished that. Whether or not anyone is living or dying at the end of the episode, they did give an interview yesterday where they said it's up to the audience to figure that out. No, it's not. You're the writers. Tell us. I digress. Is this a Warner Brothers play? Right? Is that the story here? Warner Brothers, Paramount, Skydance. Is this really what we're talking about when it comes to Netflix?
I think you could be short Netflix, long Paramount, because Paramount is now hosting UFC, and they're killing pay-per-view. I think they're just making you spend like $60 for a year of access, which is nuts if that's actually the case, because normally a pay-per-view is $70 plus you need ESPN Plus, at least last year.
Yes.
So I think they're about to get an influx of some revenue at the very least.
Maybe. I pay for Paramount Plus to watch South Park and Dexter. And then when I'm done watching those, I cancel it because I don't need to pay for Paramount Plus otherwise. There's just nothing else on there for me. Quentin, what's the most interesting thing that's come across the trade desk this morning? Okay, so we've talked silver, we've talked a little Netflix here. What surprises you? What's surprising you guys at the start of this trading year?
Yeah, I would say that like volatility hasn't really moved much, even though we've seen a bit of like two-sided action over the past couple of weeks, but we haven't really seen like volatility move from that. They've been small moves, like we'll see a move down. We won't really see volatility expand. So that's been pretty interesting. Like if you've been selling premium over the past like month and a half, something like that, you've probably been raking it in, which is a little bit surprising with some of the market action that we've seen. Like it's gotten really dull, but there has been some two-sided action. So as you've been selling premium, it's been staying pretty neutral as well, most of the market. Like if you're looking at the S&P, the NASDAQ, things like that, you've probably been collecting, and then to see implied volatility just be so low compared to where we've seen it over the past year, that's just a little surprising to us for sure.
Volatility is staying low here, 13.3 IVR in the S&P, 19.4 in the NASDAQ, Mike. Not surprising, a lot of the names that Quentin mentioned here on air, they have higher IVs and IVRs than what you're seeing in the indexes. I couldn't help, though, none of these companies this week, they're not really looking at any earnings reports. Tomorrow, AAR Core, ticker symbol AIR, with its $3.3 billion market cap, not exactly a big mover. Constellation brand, STZ, $24 billion market cap. Is this a trade this week, Mike? Are there any of these? Are you seeing any crossover between like the high IVR names and any of the earnings reports, or is this kind of just the reshuffle at the start of the year? Should we look too deeply into this? Is what I'm saying.
I'm personally not. I think for me, the most interesting thing is yes, we do have Constellation brands in a couple days here, but it's interesting to see the banks just ripping a week and a half ahead of their earnings report. I think that for me is going to be that, like, the question is, will this sustain? Will this continue? Or is this kind of like a pre-earnings pump and dump? Because this is a big move.
Well, it's actually a really notable move. You're seeing it in both XLF and KRE. KRE to me is one of the more fascinating charts that we have here, Mike. I'm looking at a weekly over the last 10 years. I see coming out of the downtrend from where we were. What is this? This is SVB and Signature Bank collapsing. But now we have this left shoulder head, right shoulder, inverted head and shoulders pattern. We're breaking a downtrend here. A few days ago, we fell back to the 50-day moving average and immediately bounced to reclaim the breakout territory. So the smaller banks look pretty good. The regionals look pretty good. And then you have XLF, which up 2.56% today, bouncing right off of its 1 month moving average, bouncing off of the former high. Banks look great. And if the banks are doing well and tech's doing well, semiconductors, I mean, where are bears hanging their hat, I suppose, in the short term? And that to me says that vol probably can stick a little bit lower over the next few sessions, maybe into next week.
Yeah, I wouldn't be surprised if volatility was going lower. And that's when we'll see a lot of people trade like the 0 DT options as well. Because the high volatility doesn't matter if you're just trading today's expiration necessarily. And you don't want to keep positions open, for like 30 to 60 days. If there's low volatility, people will do a lot of activity in today's expirations.
That is very true. Hey, Mike, anything else that we want to cover here with Quentin while we have him? We don't want to keep him for too long because we could always use the third wheel here.
No, I think we're good unless he has any final thoughts on Stranger Things. I think we can release him back to
the Stranger Things, unfortunately. Or maybe
the Stranger Things.
Look, as I tell people, like there are ways to end franchises well. There's a reason why people think that Breaking Bad was done very well and Game of Thrones wasn't done very well. And I can imagine that this just killed the rewatchability of the show. So it's more of a Game of Thrones type of ending in terms of how it met expectations, in my view.
Yeah. Well, I guess on that note, good job saving a ton of time doing other things, right?
You saved 10 hours. I just saved you 10 hours, Quentin. You don't need to waste 10 hours watching season 5.
Thank you very much. Thank you.
You're welcome. Mike, what do you say? We take a quick break here and then we spend the last 15 minutes.
We have Ryan.
Oh, is he here?
Yes.
Is he here now? Oh,
look at that.
I didn't even know.
Oh, the old trade-off. Here we go.
Oh, the producers are telling me we have Ryan Grace here in studio. Hey, Ryan.
What's up, Chris? It's nice to see you, Mike. How you guys doing?
Doing well.
Surviving, getting through. They're letting the inmates run the asylum this morning, so thanks for stepping into the danger zone.
Absolutely. It's refreshing. It's not a knock on Bat or Nick, but it's refreshing to see your faces. I've got to join the club here. I've got my glasses in my pocket, so we're
nice.
Yeah.
Please put on the uniform. Thank you.
Yeah. What's going on?
We're watching crypto this morning. 4.7% in Bitcoin here. It's back to its 50-day moving average, getting close to 95K. This has been a line in the sand that I've been watching for the past few weeks. Ryan, I've been actually meaning to ask you this for some time. I can't believe I haven't yet. I couldn't help but notice that Bitcoin peaked 18 months after the last halving in April 2024.
Right. It's fascinating how that works. So now you got those two camps, of course, that the 4-year cycle remains intact. And then I've seen some others that believe that it's going to get kicked out another year due to the U.S. and its debt refinancing. So we'll see who's right here. But for now, I mean, it's been pretty perfect in terms of how that cycle has traded. I want to lean personally. I mean, I'm just a big bag holder at this point, but want to lean towards towards the latter, and that you still have some life left in it. But to your point, Chris, structurally, I think you need to take out 95. You probably need to take out 100,000, the big psychological level. This trend needs to pick up some momentum, or frankly needs to reverse. It's been a bearish trend. A little bit of short-term momentum here. I think ETH has been on a relative basis, been a little bit stronger over the last week or so. If I look at the ETH BTC ratio, has popped a little bit as well. But yeah, I still don't think that you have seen a change or a shift from the market environment that we've been trading in since we got just that big leverage wipeout going back to October. But that said, I do think that the macro is pretty constructive. I think attention has been elsewhere. It's been on AI. It's been on precious metals. Bitcoin, crypto at large has kind of been forgotten. You've seen a lot of the flows reverse that were supporting this up until that blow up. And so that was from the ETFs. That was from these digital asset treasury companies. They're still in the market, but not anywhere near the size that they were. And so I think, there's still some life left in this. But again, you need to take out 3,400 on the upside, in my opinion, in ETH 3435. You need to take out 95, probably again get to 100, and you just need to see a little bit more of a move here before I think you get that belief back in the market, because the path of least resistance, as we like to say, has been lower. You've been able to sell every rally in here, so you need to make me a believer, Bitcoin, and I'm not quite there just yet, but it's definitely feeling and looking a little bit better.
I think this would be, if we do break to a new relative high here, this would be the first rally since mid-September where if you didn't buy the dip afterwards, you wouldn't get hurt.
Yeah.
Right. Because every other time you've tried to buy a dip here in the market, you've rallied back but then hit a new low. And so it's been a little bit difficult. Why didn't we have an Uptober or Upcember or whatever people are saying these days about crypto? I mean, it's 25 degrees here in New York. It certainly feels a little bit like a crypto winter out there.
Well, I think it did.
How come Bitcoin wasn't? Yeah, go ahead.
Yeah, I think it did for a second. And then, the market got really, really bulled up, caught off guard for sure. And then you just saw that leverage wipe out. And I think it's taken a long time to repair balance sheets from market makers. There's been persistent selling in Bitcoin specifically coming out of the Binance exchange. So, there's some speculation that certain market makers are still or were repairing their balance sheets. But look, you had 126,000 all-time high in the first week of October. Everybody thought, of course, that this was going to go to 150, 200, name your favorite price target. It's never coming down again. And then you got the $20 billion in estimated leverage that was wiped out. Now, there's a couple of potential catalysts there. MSCI news, which we'll see how that's resolved, could potentially result in some selling pressure. I don't read into that too much here.
When you say MSCI, is that related to strategy, MicroStrategy?
It is. It's related to an upcoming decision around whether or not any company that holds more than 50% in crypto assets on its balance sheet will be included in indexes. And so if that's a negative outcome, which I think it's hard to argue, at least from the industry perspective, why we really want to see that. But you've had some lobbying on both sides. So we'll see what the ultimate decision is, and I believe that's upcoming this month, and it could be implemented in February if it is something where these companies that have more than 50% in their of their balance sheet in crypto assets are not included. We'll know pretty soon. But you did get that news going back to October, and then you got some tweets, of course. And I just think that the market was just so levered up and so one-sided, and then you just had that massive flush. And, it did a lot of damage, and it's taken some time to repair that damage. Additionally, every single catalyst that you would point to following that event that could be potentially bullish just didn't really pan out that way. We did not get some grand U.S.-China trade deal. We largely got a truce. We did not get the passage of the Clarity Act into the end of 2025. And so there's some catalysts in that sense on a regulatory side of things to look forward to, but nothing that everyone pointed to, even the U.S. government reopening, that's going to be bullish, of course. It just didn't happen. And so you've seen shorts really work in this market. I think you've seen attention elsewhere. I would argue that, the outperformance in gold, in platinum, in silver, that took, a lot of the attention away from crypto. I think you also kind of got into an environment where crypto historically does very well when you're seeing both the rate of change of economic growth, as and inflation inflecting and moving higher. And so we have the growth piece, in my opinion. But when I look at energy prices, when I look at some commodity prices in some cases, and I look at some of the data that's come out, it's hard to argue that there's rip-roaring inflation. If anything, we have a disinflationary environment for the time being, but you do have the growth. I think that's still a positive setup for crypto, but crypto really on the margin benefits from that inflation impulse. And so you don't have that right now, but you do have liquidity that is starting to improve in the market. I think that, the forward outlook there is pretty positive. We're still looking at interest rate cuts on the horizon. And so I don't think that it's a bearish environment for crypto. But again, if you go back to October, you had a blow up and it was very sizable, $20 billion. Definitely didn't bring new money into the space afterwards. And you didn't get any positive price reaction from any of the kind of perceived catalysts. And so this has just been easier to short until the trend changes.
Till the trend changes. 95K here in Bitcoin. It's a nice start to the new trading week, 4.7%. Ethereum, likewise, up a 2.42%. We haven't touched on any of the individual companies, the Coinbases of the world, the Riots of the world. Do you find that as we move into a world of greater access to crypto directly, you don't need to have these proxies, the intermediaries. Do you find that they still may have some trouble ahead? I mean, I'm just taking a look at the Riot chart here, for example, from the start of last year. The share prices were actually up in 2025 despite Bitcoin being down, which if you told me that Bitcoin was not going to rally, I would have thought all of these crypto adjacent companies would have fared a lot worse.
Yeah, I think they're still going to be highly correlated to the price of Bitcoin. But what's interesting to me about some of the miners is the pivot that you're seeing here. And many of these miners that have very cheap access to energy are starting to pivot towards AI, starting to pivot towards more importantly, data centers is probably a better way to think about that, HPC. And so that's interesting to me, and that they're going to potentially, they're not, really not there yet. I think the market still views these, and rightly so, as Bitcoin miners, as crypto proxies in some way. But what I suspect you're going to see is that some of these that have the cheapest access to power, which are things like Iris Energy, or Iris, I-R-E-N. These companies are going to start to diversify their revenue streams away from Bitcoin mining. Now, higher Bitcoin price is obviously going to benefit them. But if you see some of these companies, TeraWulf is another one, WULF is the ticker. If you see some of these start to report that they're making meaningful progress, and they do have a couple of deals with some of the larger hyperscalers, but if you start to see them make meaningful progress in diversifying away from the revenue stream, then you're going to see that correlation over time with Bitcoin and their stock prices break down. But for now, they're still positively correlated to Bitcoin, and you're seeing a big move in all of these companies here today, given what we're seeing in the crypto market. And that's how they've been trading. But I think over time that changes. So I don't know if that answers your question or not, but sure. I will be less surprised to see them up in the future, given this dynamic in the market, but it's taking some time for that to play out.
Mike, let's close the loop here. IVRs on some of these names that Ryan's mentioned, if it's been a Riot or a Coinbase or an IREN or a Wolf here, they're not exactly through the roof. I want to see a little bit more. I want to see my single stock names have a bit of a premium edge, so to speak, above the indexes themselves. When you see a single stock like a Coinbase with an 11.7 IVR versus the underlying Bitcoin at a 25 or even a NASDAQ at a 19, how do you square the circle here? What's the trade for you? Would you rather just trade Bitcoin directly, or do you think that there's opportunity in these proxies, so to speak?
Yeah, I think it's a good call out. I mean, when you look at these specific stocks with, like Wolf is in the teens in IV rank, and IREN is in the mid 30s, but both of them still have pretty high implied volatility from a raw implied volatility standpoint, which makes sense considering you have some pretty crazy moves here. But I think in the long term, if you're thinking that these products are going to trickle higher, I do like covered calls, that kind of thing. Like these are small price points, like Wolf 13, IREN 46. You can sell premium against it. And that kind of negates the IV rank issue, right? Because the IV rank issue and the IV issue is having undefined risk, in a situation where historically you've been offered more premium to take that risk. So one way to offset that is by pairing stock with your short premium risk to offset it completely. So I like that idea, especially if you're looking for a longer term exposure to those products, and you can manipulate those much more easily with rolling calls up and out, things like that. But yeah, definitely interesting. I mean, I've been in the camp of like Mara having a really hard time considering the reward for mining Bitcoin continuously getting halved and the expensive nature of mining. So this is kind of an interesting concept, and the reality is they have to swerve and have a paradigm shift. So if it is going into data centers, I think that makes all the sense in the world.
How much of this is cannibalization, Ryan? I can't help but notice, we raised this on air last week. Bitcoin peaks in October right as silver gold bottom. And basically as gold and silver start making their ascent into the end of the year, crypto struggles. Is this the world that we live in now, where gold and silver are eating digital gold and silver?
I think for the time being, until you see, and it might require a catalyst, maybe it's a regulatory catalyst, but until you see significant new money flow into this space, I think when you're, looking at just how people want to chase returns here, you've got some money that's certainly come out of crypto, and maybe it's gone into precious metals, but they've taken a lot of the attention. I think you had mentioned earlier, as I was listening in, when you guys were talking to Quentin, you were on the Bitcoin or crypto Reddit, and people are talking about silver, right? So I think there's your answer. People are going to chase returns, and so it might be nuclear stocks because they're extremely volatile at times, regardless of whether they make any money. It might be data centers, AI, et cetera. It'll be crypto at certain times. It seems to be right now platinum, gold, and silver. And at some point, maybe it'll be fossil fuels again. We'll see. But I definitely think that it's taken away from some of the performance you maybe otherwise would see. And again, I think in a constructive macro environment, but that doesn't mean that, we're going to stay here in terms of price action for Bitcoin. I do think that you have a positive backdrop here, and we know, at least historically, how quickly this can change, right? It's a $100,000 asset or close to it. It's a 50% realized vol for most of the time. So you got a $150,000 to the upside, 50,000 to the downside, and you can see those gains or those losses within a matter of weeks at times. I'm not saying it's going to go 50,000 in weeks, but you could get a $10,000 move very easily in this.
Ryan, we only have a few minutes left here, but I heard that there's something called a Ryan's expected moves slide.
Oh,
is that something that we're aware of?
We do have a very simple view in terms of how we want to put a little bit of context around volatility and current spot price. So what this is here, Chris, is this just looking at a 1 standard deviation, 1 week estimated move for the 5 currencies crypto assets that we have up there, as well as look at volatility. But yeah, over the next week, and I do want to preface this by saying that volatility has come down quite a bit into the end of the year. Realized vol collapsed in Bitcoin. You can see that 25%. Now, that's going to change, of course. ETH, 44%. We haven't seen these very low levels of realized vol in some time. Implieds reflect that a little bit, though they have bounced off of the lows over the last week or so. But given the current spot price and those low levels of volatility, you're looking for about $5,500 or so move in Bitcoin, under $300 in ETH. Solana, I haven't seen it this low, single digits for the 1 week, 1 standard deviation move. That is using realized vol, so take that into consideration. SUI, another high-performing L1, and then XRP here at 13 cents. But what's interesting to me is that you are, certainly as the prices moved a little bit higher, regardless of where volatility is, we are starting to see, higher highs in terms of that 1 week, 1 standard deviation move, higher lows. So that's a little bit more constructive. I'd want to see that implied move well above 100,000 in Bitcoin before I get too excited. But it's definitely trading a bit better for now.
You know what? That's 3 hours, Mike. That's crazy. Ryan, thank you so much for coming on with us.
Thanks for having me.
Looking forward to seeing what's going on with Bitcoin. If we can get north of 95, we definitely have something to work with. Unfortunately, we are at the end of the show. But before we go, Mike, I think we got to do it one more time. We have a pretty big deal going on. A big deal, as it were. A 4% cash match on qualified deposits up to $10,000, minimum $1,000, in the first 30 days of funding. It's 30 days of commission-free trading. It's from now through March 31st. If you are a high intent trader, if you are not trading with us yet, but you are looking to change platforms, come check this out. This is a competitive offer. Again, I said before, in many cases, as strong, if not stronger than what some of our competitors out there are currently offering. If you are someone who's looking to get in and experience the platform in any way, this may be something to help get you over the hump. So consider it. Go to tastytrade.com/big deal. Again, 4% cash match plus up to $10,000 on qualified deposits in the first 30 days of funding. But you know what, Mike? We did it. Tony was texting me over the weekend. You can't do Monday. You're not me. You and Mike can't hold a candle to me and my son. And we got through it. Take that, Tony. For everyone, thanks for tuning in today. It's been a pleasure taking you to the morning show. I've been Chris Vecchio. He's been Mike Butler. Thanks, Ryan and Quentin, for joining us. Vanetta and all the like producers. Wonderful job. Take a brief break, though. I'll be back in a few hours. Futures Power Hour, Overtime, Last Call, The Right Show. We'll see everyone over the course of the day. You're watching Tasty Live.
What's up, everyone? Welcome back to the show. My name is Mike. I'm here with Chris Vecchio, and it is Confirm and Send. How we doing today, Chris?
Grateful that the Jets season's over.
Yeah.
How are you, Mike? Happy New Year.
That was tough. Happy New Year to you. Yeah, I looked at the box score and it was like Ray Davis has 150 rushing yards. Trubisky has 4 passing touchdowns. And then I was like, oh, it's against the Jets defense. It's fine.
ESPN had this awesome graphic this weekend. It was like, which quarterback is this? And it's like, they're 14-3 this year. They've had 3,800 passing yards. They have 34 touchdowns to 0 interceptions, 109 passer rating. And you're like, who is this? And then it goes, the average QB against the Jets this year.
That is not fun. It's not fun. But guess what? The good thing about football is everything turns around. It's just like the VIX. Once it's low, it's going to pop at some point. So
no, I got to just like kvetch about this one more thing for New York sports. The Giants have gone 8-30 over their last 38 football games played. Okay. 4 of those 8 wins have come in weeks 17 and 18 in the past 3 years. I mean, this team can't even tank properly that at the end of the season, they are losing their top spot in the draft. So what is going on?
Yeah.
They get what's that? Whatever's in the water here gives us great bagels and pizza and leads to the dumbest sports owners.
I feel like I do remember seeing that. Like Vegas was the example this year where they were trying to lose, and they did in fact lose by just pulling all their starters. I think it was, I remember seeing that a couple of years ago. I was like, what are they doing? They're just like shooting themselves in the foot. But here we are. I think
do that right.
I think they'll be okay in time. Just need some time,
That's it. Always time. Time solves all.
Yeah. Not much has changed in these here markets. Do you want to dive into some questions? See if we can get a little spark plug with what we got going on?
Sure. Before we do that, a quick brief look at these markets. S&P up about 0.3%, a little bit more than that now. NASDAQ up about 0.8% here. The Dow, the Russell, those are both back in positive territory, up by 0.11% and 0.27% respectively. The big news over the weekend, of course, what happened with Venezuela and Maduro. Oil is only up about less than 1% here. Natural gas, by far the bigger mover, down over 6%. Gold and silver continue to stay bid. Gold up now 2.26%. Silver up another 6%, surviving another CME margin hike. Over in the world of bonds, a little bit firmer, although gains have been eroding here the last little bit. And now we're back down to 115 in ZB and 112 and 8.5 ticks in ZN. Mike, the big mover pre-market has been ASML. Got a nice little upgrade here pre-market that effectively implies a 30% price target at year end from here. Closed on Friday at we'll say 1163, currently at 1207, up around 3%. One of the top performers, a little bit more than 3% now. One of the top performers here on the other side of the weekend.
Yeah, up decently. I'm actually surprised, to your point, in general, to see the market green today. I thought we would open red for sure, but yeah, we'll see what the open has for us in about 30 minutes or so. But yeah, I'm looking for some upside moves in crude, or at least staying above 57 from a future standpoint. But it is nice to see Bitcoin catching a little bit here for the new year.
Confirm and send today, Mike. We have 4 questions queued up for today's show. You want to get into them?
Let's do it.
John, we can keep going. What do you think about the dogs of the Dow idea and getting long the worst performing Dow components? Mike, do you know what the dogs of the Dow is?
I feel like I've heard this phrase historically. It's not something I latch onto, but I like the idea of it. I mean, we talk about all the time with the Mag 7 stocks. And when you think about like when you consider how can these benchmarks continue higher up and to the right every single year, while you have these single name stocks that eventually have their heyday to the upside and then crash to the downside and never see the light of day again. Well, there's a number of reasons, but first and foremost, if you are buying into stocks at lows in a sector that is benefiting or rallying, like that can be a nice strategy. You can find ways to get bullish when you have the Mag 7 or the dogs of the Dow and you see that they're depressed relative to their counterparts that should have a higher correlation. Same thing with the reverse. Like you could see something rallying abnormally relative to its peers and you could get short that product. But yeah, I think from a bullish standpoint, it's definitely something that I look to do when we're looking to get bullish delta in a bullish market but we're uncomfortable buying at highs, for example. Like right now you can find a handful of Mag 7 stocks or chip stocks that are not at highs where some other highly correlated products are. So I like the idea of it, but the Dow isn't, for me, it's not the place I would go. Like I would rather just go to the tech stocks. What about you?
Yeah, so dogs of the Dow, basically, you're looking at the 10 highest dividend paying stocks in the Dow Jones and you're putting your money in them. And because the idea there is if they underperform in a mature, stable type of index like the Dow, where these are long-standing companies with long histories, strong balance sheets, right? If there's any material weakness there, it's not because of something that's going to formally or fundamentally impede their operations. It's probably something cyclical in nature. And so you buy, right? Last year in 2025, the dogs of the Dow actually outperformed the broader Dow Jones. Dogs of the Dow are up 17.8% in my math here, which was above the Dow 30's 14.5% gain. So is that going to continue into the future, right? Well, the dogs of the Dow, they change because the dividend payouts and the stocks change every year. So you're looking at the dividend yield and the stock performance for 2025 being the guiding factors. Those 10 Dow companies this year would be Verizon, VZ, Chevron, CVX, Merck, MRK, Procter & Gamble, PG, United Health Group, UNH, Amgen, AMGN, Coca-Cola, KO, Home Depot, HD, Nike, NKE, and then Johnson & Johnson, J&J. So there's obviously, these are not fundamentally AI names. They're not part of the major zeitgeist narrative right now that's going on. There's a lot of individual risk. We know UNH had a very difficult year at times last year. Same thing for Nike around the tariffs themselves. But at the end of the session, right, if you're an investor, it's a different calculus than if you were a trader here. Okay, so when I see a question about dogs of the Dow, maybe these are stocks that go on a watch list, and if they have sell-offs and high volatility, they become interesting pickups, knowing that other people adhere to a dividend-building strategy in their portfolio. But I wouldn't just be blindly buying out of the money calls on these 10 names simply because we don't treat them any different than we would any other stock, single stock name, Mike, as far as I'm concerned, even if they fit the dogs of the Dow criteria.
Agreed. And yeah, I think from an investment standpoint, the longer your time horizon, the easier it is to be right about your thesis. So definitely agree there.
We can go to the next question. Should we go to the next question here? Do you have a goal for your returns each year? Mike, I kind of do and kind of don't. I like to beat the market, right? If I'm not beating SPY, then what's the point of actively trading? I should just passively invest, not pay the fees, not worry about the headache, the heartache, the sleepless nights, the checking silver quotes in the middle of a 5:30 a.m. bottle this morning, right? I could avoid all that.
Yeah, that's what I was going to say is just beat the S&P, beat the benchmark, because your alternative is the benchmark. So And it doesn't necessarily mean being profitable every single year. Like some years you're going to have, and we haven't seen it in a while, but some years you're going to have the S&P down 30% or 40. And that's your annual year-to-date return. But if you're only down 10 or 15, like you are still beating the S&P. You're outperforming the buy and hold strategy. So yeah, I think that should be the goal if you're just looking for a blanket statement. Now, if you have different strategies and you're only trading certain sectors, then your goal should be different. But if you're trading a broad number of names with a broad sector diversity, then I think it's likely something like beat the S&P or beat the Nasdaq, something like that.
Yeah, and it's different as a trader versus someone who's investing, so to speak. And I think that's the fine line here. As an investor, I may have a specific goal in mind, right? I have a portfolio worth X dollars. I need to make this many withdrawals over the course of the year. I'm paying for my kid's wedding. I'm paying for my kid's college. I have to get a new car. I'm buying a new home, right? And so I need to outperform the market by 5% in excess of inflation in order to keep my portfolio growing. What kind of assets do I need to own in order to achieve that? But it's not guaranteed. Right? Setting a fixed return goal as a trader, like you're not guaranteed to say, well, I'm going to get 12%. So if I just trade these products, I'm guaranteed to get my 12% return. It's not like that. I mean, beating the market is the goal, of course, right? Being an active trader, the goal is to not be passive. And if you're going to underperform a passive market, there's no point in actively trading. But it really depends on what's happening, I think, broadly speaking. I mean, if it's a bull market, I'm obviously looking for growth. If it's a bear market, I'm thinking capital preservation. The only things that I care about, not a fixed return goal. Am I sizing correctly? Am I avoiding forced trades? Am I staying liquid enough? Am I staying solvent when the market's going through a period of volatility? Am I allowed to keep playing the game the next day? And if I can accomplish all three of those things and make money along the way and stay in the fight, I believe, given how I've performed over time, that I will learn and become a better trader. And so don't set a return goal, in my view. Stay alive. Adhere to a process, tweak the process, grow it over time.
Yeah, I think that's a good call out, especially when you start to look under a microscope and you're like, well, I lost this month or I lost the last 2 weeks. Like it's too short of a time frame, especially when we talk so much about number of occurrences and getting over that hump. But yeah, over time, if you can survive and withstand the storm that is the market, even in calm VIX times, you'll be okay.
John, let's go over to the next question. Mike, retail traders. Ooh, this is a good question. Retail traders. With so many retail traders now trading options and selling premium, do you worry it will negate our edge?
No, not really.
I'm at the same place, but why not?
Well, first of all, you have so many people trading zero-day stuff now, and there's a lot. I think there's a lot more people buying options than selling options in that space. But you can kind of see, there's a give and take of everything. Like there's opportunity, even if people are selling options, but realized volatility stays bid. Like implied volatility has to reflect that. So like IBIT is a good example. Last year sold premium the whole year, and IBIT barely moved. In that situation, even if a lot of people were jumping on board and selling premium, it's not going to compress implied volatility so much to where it's such a low number relative to realized volatility. And I think over time, as you continue to do this, you'll start to get a feel for what feels right and what feels wrong. Like I kept talking about the gold move to the upside. And in that big realized volatility move, gold implied volatility was still at like 20%. So I was like, okay, I'm not selling premium here, regardless of whether I know or don't know who or how many people or how many contracts are being sold. It's more about, does it make sense to take risk in this product with short premium? And I think that's where I hang my hat versus knowing whether a lot of people are involved or not. Like it's more of a matter of how much premium is being offered and am I willing to accept that premium for this risk?
The edge that we're operating by, in my view, is that volatility risk is mispriced relative to the actual realized outcomes that we've seen over time. So more market participants don't eliminate that. In fact, I would make the argument that it could actually reinforce it because retail tends to cluster around similar storylines, similar expirations. I don't want to say it's basic, but when you look at where like retails are trading the S&P, you're more likely to find retails like sitting at a 7,000 strike compared to like a 69.75. Okay. And so there's a crowding effect that occurs as more participation occurs on the retail side. But even then, that participation doesn't lend to the idea that there's any sort of edge being lost, because the edge is that volatility, thanks to our human emotions and our inability to predict the future, is mispriced relative to what actually transpires. And as long as that remains, retail, no retail, that's where we find ourselves at the crossroads of trading an opportunity.
Indeed.
John, let's do the last question here on confirm and send for this Monday morning show. Is there anything different you do at the beginning of the year that you feel helps position you for a more successful year? Mike, the answer for me is just a resounding yes. I go back and I spend time looking through all of my trading activity from the prior year. I want to see what products I traded. I want to see my win ratios in those products. I want to look at the time frames that I held trades, right? What if, it's not because I was really good with gold and silver, but it was any trade that I held for more than 4 weeks was a winner for me? Well, then it's not the problem that I've been trading natural gas. The problem is that I was only trading natural gas for a 2-week cycle and not a 4-week cycle, right? So I want to pull out some of those insights. And before I dive in and start thinking I've got to remake the wheel and reconfigure everything, generally speaking, I will trade a little bit lighter for the first week as liquidity comes back into the market. If I've had strategies that are working, I stick with them. But the start of the year, those final 2 weeks into the first one, it's all about reviewing what I did. That way I can identify what I did wrong. And it's not that I need to get better at doing those things. I could just maybe even stop doing those things. Case in point is when I did this exercise a number of years ago, I couldn't help but notice that my scalping was just hurting me. If I held a trade for less than 4 hours, it was basically a loser all around. My losers were twice the size of my winners. My hit rate was less than 50%. So by cutting out a bad habit, my performance improved. And I was able to use that capital towards strategies and timeframes that were actually working for me within my trading style. So spend the time reviewing your log. It's a worthwhile endeavor.
Yeah, couldn't agree more. I think my answer is relatively the same. I think when it comes to the year-to-date P&L reset, you can take that however you want, but I think it does bring a natural end to what you did last year, and you can review on the transactions tab. That's what I like to do, is just look at the biggest loss from a name perspective, look at the biggest win from a name perspective, and then dig into that name and see, what I did. I'm sure I would have remembered it anyways if it was a big loser or a big winner, but just to be sure. And then, yeah, I don't really change too much, but I am deploying a new year-long trade in the micro E-mini futures. So, and I'm going to basically be doing the same strategy that I did for IBIT, which is sell premium on both sides, but don't accept short delta. So if I get tested on the upside, I'm not under hedging, which is typically what I would have done by just rolling up the put and rolling out the call and keeping the call the same. I'm just shifting the whole thing up for a scratch or a small credit. So that worked really well for IBIT. And it was kind of an aha moment for me because if you're doing something like that, you don't get caught in the big bullish moves to the upside. And if you are sized correctly, you're already going to be better off to the downside relative to the buy and hold strategy. So hitting those two marks, I think, is super important. And like the IBIT thing, I had a 65 straddle at the end of the year and IBIT closed at 50, and I still kept 50% of the premium that I collected. So that's a big testament to IBIT's implied volatility relative to realized, but you can really manipulate the strikes and where your risk is if you kind of just tweak a couple of things that we've talked about over the years. And there's nothing wrong with being perpetually bullish. I mean, yes, it's going to bite you at some point, but that's where sizing correctly comes in. So for me, that is going to be the adjustment for my year-long strategy, the core strategy, and we'll see how it goes.
Sizing correctly is just the most important thing that new traders can get around. I know a lot of people are focused on being right or wrong and like punching that lotto ticket, but if you trade off a slightly, a smaller gain profile and a potential trade for, 1 or 2 more points on probability of profit, and you size correctly, you stay in the game longer, gives you more time to accumulate and to build. And quite frankly, when that big opportunity comes around, right, Mike, you have everything squared up to take advantage of it. So, good confirm and send here to start the new year. 4 questions that I think, Mike, you and I both care a lot about. Quite frankly, I'm thinking a lot about how things that I did wrong or right last year. I got to tell you, my number one mistake, when I got below 21 DTE and I'm like, 5 points off of my ES target, I should just get out of Dodge, take the money and run. Stop being greedy and waiting for those last 5 points, because it bit me in the ass a few too many times this past year.
Yeah, that'll happen. But hey, you live and you learn, as they say.
All right, you know what? We got to take a quick wrap here. We're getting ready for the opening bell here on First Call. We'll be back in about a minute's time. You're watching Tasty Live.
It's option. Jive.
Mike, we are back. We're about 15 minutes into this trading day. U.S. stocks have opened up. They're trading a bit higher. S&P up about 0.6%. NASDAQ 0.8% higher, led higher by those semiconductors. But it's time for another little bit of options jive. We want to talk about strengthening our market awareness here as we kick off this trading year. Mike, this is a topic that I actually find very interesting and important. We've discussed a little bit here at the start of a new year, reflecting on what worked and what didn't work in the previous year.
Mm-hmm.
I think this is a process people should do quarterly, quite frankly, but I understand with the new year, there's new resolutions. So just before we get into this, tell me a little bit about what your process is. Do you do anything different fundamentally when you do your year in review? Has there been anything that you've noticed in one of these reviews to increase your market awareness that like the light bulb went off and said, oh my gosh, how come I was never doing this before?
The only thing that comes to mind wasn't necessarily in the year-end review. I guess maybe it was, but just shifting from like, I love doing earnings trades, but shifting from undefined risk to defined risk. But that kind of came with the market structure change, because when we first started doing earnings trades, you could see heightened implied volatility in the 30-day cycle, the 60-day cycle. Like it was still elevated there, where these days, a lot of that implied volatility is concentrated in the weekly cycle, and the 30-day and the 60-day implied volatility is depressed. So that kind of gave me the light bulb moment of like, why am I selling premium here when I can buy premium in the 30 or 60-day and sell the weekly against it? And that's really what started our diagonal spread, crab trade, calendar spread. Like that's why we do them so much, was because we saw that shift in implied volatility, and recognizing that shift made us move towards those strategies, which kind of hit on all those check boxes while still allowing you to participate, but keeping your risk defined just in case something goes haywire. You know exactly how much you can lose up front. Because historically, a lot of my big losers when I was selling undefined risk, selling strangles for earnings, a lot of those year-end losers were from earnings trades. So I'm like, okay, this has to stop. I'm not doing well on these things. I'm not picking these products very well, but I am consistently engaging in them. So shifting to defined risk there has made a big difference overall.
Yeah, you mentioned the earning trades. I find myself paying a little bit more closer attention to earnings, not because I learned my lesson at the end of last year, right? I typically don't trade around earnings. I'm a macro guy. I take a few stabs. I decide to, trade a little Oracle. What's the worst that could happen? But it was obvious to me, as one of the things that we're going to talk about now, that like very clearly as I've developed over time, I know that I don't have a good sense of market awareness about individual stock names as it pertains to earnings, because I think in a macro worldview. And I think that trying to develop that muscle a little bit more this year is I just want another strategy, another tool in my toolkit so that I can continue to diversify and layer in different assumptions and hopefully have a lot of different things that are working to offset the things that aren't working here. So I do think that we start this year, we go through today's segment here in Options Jives. How do we develop a sense of market awareness? Like what's going on around us as we make our way through the day? How do people like Tom or Tony, or even you and me, Mike, how do we know what's important versus what's not? And that's not because we've sat down and, went to college and got our degrees in finance or economics or, studied for the CFA charter, or it's because we've experienced things and we've learned to figure out what's important and what's not, depending upon the context in which they occur. So John, we can go to the next slide here. As we get into this new year and reflect on what happened in the most recent trading year, we want to figure out ways to improve our strategies and our trading outlook in order to be more successful. Now, one such way that you can do this is through market awareness, right? Market awareness refers to our ability to assess the entire stock market, the options marketplace from a 30,000-foot view, from that top level macro perspective. When you have that market awareness, it at least helps you avoid bad decisions. It's not that you're necessarily going to take trades, Mike, on some of these top line observations you have, but they may keep you away from doing the bad things up front. And for me, the bad thing would be trying to scalp around an earnings report. So, John, we can go to the next slide. Why do we care about strengthening our awareness? There is a prime benefit here of strengthening your market awareness, and it's that it can lead to improvements in 3 specific areas. 1, how we form our assumptions. 2, where we choose to get into the market. And 3, is this something that I've seen before? I just made the joke, Mike, that this triangle in the NASDAQ right now, it's a movie that we've seen play out. Why do I say that? It's because of my market awareness. It's recognizing a particular type of movement in the market. It could be the price action. It could be how volatility is evolving. But you get that spidey sense, that deja vu. Oh, this is not normal. Or when this occurs, I have experienced this before. You have to file those things in your internal library to help build out your understanding of what happens for why and what reasons. John, as we move on to the next slide here, we talk about the process of building out these assumptions. And it's really helpful to have that longer term opinion of a market direction. You and I say we're bulls. We think the market's going up. Why? We can have our X, Y, Z reasons. Maybe they're different from yours. Maybe yours are ABC. But as long as we see those pillars of our rationale remaining in place, how do we approach our strategies? And so for a bull, for example, the market's dipping. We're into our 1 month. This thing is probably a little cooked on the downside. I'm going to buy here. I'm going to buy the dip because the market still is probably going up. So how do we get those assumptions in place? Well, you have to look at interest rates. You have to look at currencies. And as a tasty trader, you're, of course, looking at your volatility curve analysis. Mike, you and I frequently talk about this, and I like to question you and Jamal and Nick whenever I can. What do you think about the shape of the volatility curve? What does this backwardation mean? Why are we in contango? Why is the front month kinked when the rest of the curve is appearing normal? All of those things help inform me for how I want to approach the market. I'm assuming it's the same for you too, because after all, we are both tasty traders.
Yeah, I think the volatility curve is something that everyone should understand. You can make your own watch list. I actually need to make my own watch list for this year. But yeah, that's one of the things where it's like, if you know that historically speaking, the market is not going to crash unless we are in backwardation, or at least hasn't crashed more than 10, 20, those are the times when it's going down 20%, 30%, we are in backwardation, and on the way back up we are in contango. So if you can just take that from a simple sentence, like if we're in backwardation, that's your highly probable or more probable chance of continued volatility to the downside. And for recovery standpoint, we have to move from backwardation to contango. If you understand that those can be true, and they can be true, they have been true, they can be true in the future, then looking at the volatility curve, especially into big sell-offs, can help develop assumptions. So like we talk about this all the time, like we'll see the market down 60 points, we'll look at volatility, we're still in a steep contango. Volatility is not really reacting. And we're just like, well, if volatility is not reacting, why should I react to this? So we might take a bullish stance into those sell-offs, where in the same situation, maybe you get a 100-point sell-off, 150-point sell-off, and we look at volatility and we've gone from contango to a flat curve or maybe a slight backwardation. That's a different environment. And that's like, okay, wow, we actually have moved from contango to being flat, or from contango to being into backwardation. We might have more selling on our hands here. Let's wait and see if we're trying to take, a bullish stance, or if we're trying to lean into the downside. That would be the environment I would want to do it in. So that's an example of market awareness, something we've developed over time. But yeah, the volatility curve, if I were to pick one of these on this list, it would be the volatility curve, because we have it on our watch list. We check it all the time.
Yeah, you mentioned the watch list. That's one thing that we can do here on the platform. And I think fundamentally, that's one thing every trader should do. You can go over to the platform. We have a bunch of preset watch lists here. But if you're trying to develop your market sense, I personally like looking at futures more than the ETFs, for example. What happens overnight in the S&P 500, it still counts. Same thing in the bond market, same thing in gold or oil. So instead of waiting for like a GLD or a TLT or a USO to open, which is perfectly fine if you're only a cash equity trader, but for me, it's looking at things like ES and GC and ZN and ZB, which is why on the platform, we can go to the next slide there, Mr. John. You'll find that we have this, and one more slide thereafter. In fact, on the left-hand side of the platform, you're going to see that there is an ability to tailor out your watch list. Just one more slide. There we go. Okay. So you can choose a watch list. You've seen me tinker with this on the platform. I like to keep the futures CME tab open, but you can also go into things like the high options volume. What's moving today? What's happening there? Is the volatility going up or down? Is there news, right? This is also how you can develop the sense. Hold on a second. I notice all these names in the high options volume list, Mike. These are all semiconductor names. What is that telling me about where the market's attention is today? Or what if it's all random and the indexes are flat, right? That's also informative unto itself. So just being aware of the different sectoral relationships, the asset relationships, you don't even need to trade them to start off. Today is a really good example of this. If you weren't with any skin in the game coming out of this weekend, right? You weren't trading oil, you weren't trading gold, you didn't have any stocks or bonds on. What about today surprises you or doesn't surprise you? Right? How come we're not seeing a bigger move in oil? Why is most of the action in the metals? How come stocks are floating to the upside? Is this challenging your assumptions? So test your awareness in real time with what you think would have occurred provided an event happened, and see if you're right. And if you're right, then maybe you should start building a strategy around it. And if you're not, maybe assess your worldview and your understanding of how the markets operate.
Yep. Couldn't agree more. And I think from a watch list standpoint, I really like to just look at, from a day-to-day standpoint, if I'm trying to see what the market is focusing on, I just look at stuff over 1%. So like right now, I can tell you, just looking at the futures watch list, there's only a handful of products that are up over 1%. And there's only one product that's down more than 1%, and that's natural gas. So that eliminates like half the list right there. If you're just looking for a quick and easy way to see what's going on in the market, I like to do that, is to look at what's up or down over 1%. Everything else in the middle is kind of just that expected chop, and there's not much to glean from that. You're muted, Chris.
Thank you. We can go to the next slide here. John, as we get ready to wrap this up, what's the point of all this? Market awareness is generally trying to improve our ability to have good awareness. If it's on the future side, the ETF side, we want to have the fear awareness, the VIX products. It could be VIX 1D. It could be VIX itself. It could be /VX futures, right? Maybe even it's VVIX. You want to be aware of the participation going on. Are trading volumes higher or lower than they've been over the past week, the past month? Are volumes higher today because of an earnings report, an economic data release like a CPI non-farm payrolls? Wait, today was a CPI report day and volumes are lower than they have been over the past month? That means something. These are things that really can be improved upon, right? Your market awareness can be improved upon through just spending time in the market. You, of course, can read research and bootstrap that episodic knowledge by ultimately going and living through other people's lived experiences. And that's one of the things that I think, Mike, you and I have both done, and a lot of successful traders have done over time. You read the books about Jesse Livermore or the hedge fund wizards, for example, the Jack Schwager books, and you could see what's worked and not worked, and you begin to test your own ideas out over time. So if I'm a new trader, I want to absorb as much information as possible. And that's to say, I want to learn from other people how they develop their market awareness. And then I want to figure out how to do it on my own. So you can only improve upon these things by actually sitting and staring at the charts and looking at the tape and creating hypotheses and writing them down and seeing if the market plays out the way that you thought it would. But having a good idea of events and the changes in volatilities and the liquidity, it's important to have a deep understanding of the underlyings of the industries we're trying to trade. And I know it seems trite, but ultimately having an idea of what's happening in the products that you're operating in, it's not the worst idea in the world, Mr. Butler.
Yeah, and I think, it's a necessity of sorts. Like, even if you're not trading these products that are moving, like I have a position on in silver, but I don't have a position on in gold right now. But like, I know the story is silver, gold, platinum. So my eyes are locked on there. And if I see something that I like and I want to take a stab at it, like I will step in then. But it's good to know, like, why are the end of last year, why are the equities not moving? Well, it may be because everyone that's trading is just focused on these precious metals, and that's it. But and you're seeing that continue today. But yeah, I think at the end of the day, like, you could see silver prices rallying and be like, ooh, maybe this isn't so good for the tech stocks or the chip stocks. Like, you can take an assumption however you want. But I think the market awareness piece and just having a pulse on what's going on in the market will help you develop the assumption, and at the very least, ensure that you're not just shooting in the dark and, placing these assumptions, whether they're bullish or bearish, without having a holistic view of what's going on in the market.
We can go to the last slide here, John. Developing market awareness is easier said than done, right? It's a skill that has to be developed over time. Quite frankly, I think it's a skill that's constantly a work in progress, because economic regimes, financial regimes, the relationships between assets, they change over time, right? We've seen this with bonds and stocks over the past few years. We've seen this with gold and stocks over the past year, where gold kind of became more of a risk asset than anything else. And so it's never a finished process. There are broad overarching frameworks that I abide by. But in terms of, well, if X is happening, then Y should occur. Maybe that's true today. It may not be true tomorrow. It can be mastered and strengthened through practice. It's honing. It's doing your reps. It's going to the gym. If you stop paying attention to the market today and disappear for 3 months, who knows where we'll be? So it is a recursive, constantly updating, constantly trying to improve. I just think it's an important skill to have, Mike, and it gives us a better chance of success in 2026 if we're focusing on what motivates the things that we are trading, and quite frankly, what to ignore, how to figure out, separate the wheat from the chaff, ignore the noise and focus on the signal. Market awareness is incredibly important, and I think it's a skill that all of us can work on, even if we think we're really good at it still.
Indeed.
That's it for Options Jive, and we're at 10 Eastern, 9 Central right now, that's a good time for a quick little break. Hey, on the other side of this, we have more great programming coming down the pipeline. You know what? Let's just take the break. Get a cup of coffee. Come back. You're watching Tasty Live. Mike, we are back. Hope everyone's having a good start to their trading week, trading month, trading year. You're watching Tasty Live. This is First Call. I'm Chris Vecchio. He's Mike Butler. The Batman will be back tomorrow. Have no fear. This is not a regular occurrence, but you will have to deal with us for the next 20 minutes or so as we talk about the Santa Claus rally. Mike, where is the Santa Claus rally? Is this it today? Are we finally getting the Santa Claus rally?
It may be. It might be the extended Santa Claus rally. You know what's funny about the Santa Claus rally? I watched a Santa Claus movie with Kurt Russell, and can't say I'll ever watch it again. Christmas Chronicles. Have you seen this?
No, I got subjected to a movie called Christmas Again on the Disney Channel, which is basically Groundhog's Day for kids.
Got it.
But this
Same
little girl's
concept.
a brat. But this little girl's a brat who's having like the best Christmas ever and doing everything she wants to do every single day, and like it never gets boring for her. So there's
Great
no lesson
message.
learned. No lesson learned.
Yeah. Then your kids turn to you and you're like, why am I not doing this every day?
Yeah, great. Like, this isn't first call, by the way, Mike. What show are we on?
This is market measures.
This is market measures.
I heard you say it, but I just wanted to let you roll with it. See where we went with it.
Maybe you should take this one then.
Well, I missed the first hour of the day, so maybe not. Maybe not. Weekly 0-day breakdown, trading into the Santa rally. Let's dive in, people. All right, SPX and the VIX. VIX 1 day. So we literally just talked about this, how volatility can be a nice guiding light, at least for near-term movements. But during the Christmas week, Santa rally pushed the market to new highs, while implied volatility declined. Heading into the new year, intraday trading ranges widened, accompanied by elevated trading volume during the final trading days of 2025. And yeah, the story wasn't necessarily the S&P. Again, it was the precious metals, which is a first for me. Normally it's the S&P and the NASDAQ just ripping higher, trying to create the narrative. Like I was shocked that we didn't get to 7,000 SPX, but hey, there's always next year, or I guess this year. There's always this year.
We're waiting until next year for 7K, Mike. I've got
I think we'll get there in a couple weeks. At this rate, couple weeks. Let's pop over to the next slide. Take a look at the VIX levels during the holidays. So the VIX reached its lowest level on Christmas Eve, spooky, closing at 1347. The median VIX during the holiday period was 14.5, well below both the 2025 median of 17.2 and the long-term median of 16.7. And I like for this one, so this is a good example of another shred of market awareness. So it's not always the market ripping higher, resulting in the VIX getting depressed. Sometimes it's the market not moving and the VIX getting depressed. So sometimes you'll see markets selling off, VIX is elevated, and then not necessarily the market rebounding in a big way. It could just be the market cooling off and having a narrow intraday trading range, which results in the VIX being compressed. So the volatility, or the VIX, is the volatility forecast of the S&P 500. And if the S&P 500 is not moving, even if it's moving a slight bit to the downside or a slight bit to the upside, you can and should expect to see the VIX compress a little bit. So that was, for me, really the story of the end of the year. Do you have anything to add to this? Or are you on board with that?
I mean, I'm on board with it. Again, the fact that Santa Claus rally really hasn't played out, even though vol declines at the end of the year and it's below both the 2025 and longer term medians, I would think that the S&P should be at 7,000 or 7,100. Maybe I have some interest over there, Mike.
Maybe. Well, you definitely do now because you were filled on the show. So
yes. Oh, that's true. I got to put that on the follow page.
There you go. Let's pop over to the next slide. Look at iron condor performance. We kind of talked about this a couple minutes ago about low VIX, S&P not really moving, but iron condor performance, low realized volatility during the holiday period, which was really just super narrow trading ranges, not much going on at all, created an ideal environment for premium selling in this example. So managed positions at 25% max profit resulted in a 100% success rate since mid-December. And yeah, I think when you take this into account and you look at how narrow these trading ranges were, you were consistently getting paid to take that risk. And this is a good example of implied volatility likely overstating realized volatility, because the markets still have to price in some kind of volatility. You can't just price in the fact that we're going to have, a 50-point trading range or a 40-point trading range, or even more narrow than that. So it was a good end of the year. And specifically for the S&P, the attention was elsewhere. The S&P really wasn't moving too much. So created a nice environment for the daily iron condor for 25% profit. How about 50% profit on the next slide here? 50%, looking at the profit target, greedier profit taking at 50%, increased risk without improving returns. Interesting. Longer durations and higher afternoon volatility led to 2 losses and materially reduced overall performance. And yeah, this, when you think about this and you think about how these trades are deployed, with iron condors, when you place them, to get 50%, you're going to have to hold them more than likely into the early afternoon, late afternoon session, where if you're just trying to get 25%, that could come out in the first hour of trading, hour and a half trading. Like it could be as simple as that. So in this case, it's, risk on, risk off, trying to take a tiny chunk out of it. And in the case of lower implied volatility, when you have a narrow trading range, you can't absorb as much volatility against you. So I think in this situation, taking them at 25% really got you out of the trade a lot sooner versus the 50% target where you were likely waiting longer, probably from like 9 a.m. to noon, I would assume, if we were to look at the timestamps on these. Yeah, here you go. The minutes from entry, you can see you have to hold these way longer than on the previous slide where you were out on all of them by 11 a.m. So these ones, you're holding them into the afternoon, and a lot of them turn into losses because of it.
It's a great environment for scalpers, Mike. This seems to be like a holiday playbook more than something that would necessarily be great during normal conditions. But again, if vol's staying low and we don't have catalysts, that earnings calendar this week is really dry. There's nothing there until Friday for non-farm payrolls.
Yeah, and I think you could see a situation where we are kind of just in this lull period until the banks report, because the banks, to your point, you called them out earlier, they're ripping higher, and it could set the stage for a strong earnings report quarter, but they don't report until January 14th, 15th. So we still have about 10 days until that happens.
Banks make money when they get paid back, Mike. That's all I'm going to say to that.
Hey, we'll see. We'll see. Maybe they'll drum something up for us. Maybe they'll surprise us. Probably not, though, because they're banks. All right, next slide, please. Exceptional performance during the holiday. This holiday period, 0-day performance significantly outperformed long-term results when profits were taken earlier and trade duration was reduced. So again, taking profits at 25%, really the story was the duration. You can see it here. 2 hours in the time in the trade, an hour since 12:15, 50% reduction in the time in the trade. So, and I think when you look at the way the markets moved or didn't move, in this example, taking the small shots when volatility is super low, I think this is a good takeaway for this market measures here is if we have the VIX in the low teens, maybe you reduce your profit target to 25% instead of 50 because you know you're dealing with more narrow trading ranges and you want to be out sooner than later because of that. And historically, with the Santa Claus rally, of course, we didn't really get one this year. So the neutral iron condors worked well in this period of time. And it did work well with the lower implied volatility and the lower profit target, to be sure.
The Santa Claus rally window officially, today's the last day, so it's the first two of the new year. That puts us through to we started this window on the end of the 23rd. That was 69.61 in the S&P 500. We have moved 17 points, Mike, over that window here. So being directionally neutral around it was ultimately the right thing to do.
Yeah, for sure.
So far.
Next slide, please. Side testing analysis. So recent price action differed from long-term behavior. Instead of frequent call side testing, SPX more consistently challenged the downside, with the downside strike tested approximately 3 times longer than the call side over the past 3 weeks. This downside heavy price behavior increased the risk of bullish strategies. And yeah, I mean, while this is true, we're not being tested with 200-point moves to the downside. We're being tested with very small moves, and I think it's more of a reaction of the low implied volatility in general and the lack of interest in pushing this thing to the moon. Santa Claus was smoking cigs outside, akin to Bad Santa, not giving us. I see your reaction here, but I mean, it's true. We didn't get the rally, and I'm kind of upset. Now that I think about it, I'm kind of upset we didn't get it.
There's probably some deep childhood trauma buried somewhere in there, Mike.
Potentially. We won't bring that up on this show.
No, that's market. That's not for market measures. No.
Yeah, maybe for the opening bell at some other time. Next slide, please. 30 delta, 30 wide put spread performance. So keeping this in mind, traders who positioned bullish for the Santa Claus rally using a 30 delta, 30 point wide put spread managed at a 25% profit target with a 500% stop loss were still profitable, but with significantly lower returns compared to iron condor strategies. So yeah, I think when you look at the minutes from entry, of course, these are going to be longer term relative to the quicker profit targets, likely because you're collecting more, you're waiting for more, you're more directional. But yeah, nice to see that you were still profitable, even with the more tests to the downside here in this 2025 year-end market. Last but not least, worst case day review. 12:15 and 12:17 saw large one-sided moves, leaving only brief early morning profit opportunities. This underscores the importance of mechanical execution and quick profit taking in low volatility markets, where volatility expansion can quickly increase risk. And yeah, even if you're not in the money or tested necessarily, if you see an implied volatility spike just for a little bit, you can see marked losses or extrinsic value losses until that premium is zapped back out of the market. So again, I think the easy takeaway from this is when you have super narrow trading ranges, maybe your 0-day profit target of 50%, you chop that down to 25. All things considered, you want to be out sooner than later. And in high volatility environments or implied volatility environments, because you have a much wider trading range that you can absorb, maybe that's when you're looking for that 50% profit target. And I think I can't emphasize it enough. It's because you have so much more space for that market to move. Although the market is projected to move more, it's easier to hold through that sort of period of time versus when you have, a 20 or 30 point range with a 0-day iron condor, where you're really just looking for that small kind of scalp feel.
Yeah, and I think the takeaway there, though, you staying mechanical is what defines the success here.
Mm-hmm.
And the second that you start saying, well, I've made 25%, let me kick this out to 50, and it falls apart, don't be surprised. It's a totally different risk profile. You need to hold the trade for longer. You need to take on more risk. But fascinating. Low volume, low volatility. You get a little bit of a sideways chop out of the gate. You can take your trade, you can move on and go back the next day and stay mechanical during that type of environment, but in that specific type of environment.
Indeed. Well, should we take a little quick break? We got some special guests that are going to join us in just a little bit here, but yeah, we'll be back in about 90 seconds. You're listening to Tasty Live.
Finding where markets meet politics, if you will, is kind of a passion of mine. We're changing cycles right now. We're moving into a different political complexion down in Washington, D.C. We're moving into the end of a potential Fed rate hike cycle. And as you change these economic and political regimes, asset prices behave in different manners. So I do think what's worked over the past, say, 1 or 2 years may not work so well in the future. I have like a kind of a core satellite portfolio mix where I keep some assets for multiple months, even quarters, years at a time. But then I augment that with some options trading in order to help provide a little bit more convexity to my portfolio. Risk management is the most important thing. You can't control where the market's going to go on a day-to-day basis, right? No one individual investor has that capability. But what you can control is where you get in the market, where you get out of the market, how big your position size is, and learning that the market is not always going to move in your direction. You have to appreciate the fact that you will make mistakes, but the idea is that you make enough of these trades with a consistent enough edge that over time, as you stockpile some results, then ultimately you are profitable over the long haul.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
What sparked my interest in trading was the probabilistic nature of it. I used to play poker a lot, still do, and if you understand the math for poker, you realize that it's a probability game, it's a number of occurrences game, and you want to put yourself in good spots the majority of the time and have good risk management. All of these things apply to options trading and trading in general, so that was my initial pull into the trading world. My trading style really revolves around implied volatility analysis. I like to look at specific markets, look at the differences in implied volatility between the weekly cycles and the monthly cycles, see if there's certain strategies that might play into that more than others. My favorite strategy of all time is a short put, simply because it allows you to acquire 100 shares of stock at a lower cost basis. And it's a position you can manage or push forward in time forever if your trade size is small enough.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IB rank, and more tools. Tasty Trade. Download today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade. It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
What's up, Tasty Nation? Welcome back to the show. This is Options Trading Concepts Live. My name is Mike. I'm here with Jamal.
Hello.
And of course, the one and only Ryan Grace from the Tasty Crypto team. Crypto's up. Everything's up.
We're feeling better. Yeah, it's a nice start to the year, I suppose, when
year.
you look around, catching a bid in most things, it would appear.
Yeah.
How you guys doing?
I'm doing good. I feel happy that we're playing the Packers first playoff game.
Yes, yeah.
And actually, it works out nicely because now the Philly is going to play San Francisco. So that's one juggernaut gone. And if we can get past the Packers, we'll see what happens. How do you feel about your Bills?
Pretty good. Yeah. Yeah, I mean, as a Bills fan, I'm always somewhat skeptical for any game, regardless of who you're playing. But they're going down to Jacksonville. Should be fun. You know, Josh Allen is going to do his thing. If he does that, then I'm pretty confident.
I mean, all those games look pretty good. I mean, you guys are going to Jacksonville. Obviously, they've been catching fire over the last couple of weeks. So that's going to be a daunting task. I mean, anytime we face the Packers, it's going to be a game. I know they've looked terrible the last couple of weeks, but you know they're somehow going to muster together and try to fight, just like we saw last night. Both of those teams put it together. Crazy game last night. I'm sure I don't know if a lot of people saw it, but wow, what a game. We were just talking about it. Wild stuff. And Aaron Rodgers lives on. This dude's in the playoffs one more time.
It's nuts.
Who knew? Coaches already getting fired. I feel like 3 coaches already got fired in less than 24 hours.
Yeah.
Atlanta, Cleveland. By the way, did you see the press conference yesterday when Bengals lost the game?
No.
They were mad that what's his name? You know, what's his name got the sack record. And so the coach was like, "We're playing for our lives here." Like, dude, you're already out of the playoffs. What are you talking about?
Yeah.
You're mad because they stopped the game to celebrate a record?
Yeah, Myles Garrett. Yeah. That was sick.
Crazy stuff, man.
Yeah.
But I do have to add, because I don't know who it was. I'm not going to point any fingers, okay? I was booed. Yeah, last week I was booed somehow about my Miami Hurricanes. And guess what happened?
Smash.
That's right. Keep booing. I want the boos to keep coming. Miami Hurricanes, baby. Miami Hurricanes. That's right.
They look good.
Yeah, they did. So did Indiana. Holy cow.
Yeah.
Indiana. If I woke you up, if I talked to you 5 years ago and said Indiana's going to be the best team in the nation,
right,
you'd have laughed me out the building. Yet here we are.
Yeah, last couple of years they've turned it around quite a bit.
Something else, man. It's something else, man.
But yeah, I looked at your Bills box score and I was like, Mitch Trubisky is throwing 4 touchdowns. I was like, I know this guy.
I think he's the best backup quarterback in the NFL.
He's one of them, like legit.
I mean, he
clearly is. Yeah.
You know, I mean, granted they're playing the Jets. Jets haven't had the best season, but Mitch can turn it on.
Season. First team since 1930 to not have an interception in a game in one game all season. Sorry, I digress. Go on.
But Mitch can turn it on at times.
Yeah, I think Mitch and Bajent would be my top 2 backups.
Yeah. Yep. Yeah.
I wonder if they get like calls from like teams this offseason. Although both of them, I think they're paying both of them decently.
Yeah. Bajent just got a nice contract, right?
Yeah,
he's legit.
Yeah, we're on the watch to see how many more coaches get fired. This is that kind of Monday. What do they call? I forget what they always call this. There's something that they always call this Monday where they fire coaches.
Oh, for NFL?
Yeah, I forget what they call it. I mean, basically Black Monday, I guess, is what they call it. But it's that type of day.
Who knows?
Tough league, man.
But yeah, it'll be fun. We got a extended time off till Saturday. First playoff game. It's going to be glorious. Can't wait. But yeah, E-minis, NASDAQ, Dow, Russell, Bitcoin, ETH, all up pretty decently here. E-minis up 60, NASDAQ up 270, Bitcoin catching a nice bid up 4K, and ETH up just a skosh. But still, the story of the end of 2025 and into 2026 is this move in silver. I mean, silver, platinum, gold catching a bid too, but these things.
Copper's almost at back to those highs, actually.
It's crazy.
That one's interesting.
That is wild too.
Yeah.
So yeah, these metals are flying around. It's wild to see, but at least today we're getting a macro move in the other sectors as well. To end the year, it was really just the precious metals, but nice to see Bitcoin catching a bid. Curious to hear Ryan's thoughts in just a second here. But yeah, I mean, I haven't traded anything just yet today, but keeping my eyes peeled. We do have the earnings quarter kicking off in about 10 days. The banks are kick off the bulk of earnings. That'll be January 14th, 15th, right around there.
They're ripping today too.
Yeah, the banks are ripping today too. So it's like wherever you look, most things are up and away, which when you look at a VIX of 14 and a VIX one day of sub 7, pretty disgusting. But yeah, up and to the right until things change, feels like.
The cool thing, and I just had to say this to get it on record, the cool thing about right now and today is the first day of the trading, well, second day of the trading year, but it's essentially the first day. We have no idea what's going to happen. We have no idea if we're going to get a VIX of 50 this year. We have no idea where things are going to be. I find that kind of fascinating, just to live in that moment for a second. Like, we have no idea where things are going to go this year.
Yeah.
We have no idea what the macro events are going to be. We have no idea what will happen around rates and bonds. We have no clue.
Yeah. But there's going to be something. There'll be something that pops the VIX. There'll be some kind of catalyst. It's just a matter of what.
Always is.
I thought I saw something that was looking at volatility on a monthly basis, and January tends to be, I believe, a more volatile month. Correct me if I'm wrong. I think on average, when you look at what months are more or less volatile, January does tend to have some volatility. So, we will get some opportunities, but for now, it's been kind of a one-way, very investable, buy the dip market. I think, when you look at the S&P versus the Russell and the NASDAQ, I think on a relative basis, you're seeing some outperformance, at least here in the short term, in the S&P. But you did, prior to that, have a ton of concentration, a handful of names, big tech, AI, et cetera. So I think it's definitely healthy that you're seeing a little bit of a broadening of that rally into the end of the year and to start this year.
Yeah, for sure. Some of these names turning around. You had MU significantly higher to start the day. AMD, similar story. Nvidia, same story here. So very interesting to see a little downside move there while we continue to rip higher in the E-minis NASDAQ from a broader perspective. But yeah, we can kick over to the slides real quick, talk about Bitcoin, the landscape of crypto, see what's going on there. Before we do though, are there anything on your mind for 2026? To Jamal's point, it's a brand new year. Things are going to happen. Things are going to change. What are you looking for in the crypto space from a 30,000 foot view, like to change the narrative and get a nice little rally here?
Yeah, I mean, in the crypto space specifically, I think you can point to potential regulatory catalysts. So we have the Clarity Act, which I think on the 15th will go to committee or discussion. I don't know exactly how this all works on the political side of things, guys, but pass the House with the Senate. Seems that, this is going to move forward. And so I think, once you get those regulatory catalysts, it can likely bring in people or institutions that have possibly been on the sideline. More and more participation is what we're seeing. And I think that, this is going to catalyze further adoption. That's what you want to look for at that kind of macro view, right? If we're going to see this market expand, you ultimately need to see much bigger players enter the market. So when you look at crypto, it's about $3 trillion market cap, maybe a little bit above that here today with the bounce. But how do you get to 5 trillion? How do you get to 10 trillion over time in terms of market cap? Well, obviously you need much bigger pools of capital and participants to come in, aside from, where it started, which was retail. Retail had an opportunity in this space to front run that larger flow. And we're starting to see some of those bigger flows, certainly with the launch of the ETFs and the digital asset treasury companies, what we saw into 2025. But I think, you look for that to continue when you get more regulatory clarity. That could benefit DeFi. So those are a couple things that I'm paying attention to. But I also think that the macro environment really matters here. And so as long as we're in a pro-growth, disinflationary or inflationary, really, inflationary would be better for crypto assets, but as long as you have pro-growth, you have a little bit of a weaker dollar, you have at the same time, short-term interest rates coming down, all positive on the margin for crypto. So I've looked for that to continue. That's what I'm paying attention to. I'd look for more adoption, but I think again, that's on the back or on the heels of regulatory clarity. You saw what happened in terms of stablecoin adoption. I would expect that to continue as well, but that was on the back of regulatory clarity there. And so those will be positive catalysts, in my opinion, for crypto going forward. And I think you also have to look for some surprises, right? We had around the election or shortly thereafter, the inauguration, you had these executive orders to really establish the United States as this kind of dominant player. It really is already, but real dominant force in crypto. And so you could see further developments on that front in terms of, you know, a Bitcoin stockpile for the United States, a strategic reserve, if you will. I would just look for potential, you know, catalysts there as well.
Yeah, makes a lot of sense. And yeah, I think when it comes down to the crypto space and where we can see some upside moves, I mean, like you said, an inflationary environment brings more narrative to Bitcoin. But at the same time, if the rest of the market is ripping higher, Bitcoin has been historically positively correlated to the NASDAQ E-minis as well. So love to see it. But yeah, why don't we pop over the slides? We can get a little more granular, look at some expected moves and whatnot. What do you have for us today?
Yeah, so to start the year off, we're feeling a bit better, right? We've got some green on the screen finally after what was a pretty difficult period. And I would argue, you know, maybe some tax loss harvesting given the underperformance of crypto assets versus precious metals versus tech versus just anywhere else, you know, that you could have been long. Bitcoin really underperformed, at least into the end of the year. The fourth quarter typically is pretty good for crypto, at least it has been historically, not in 2025. All-time high in the first week of October, and then the rest is history, has been trading lower since then. But to start the year, we're catching a bit of a bounce here. Volatility just collapsed, realized and implied, but more so realized volatility collapsed post the Christmas holiday. And you're still seeing that in the market, but you are getting, you know, a little bit of a bounce off of that 90,000, 85,000 level that we've traded into a couple of times here. So we're seeing price momentum now as we measure this by the exponential moving average crossovers that we use. And I think at times you have this on the chart as well, Mike. But you are seeing some short-term positive price momentum, which is step one. What I want to see until, you know, for me to become a believer again, I suppose, is I want to see that also move into the weekly time frame. And that's still been bearish. There are some levels I think you have to take out before I'm really excited about jumping back into this and trying to chase prices in a sense. And that's my 95, 94 maybe in Bitcoin. It's probably about 34, 3,500 in ETH, you know, well above like 160 in Solana. And so you're not there just yet, but you've definitely, you know, you're seeing more constructive price action. You're seeing sentiment improve. Fear and greed index went from, you know, some of the lowest levels we've seen since the FTX collapse to back around 40 right now as measured by the CoinMarketCap fear and greed index. So sentiment is improving. You're seeing flows kind of pick back up a little bit. You're seeing positive price action for now. But again, look at the 3-month trend, still pretty bearish. I want to see that change before I'm a believer again. So that's kind of what we're looking at, you know, high level. The one thing I will call out, a couple things to call out here. If you're looking for spots, Bitcoin Cash, that's been as bullish as it can get throughout all of this. The trend has not changed. We're back up to 650. If you want to look for bigger price targets, you could see this 800 plus. Doge, memes, just catching a bid to start the year. You see this with Pepe, seeing this with Bonk on Solana, seeing this with Doge. Doge up 21%. That's the underperformer when we look at, you know, some of those meme coins, that we'll track. Realized volatility has come in a little bit, but you are seeing a little bit of a broadening of this price action as well. It's not just Bitcoin over everything, which we'll talk about in just a second, but a couple assets to call out on here in addition to Bitcoin ETH. XRP having a nice move to start the week back up above $2, but Bitcoin Cash, Doge also on the radar. If we jump to the next slide, just taking a look at, we haven't for some time because it's just been as bearish as it can get. But looking at some of the smaller cap stuff, just to try to find any pockets of outperformance or potential opportunities, you're seeing, again, that broadening of the price action that I mentioned. So not out of the woods by any means, terrible 3-month trend in there for all of these, but, you know, catching a little bit of a bid in SUI, which is one that we track. Cardano, ADA, which people like, is up 12%. Year to date, you only have 5 days here, but you're seeing some outperformance as well versus Bitcoin. Implied vol and realized vol has come in everywhere. And you are still seeing, again, that bearish trend on the weekly and monthly basis for a lot of the smaller cap stuff here. So if you jump to the next slide, you'll see pretty much the same picture. We've got, again, a little bit of a bounce in some of these things, but the bearish price momentum over the kind of intermediate, longer-term timeframes remains. Pepe, though, every once in a while you catch it. We've talked about this where some of this stuff is just so blown up. It will have some massive rally, probably sell out of it. I don't know if you look at this to kind of recover everything, but hard to ignore a 65% pop on a 1 week basis there, which came over the last couple of days. So there is some volatility in some of the smaller cap stuff. It does feel a little bit better to start the year. That said, again, the takeaway here for me is I'm not really stepping in and trying to buy dips just yet until we achieve some higher prices and we hold on to those, because up until this point, every rally into 94, 95, if we got there, has been pretty quickly sold off. And if you go back to the end of last year, you'll remember there was this pattern where overnight you'd kind of levitate higher in the crypto markets. And then as soon as you got to the US equity open, everything just got slammed lower. Not seeing that today, but that was a pattern that was in play. And, I really want to see, again, these higher prices taken out, and you want to see that trend change. I don't think you're seeing it just yet today. We need a couple more days of this price action.
Yeah, for sure. And a couple more days of this is back to 100K.
Yeah, and that's the big psychological level that probably gets people interested again. Okay, maybe it's not dead. Maybe the cycle isn't over. And that's been the narrative for the last couple of months.
It's interesting you mentioned that, like the open, what would happen prior to the open, and then how during the hours it would get sold up. I've heard of different, or maybe just one ETF that might be on the way for people to be able to trade.
I've heard of that too, yeah.
Yeah. It's a thing. I mean, it's a thing that happens quite a bit, especially in some things that trade, especially something like that trades 24 hours. But, I know there's obviously differences in the gold price and the way that GLD will move overnight, things like that. So it's kind of fascinating.
I think at times we've seen this in equities as well. I remember a study, it was probably a few years back, where the S&P, had you just bought futures when they reopened at 5 o'clock Central Time, held them overnight, and then sold them on the cash open, you outperformed significantly versus, the opposite. And so, for whatever reason, those patterns do emerge. I wouldn't expect it to persist into perpetuity, though.
Yeah,
obviously.
Right. Works until it doesn't.
Exactly. So taking a look at our expected moves here on the next slide, as I mentioned, realized volatility absolutely collapsed in here, as you might expect, given the slow holiday period into the end of December, beginning of the year. As this is a look back on the prior 30 days, I don't think that we stay at these levels. I would imagine that you do start to see some bigger swings, and hopefully for us as we're long, hopefully to the upside in Bitcoin and ETH. Implied has come in a little bit, but it is definitely off of the lows. So you're getting a bounce in implied volatility, though it's still at kind of relatively low levels when we look at that IV rank for a 3-month, 6-month, and 1-year period. For our expected moves, you're looking at underneath a $6,000 move in Bitcoin, 268 in ETH, Solana single digits, and that's just going off of the realized fall, so I wouldn't read into that too much. But the move in there has been about $10, $11. Solana has not done very much. It's been pretty quiet in there, but ETH and Bitcoin starting to pick up a little bit. I think what is constructive here is that when you look at the spot price and volatility, and you get your 1 week, 1 standard deviation move, the higher high that's being priced in and where that is in terms of where if you did get there, you do have a better trend, in my opinion. You flip back to bullish for both of these in Bitcoin and ETH on the short-term time frame. And so that's encouraging, seeing a higher low as well in that expected move. But again, it's not it's not static. It's going to be dynamic, obviously, as those prices change. So those are the expected moves for the week, but I will again caveat that with pretty low levels of volatility right now. So as that vol picks up and spot prices possibly move higher, you're going to get much bigger moves. Wouldn't be out of the question to start to see that at 6,500, 7,000 on the Bitcoin move. Jumping to the next slide, a couple things to point out here. And this is in relation to what we talked about, where you're seeing kind of pockets of performance outside of Bitcoin and ETH. Bitcoin market cap dominance slipping a little bit, but the momentum in there has been pretty bearish, which if you're long a bunch of alts, you want to see, some large upside moves in other areas of the market. This is what you want to eventually see, is a continuation of this breakdown in Bitcoin dominance, which is Bitcoin's market cap versus total market cap of investable digital assets. ETH BTC also trading a little bit better here. It's pulled back from the highs over the last couple of days, but we'll keep an eye on that. If we see that price momentum flip to bullish on a weekly time frame, then I'm probably going to really lean heavily into ETH as I look to deploy new capital versus Bitcoin, but we'll look for that signal. Solana versus Bitcoin short term, Solana has bounced a little bit here and is outperforming on a 1 week basis versus Bitcoin and versus ETH. But the trend in there has still been pretty bearish. And so I'm more focused on ETH over Bitcoin, more focused on Bitcoin ETH versus Solana, at least for now. Doge got that pop. We'll see if it holds or not, but Doge versus Bitcoin up 13% on the last week. But again, keep an eye on Bitcoin market cap dominance. If you break below 59, get into 58 and change there, maybe the move is on. You could easily see 3,500 in ETH.
Yeah, it's moving, that's for sure. But ETH catching a little bid relative to Bitcoin, but good call out with the Bitcoin dominance. It seems that we are, obviously flat from a 1 week perspective, but I think you start to see more flow into that, especially if we get a continuation of this rally. Wouldn't be surprising.
Yeah, and those would be the early signs that you'd look for. And if you get them, and this starts to move pretty quickly, I would hang on to these, because we could be in a world where you get crazy prices that are really hard to fathom when you're in this environment, but we know how quickly that could shift. And to Jamal's point earlier, new year, anything could happen. Wouldn't be surprised if, we got much higher prices, even though the view right now really has been cycles over, 4-year post-halving cycle is in, the top is in, maybe this rises, we'll see. But I wouldn't be surprised, I'll tell you that. One last slide here, looking at cross-asset correlations, still positively correlated to equities in this environment. Maybe no surprise there, I suppose, given the backdrop that we have from a economic perspective. Still positively correlated. Not much of a dollar correlation here over a 1 month, 3 month basis. Recently, this has flipped, slight positive correlation with the dollar over the last couple of weeks. I wouldn't read into that too much. I think dollar weakness structurally is a tailwind here. Lower rates structurally is a tailwind. You're seeing a steepening of the yield curve as well, which is going to reflect a view of growth, economic growth. And so I think those are all positive signs, but a little bit of a positive correlation with the dollar here short term. And no real correlation with gold. Hasn't been for some time. Gold's been just on its own planet, ripping higher with the rest of precious metals, maybe taking some of the attention away from crypto, but no real correlation there. And no real correlation with the long end of the yield curve if we look at, or at least the price of bonds, I should say. If we look at TLT, 20-plus year Treasury, ETF, tracks price, and you're not seeing much of a correlation there. Still an inverse correlation with volatility, as we might expect, given the positive correlation with equities. So those are cross-asset correlations. I did, if you go 2 more slides down, though, I did just very quickly run the same stuff here for the S&P, the NASDAQ, and the Russell ETFs, as well as gold. Didn't get a chance before the show to put other assets on here, but we can look at this as well going forward if you want to. But again, I think this reflects, the view that I've mentioned, where you have a positive economic environment. Growth seems to be holding up. And disinflation, that's probably good for the consumer. You see that with oil prices coming down lower here. And that's been the trend for some time. But when I look at price momentum in there, SPY on a relative basis has been a little bit more bullish than the NASDAQ and the Russell on the daily, but structurally, like, this is a bull market. No surprise to anybody. And gold as well. Ignore the 82% volatility on gold. Apologies, that's an error. But everything looks pretty constructive in my opinion.
Yeah, and I think this speaks to, how can Bitcoin get to a significantly higher price? Well, if the E-minis are up 10, 15, 20% this year, NASDAQ the same, Bitcoin is, a finite product at the end of the day. Like it is scarce. So that can all add to it. And that's where you can really get that asymmetry to the upside. And looking at the correlations previously, like if we do get those moves in SPY and the Qs, there's a strong positive correlation there historically. So, and yeah, to your point with tax loss harvesting, I think there's a number of things that can play into that year-end kind of sell-off. But given the move today, if we see a couple more days of this, like we're right back to where we were, middle of the range from the highs to the lows.
What I would want to see as well when I look at Bitcoin, I look at ETH, is I want to see, and really, I guess for the rest of these assets, but when I look at implied vols for Bitcoin and ETH, and realized, but more so implied, I want to see that positive correlation between price and volatility. And you want to layer in volume there too, right? We want to see a significant amount of volume on the up days. You want conviction behind some of these moves. On the flip side, if we're looking at, a 5-10% move in Bitcoin and there's no volume there, I would be skeptical, honestly. But if you see volume picking up, you see volatility picking up, and you see price all moving in the same direction, I'm going to be a bit more confident in that move, especially if we retake that trend and we get back to 100,000. People are going to start to talk about, could you take a run at new all-time highs? It's 126, 125 area or so. If you bought it at 85, you probably want to sell some if you do get there. But I think that's how quickly the narrative can shift. But those would be the signals, again, that I would look for.
Yeah, for sure. And you're starting to see that just a little bit as we start the new year. IBIT right now, 40 million shares traded today. That's more than SPY and the Qs in isolation. But you are seeing a slight implied volatility increase, up 2% in IBIT, up 1%, 3% in ETH. So seeing exactly what you're saying, just a slight increase in implied volatility into this move today. And I think you'll see that grow even more if we continue on a little tear here, especially if it decouples from the E-minis and NASDAQ. If we see Bitcoin and ETH continue the rally while the E-minis and NASDAQ kind of flutter around, I think that could really bring a lot more attention, a lot more volume as well.
Yep.
Beautiful. Love it. We're streaming live on the YouTube channel. If you want to stream us, if you want to find us there, we're streaming live. Just go to Tasty Live. We've got the big deal pinned to the top of the YouTube chat. 4% cash match up to 10K and 30 days commission-free trading. So scan that QR code or just go to tastytrade.com/big deal. I've got it pinned to the top of the YouTube chat for more info on that. But yeah, thank you, Ryan. Lots of good nuggets there. Are you trading? So we actually talked about maybe a little paradigm shift in some of the miners going into more data center centric activities, which is really interesting to me, especially when you consider some of the low price points on those products. What do you see, if anything, going through the next couple months or into 2026 with that?
Yeah, I think right now there's still a very strong positive correlation between those miners and Bitcoin. Or ETH, the same positive correlation that you're going to see with all crypto-related equities and the underlying asset there. And so I think that continues. But what I would look for is there a point in time where, that correlation doesn't have to go negative by any means, but that very strong positive correlation starts to break down a little bit. A handful of these, and that's the model for a lot of them, is how can they start to try to diversify away from crypto mining revenue? Well, that's still a major component of the revenue for those companies. How are they diversifying away from that? Because they have infrastructure that they've built that has to be powered, in a variety of different ways, and there's certain prices associated with that. But that infrastructure, prior to this, primarily used to mine Bitcoin. Same infrastructure, in many cases, can be used for high-powered compute, for AI. So you're starting to see a little bit of a shift from, these companies being viewed. And I don't think the market's really reading it this way just yet, but I think it will at some point. And it's not going to be every single Bitcoin miner, but those that have, been successful in executing a strategy to shift revenue away from primarily being crypto mining services and related revenue to HPC and to AI data centers. When the market starts to sniff that out, you'll see those winners. And I think that a lot of what it comes down to is who has the cheapest access to energy. TeraWulf is interesting to me. IREN. You're seeing some bigger deals with some of these previously crypto miners, maybe still crypto miners, but CoreWeave, is another name. They're extremely volatile, don't get me wrong, and they're still highly correlated to the price of Bitcoin. But that's something else that I would be looking for, and I think could play out into, middle of 2026, into the back half of the year, assuming that, we still see a lot of bullish sentiment around AI, which I do think continues. I think what you saw into the end of last year was just a correction. I don't think the AI bubble has popped. I think CapEx continues here. It will be met with some skepticism, but I don't think it's over. And so that's what I would look for. And again, handful of those, IREN, IREN, Wolf, those are a couple that I own. And the way that I have exposure to those, shouldn't say I own them, not in all cases. I have some shares, but also just short puts into pullbacks because there is a lot of volatility. And regardless of the IB rank at the time, you're looking at things that have a realized vol on a 30-day basis of like 100+%. So I think there's, opportunities there. And then on the flip side, you do take assignment of those short puts. You can sell calls pretty quickly against them. So there's some fun, I suppose, you could have in there. But those would be areas that I'd look at. And I think that if we do see higher prices in crypto assets, then you're definitely going to see the likes of Circle and Coinbase, Circle especially, which has had a significant pullback, post IPO highs. I think those do well, and I would look for more companies to come to market this year. I think Kraken has filed to go public. There's probably some others that you'll see, and so that's something I'd keep an eye on.
Yeah, absolutely. It's definitely an interesting shift, and to your point with IREN and Wolf, like these are different price points. $47, very affordable. Wolf, $13, super affordable. And yeah, this is 100% implied volatility. You're getting paid a lot to take that risk. You could wheel into this thing. And IREN, like this is big premium here. Like you're getting from the 40 strike, you're getting almost 10% cost basis reduction on the intrinsic value risk. And you could turn around and sell a call above, like 10, 15 points above for another 10%. So yes, still not for the faint of heart, but cost basis reduction is there.
And I think to be balanced here, you've got to call out some of the risks with some of these companies, and the real risk to a lot of these, and you can, see on the chart here, how much they ripped as there were these big announcements being made around investments into some of this infrastructure by larger companies such as Microsoft. The risk here is just how much debt these companies have. And in order to service their debt up to this point, they've had to dilute shareholders in a variety of different ways. And so that's something to just be aware of. Now, it doesn't mean that it's an overly negative thing, but that's the risk, is that they can't service the debt. The AI trade doesn't pan out. They don't have the contracts in order to generate the revenue. But I'm not sure I want to bet against AI at this stage. Maybe. I don't think you've fully seen the extent of it, in my opinion. But that said, that is the risk, and you do get these headlines around dilution. They do carry a lot of debt. And so you do have a dynamic where, it's not today, but there is a massive amount of downside risk here, and that's why they're priced at 100+ volatility.
Yeah, and in both of these cases, 100% implied volatility in IREN, 100% implied volatility in Wolf, yet IREN only a 35 IV rank and Wolf only a 15 IV rank. So this tells you that even though we're sitting at 100% IV, this was much higher.
It was, yeah. And these are stocks where, you look at the price, you went from $60 to close to $200 in, I'm sorry, I'm looking at the wrong stock here. But they've tripled, they've quadrupled if you go back to probably the September time frame.
Yeah.
Heck yeah, this thing has moved around a whole lot. I remember this one.
But yeah, definitely interesting. And that was always my question too. Like Mara, I always call it Mara as the example, but like I always had a hard time believing this would like sustain above 20 because it's like at the end of the day, if you're just mining, eventually the mining ends. The mining is so expensive, and if Bitcoin's price, like the coin that you're mining gets so depleted, like at what point are you going to run into some big issues? But if you shift away from that and utilize your mining centers for something else, that's one way to do it.
Yeah, that's how I would think about sorting through all of these. But then again, at the same time, looking at this chart here, this is a extremely volatile Bitcoin proxy, and it's going to go up. I don't even want to use the technical term, but it's going to go up a lot if you see much higher Bitcoin prices. You can see where the all-time high in there was right before the collapse in the price of Bitcoin and other crypto assets. And so, there could be an opportunity at these levels, certainly if you get a sustained bounce. I do think still that they are crypto proxies, but look for a handful of these names to potentially diversify away from that and for the market to start to price them accordingly.
Love it. Checking out the YouTube chat now. Let us know if you have any crypto-related questions for us. But yeah, some people saying this is the year of the sub 13 VIX grind up. Very possible. I mean, when you look at interest rates alone, what do we got here for the year? If we go to December. So we're currently at 350, 375. There's a 60% probability we arrive at 50 or 75 basis point cut from here. So around 3.325 or 2.7530. And historically, when you cut the ability to make money from a risk-free rate perspective, that can be a catalyst for higher equity prices as people are investing and getting into other things to try and make up for that. So yeah, I mean, that could be just that. If we don't see some craziness with some 50, 60, 70 VIX pops here and there.
Yeah, it could be that kind of quiet year. I mean, I'm bracing myself for, I guess, I'm bracing myself for a year where we don't have like 20 to 30% gains. If I'm wrong, that would be great. I get more interesting market, but I'm bracing myself for a year where we just don't have these huge outsized gains in the market.
Yeah. And they'll come eventually.
Yeah, for sure.
Always does.
Yeah, it has.
It's hard. That's the thing. It's just like hard to imagine. We're like sitting near highs. What is going to bring us much higher? What is going to bring us much lower? It's like right now, we just don't know, For the year-long strangle, what are your rolling mechanics? What are your deltas? I'm not really focused too much on the deltas. It's really more just about the general idea. So we did this in IBIT last year. It was a great trade. I didn't close it. So this is a nice rally on this one, but IBIT closed at like 50 and I ended with the 60-65 inversion with $3,000 in credit. So I made like $1,500 on one contract. And I never had upside risk. Anytime I was testing the upside, I just shifted it higher. And I only had to do that a couple times. And then IBIT, of course, came down significantly from the recent highs. But that's going to be the same strategy with the micro E-mini futures strategy, is just selling a strangle, rolling into the next month. And if and when I'm tested to the downside, I'll roll out and down to reduce intrinsic value risk. But if I'm tested to the upside, I'm just going to shift the whole thing up so that I shift my upside risk to downside risk. Because that's the environment. That's where I want to be if we're going to stay in the VIX of teens and the market kind of just drifting higher. Like, this is kind of crazy. We're up 50 points. It's not even 1%, 0.7%.
Yeah.
That's just that's how expensive these markets have gotten. But yeah, that's the strategy. If crypto became a currency used for daily transactions, which coin is likely to be that beneficiary? Maybe Solana because of instant confirmations, or maybe is it stable coin?
That's how I would think about it. I wouldn't think about it in terms of which cryptocurrency on any particular blockchain network as an asset is used for transactions, but more so on which networks. And I think that matters less over time, given that you have these high performance L1s. You have Solana, of course, but you have L2s, scaling solutions for Ethereum. It's only improving in terms of the technology, lower costs, higher speeds, increased throughput, et cetera. So I wouldn't think about it as, okay, people are going to pay with Bitcoin. Sure, you can use Bitcoin to transfer value on a permissionless, decentralized blockchain network globally. You can use ETH, you can use anything else, and then it becomes this kind of sort of money. But I really don't think that in terms of how this has evolved, that's the use case anymore. You can also do this with digital gold, or, prior to any of this, people had bank accounts where you had a debit card associated with, or I shouldn't say bank account, but you have a debit card associated with a gold balance, or you have, a debit card associated with your brokerage account. So there's that component to it. But I really think it's stablecoins. And that's clearly what we're seeing in terms of the growth of stablecoin market cap, the adoption and the launch of stablecoins by financial institutions. This is just a quicker, faster way to move dollars. So the asset is US dollars on a blockchain network. And I think that, that technical component, the thought of it being a blockchain network is abstracted away, and we forget about that. Just like today, when you go and you use your credit card or you use, a digital payment or anything else, you're not thinking about it's on the internet. I think that's where we get to. And so the network itself probably doesn't matter as much. There's probably a degree of interoperability. I think a lot of that activity probably occurs on Ethereum, but I don't think it's people are going to be going to the store and buying something with Solana. Sure, but it's probably going to be stablecoins more than anything in terms of what makes up that transaction volume.
Yeah, I agree with you there. And I think we've talked about this before, but the move away from traditional bank transfers, ACATs, ACH, it all takes too long. It's one day. It's literally one day. If you withdraw and deposit, you'll get the funds, or you'll see the funds the next day, most likely. But if you're looking for instant transactions, stablecoin is the way you're going to be able to do that. And on tastytrade, you can withdraw and deposit with stablecoin now. I've done it a number of times. Something will hit the wire on the weekend, and I'm like, ooh, I want to add more to my account, and I want it available for Sunday futures trading. That's how you get around the 2-3 day holding period for traditional transfers with banks. You use stablecoin, and it's very easy. I have it on my PayPal. I use PayPal. I forget the denomination. I think it's just PayPal USD.
Yep.
And I was just using that to go back and forth, and it's instant. They don't charge you anything to convert cash into the PayPal coin, so it's.
And I think you're going to see more banks launch stablecoin services. I think this is going to become commonplace. And again, probably not going to think about it. What was novel, previously, we don't really think about it anymore. Mm-hmm. It was somewhat novel to take your phone out and tap it against the card reader at the 7-Eleven. Not anymore. You do it with your watch, whatever. And so I just think that's how we kind of evolve over time. And you see that as well. I think permeate other parts of the financial system beyond just payments. I think you're going to see, the increased kind of tokenization of securities and settlement, and things are just going to be faster and maybe more efficient and lower cost as a result.
Yeah, for sure. And that's ultimately the end goal is instant transfers in and out and seeing that capital immediately. And stablecoin can definitely be how you get there. Let's see. Stablecoins will replace all transfers in financial soon. In a roundabout way, you can already use CRO to pay for everything now. That's their entire business model with credit cards. Yeah, I wouldn't be surprised to see a full digital transformation. And I mean, that's just the way of the world, right? Everything is going more digital, more digital. We're not going the opposite way. That's for sure.
No.
All right, we're at the bottom of the YouTube chat here. We've got a handful of products moving today. E-mini still up 50, NASDAQ up 230, Bitcoin staying bid, catching a little bit more wind behind the sails, up 4,100 now. We've talked about MicroStrategy. We're talking about that in terms of the inability to stay afloat here with this big sell-off. Where do you see a company like this going into the future, especially if we get a Bitcoin rally? Like, do you think this actually will start to catch a bid?
Yeah, absolutely. If there's more to this move, and let's say you just retake 100,000 again, this will trade accordingly. It's a high volatility crypto proxy. You need to see that premium to the assets reemerge. There has to be a reason to own this. Until then, it's going to be more volatile to the downside. But I don't believe there's a world, obviously, in which the price of Bitcoin goes much higher and MicroStrategy doesn't follow, because MicroStrategy is just Bitcoin. It's a wrapper in that sense, with a lot of financial engineering in terms of what they've done with their balance sheet and the other shares that they've issued and some of the associated dividends. I'm not in the camp that there's some death spiral unwind here, but if the question is just simply, does MicroStrategy benefit from any crypto rally? Absolutely. And
I'm still long MicroStrategies. Is it weird that they didn't touch all-time highs when Bitcoin was touching all-time highs?
Yeah, to some extent. I don't know, what the reason for that was, but yeah, I do think that's weird. But it tends to kind of, lead in some cases as well. So peaked earlier. Maybe that's just coincidental. Mm-hmm. But yeah, I do think it's odd that you didn't at that time see, a much larger move in MicroStrategy. But I think that could have also been to just the number of announcements around share dilution and just some of the skepticism that it was met with at one point prior to that. But yeah, I do think, the correlation remains.
Sure, for sure. Yeah, trying to see what else is moving here. We can take a look at some crypto futures, some crypto products here. Let's see what's moving to the downside today. Oh, Bitcoin Cash, very rare. Bitcoin Cash is really interesting though, because it has completely defied the recent sell-off that we saw in Bitcoin. It's sitting near highs, especially when you look more long-term. You can see we're sitting close to the highs in 2024. But yeah, it's been a very strong rally, especially from the lows in early 2025 to now. Do you think this is in line with the whole stablecoin narrative and just having capital in a different place other than like the actual asset world of crypto?
I honestly don't know. It's been an outlier. I can't explain, why has Bitcoin Cash been a place to hide out versus everything else. I know there was like a protocol upgrade at one point, but no, I wish I had a better story for you guys. I haven't been that close to Bitcoin Cash aside from when we look at the momentum indicators and just tracking the month over month price action. I don't know why Bitcoin Cash keeps going
It's like
up.
that sometimes.
Yeah.
Sometimes that's the answer. I don't know.
Yeah.
It is. Yeah.
But I think this is an interesting sign. Like when we look at crypto in general, the biggest movers to the upside, and of course you'll likely see this regardless, but you're seeing the fun stuff come out a little bit here. Shiba Inu, just like all these ones that have been left for dead.
Yeah.
Finally coming through for some activity here. And we talked about this too, like when Bitcoin was ripping higher, all this stuff was moving a lot more. And these were the first to go down before, the whole Bitcoin sell-off that we saw at the end of the year. So
yeah, and this has been, I think, the cycle and the story historically where these things are just extremely volatile. Either they're worth 100x or they're worth 0. And the stuff that's kind of had this like survivorship bias sort of thing, eventually stops going down and then people notice. And, I don't think it's sustained, but you get this rip. You get a 60% move in Pepe. And maybe it goes up 100, 200, 300%. I have no idea. But, what we do know is obviously it stops going down at a certain point. Sentiment can only get so negative. You bottom. And then once that's occurred, any catalyst can kind of move it higher. Maybe it's just the price of Bitcoin and money starts to flow into some of this other stuff that then just looks really cheap. But I wouldn't look for that to be, fundamental in nature or something that's sustained necessarily. It's just one of those things where you probably want to own a little bit of this, as we've talked about, in terms of a volatility kind of component in your portfolio. Have a little sprinkle in this stuff because eventually you get some massive pop.
Yeah.
You know, it's the same. It's like anything else, right? Eventually, one of these teams that doesn't win any games catches a win, and so if you just bet on that every once in a while, you might win. But you look at the chart, right? I mean, it's pretty trashy, as I like to say, and so you know, eventually you get a bounce, but does it last? I don't think so. At least not right now.
Fair enough. Were you talking about the Jets just now?
I mean, it felt like
maybe. Yeah. Anything. You know, it was just like whatever bet you want to place. I think of this more in terms of bets. You're going to get a win once in a while.
Yeah. Every once in a while.
Every once in a while.
Couple minutes left here. Yeah, kind of a nice day to start the year, at least the second trading day, but the first Monday, we'll say, of the trading 2026 year. But yeah, Bitcoin up 4,200, steaming along. Good to see. Near the high of the session here. And I would imagine we eclipse the volume that we did, at least in the Bitcoin futures on the 2nd. We're almost already there, and it's noon. Got plenty of time left here. So nice volume behind that move, and hopefully it sustains. But we had this big liquidation here in mid-November, just a big red bars, and we're about to be above the recent trading range there. So maybe, just maybe, we see a nice rally back above 100K. And to Ryan's point earlier, I think that is definitely the psychological effect. I think if and when we get back above 100K, you're going to start to see headlines about it, blah, blah, blah. And that can only be a bullish thing in my mind. But we'll see.
For sure. Speaking of volume is low on the SPOOs, only about 700K from what I saw earlier. So even though this is the first real, I would say, trading day of the year, volume's still a little bit low. I mean, we do got some stuff down the pipeline this week, I guess. I guess there's a jobs number. I don't know if that even means anything anymore, but it's coming. It's on the way. So, you know, that's one thing I guess to look forward to, see if we'll get some volume by the end of the week. If not, like you said, we really kick off those earnings within 10 days time, I think.
Yeah, 14th, 15th is when the banks will report, and then basically the next week after that, that's when you'll get your Mag 7 and a lot of other companies reporting. So we shall see. But yeah, to your point, Jamal, volatility is okay for the end of the week, but you're definitely seeing a little jump here from Thursday going into Friday, and that reflects the jobs number we're getting. We're getting unemployment this Friday, 7:30 Central, jobs 7:30 Central on Thursday. So, yeah, could see some volatility at the end of the week, but really 63 points for the end of this week is nothing too crazy. But, I mean, the VIX is at 14, market's ripping higher. This is kind of what we should expect with low volatility.
Mm-hmm.
But that's it for us. Thanks for tuning in. If you got any further questions, you can find us all on the Twitters. I'm at Trader Mikey B. Jamal's at Jamal Chandler. Ryan's at Ryan Fred Grace. And give Tasty Crypto a follow as well. I've got the big deal pinned to the top of the YouTube chat, tastytrade.com/big deal. You can check that out. And I'll also put the Tasty Crypto newsletter in there. Totally free. Sent out every Saturday, updated Wednesday. Get your market update and the thoughts from the Tasty Crypto team as well. But yeah, stay tuned. We got plenty more content coming your way on the YouTube channel as well as tastylive.com. We'll be back same time, same place, 11 a.m. Central tomorrow. We'll see you then. Peace.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the bored. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Trading is hard enough. Here's what liquidity is. You want to be like water. Liquidity is in reference to how easily you can get in and out of a position, from volume to open interest to actual price at which you can buy or sell your position. It's important for all traders, from stock traders to futures traders to options traders or even crypto. Tight bid-ask spreads and high volume are characteristics of good liquidity.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
What is going on, everybody? Happy New Year and welcome back to Risk and Reward. We had a lot change over the weekend. A little bit of vol coming in the market today, but I shouldn't even really say vol. We just got some higher highs going on. We're going to talk a little oil, talk a little energy. That's of course the energy sector, not Drake's 2015 hit single. I'm joined today, as always, by my wonderful co-host Errol. Errol, how are we feeling?
Doing pretty well. Hope everybody else is doing well. Happy New Year. Happy New Year, brother. It's another week. It's a new year. We got a little bit of volatile, I guess, sentiment over the weekend. We got more news coming out over the weekend, so all eyes on oil. What a way to start off the year, though. I guess we'll get into all of it, but we got some headlines for sure.
For sure. I also have to issue an apology on Wednesday. Yeah, on Wednesday, the last time we were on air, I very confidently said we would be back on Friday, knowing full well that we would not be back on Friday.
What a guy, though.
Hand up.
What a guy. What a guy.
Hand up, it's on me. I realized this was like one of those things where I was laying in bed like Saturday night, and I was like, oh, no.
I was like, I know this was on your mind all week.
Yeah, it's been wearing on me. So, yeah, I gotta open take accountability for that one. But, yeah, we got things moving. Pretty much every American oil company jumping a little bit. All the way from Exxon to Schlumberger, everything. Everything.
The whole 9 yards.
Yes.
Speaking of 9 yards, football games this weekend. What's the update? How was it? What's the rundown?
Electric week 18 in the NFL. Okay. Playoff positions are figured out. Right. The Broncos secured the number 1 seed.
There we go. That was pretty clutch. Appreciate that.
First round bye is gigantic in the playoffs. So
especially we got by off a few games by the hairs of our chin. So we're going to need that first round bye.
Yeah, they just keep finding a way to win.
I don't know how.
They don't beat a lot of teams as badly as they should, but they just keep on finding a way to win. Exciting there. Number 1 seed in the NFC secured by the Seahawks in an electric game on Saturday night. So yeah, it should be an exciting playoff season here for the NFL. My sleeper is the Texans. That defense is pretty elite, even though the offense is kind of anemic. I think the Texans could make some noise.
Hey, I always take the defensive case. You know?
Friday
Always
was
about the
ruined.
defense.
Thanks, Gus. Sorry, man. I know you're being sarcastic. I hope you're being sarcastic. If not, I genuinely am. Sorry. But yeah. What? I just did something. Happy New Year, Jared. Good to see you.
Happy New Year, guys. Happy New Year.
But yeah, anything you got anything top of mind you want to jump in, look at first?
No, nothing top of mind, but we can go ahead and jump into the Tasty platform, kind of see what we got going on this Monday, the first full week of the trading year this year. So got a little bit of Netflix into the new year, sitting through that Warner Bros. Deal a little bit. It'll be interesting to hear still how that entire situation kind of digests, but really not much going on over there.
Suing now.
Is that what the case is?
That's the new thing. Yes.
Or what? What's the angle there?
They're saying that their deal is so much better that there must be collusion, and that Warner Brothers CEO is good friends with Netflix's CEO. That's
I
That's
haven't
the
looked
thing.
into the
So
details of that. But
they're tossing around that idea.
Okay, that's an interesting angle. I mean, they came in thinking about what 30 billion over. I think they had offered over Warner Bros. Deal, or I'm sorry, over
it's
Netflix's deal.
considerably more. I mean, it's basically like 25% more per share, and then also all cash instead of some being Netflix stock. So,
that's an interesting. It sounds like they're kind of taking a. It sounds like this is an onside kick right now. This is what it sounds like. I think they kind of knew it was going to get blocked, and they're like, let's try to throw out the collusion case if they don't accept our deal.
Yes,
I don't know.
Paramount is upset
every try
by the situation.
Yeah. What's going on, Stefan? What's going on, Mike? What's going on, guys? Jared, Happy New Year. Happy New Year. Just taking a little bit of a look at Netflix right now. Our position's not moving too much on that end. SPY. Again, still happy to have this position on. It's been a volatile one, especially holding this into the new year over the last couple days. But having on some long delta has served me right over the last 30 days. So again, shout out to you guys letting me get on some long delta. It's needed for the portfolio sometimes. And then a little bit in the NASDAQ micros we'll take a look at here in a little bit. But I want to take a look at some of the oil names too. Maybe USO. Some of those options are typically, pretty liquid if we want to get involved there. And then obviously the oil futures, but maybe USO to start. Take a quick look.
Yeah, I mean it's USO, it's XOM, it's SLB. I mean you name it, everything moving today. I would assume COP is also up, though I haven't checked.
Yeah,
it is. I would assume BP is also up, though I haven't checked. It is. So yeah, we got movers. I know Exxon was the big thesis because people were saying that Exxon is the only oil name that does not have Venezuelan exposure, which should make it a little better in this time of turmoil. But to be transparent, I think we're going to get that freaking oil. So I don't know. I think this might just work out beneficially for U.S. oil companies in aggregate.
There we go. It's looking like Exxon has experienced most of the volatility so far. I mean, USO, I would say so at the same time. Premium is not too attractive on USO. Maybe XOM. Do you have a preferred vehicle for the oil that you typically like to dabble in? Mine was USO, but I'm not liking the premium that much on USO, but we'll keep looking.
Yeah,
XO1 is there.
I feel like XOM is probably the best way to attack it, even though obviously it's a specific name and not the broader oil market, but it's just got good volume. It's got good float. The like ConocoPhillips and BPs of the world are just a little bit lower float, can make it harder to
was that BP?
Find liquidity. Yeah, just BP.
BP, gotcha.
But yeah, these cheaper underlyings, more gaps. It can be a little more challenging.
I gotcha. I'm really not finding the oil futures too attractive. I don't know. I've never been a headline oils kind of trade. I remember the last time really getting involved with oil was when oil was going negative a barrel. That was like what, maybe 5 or 6 years ago now.
With oil as well.
Yeah. So I mean, from there, I've pretty much just been using the contracts. But we'll take a look at the futures in a little bit. But take another look at USO. Again, not opposed to getting on some type of delta in the oil.
Yeah, Jared echoing my sentiment on XOM.
The best liquidity. Yeah, let's take a look over there. Let's go XOM, guys. January 30th, we got some earnings. Let's go to February 20th. What's that looking like? What are you guys doing in oil? What are you doing over there in oil, Jared?
Yeah, I have no involvement here. If anything, I'm looking for angles where I think that things might be overextended because I just don't know. I mean, obviously we're reacting to price and future information here, but there's still a lot of unknowns about what's going to happen as it pertains to the specifics of the oil and the Venezuela situation. So, if there was anywhere that gets overextended, I would be willing to get contrarian, but I'm not really trying to get long into these moves. I don't think.
Yeah, no, that's valid. That's valid. I'm not feeling a strong tug of conviction to either side of the market, either on oil, to be completely honest. But we'll keep it on the radar. Take a quick look at VIX, a little tour to market before we switch gears over here. VIX getting crushed into the new year a little bit. I'm 1480 on VIX. I mean, look, guys, it depends how you look at it. It's a half glass full, right? It's half glass, half full. No. I mean, VIX is fairly low considering what we've seen into the last year and the last few years. But I mean, relative to what we've seen this year, we're only into the third day of the trading year. So this could be large or small movement in VIX, depending on what we get for the rest of the year. So let's not complain too much until we see how the market digests some of these things. Iron Condor and XOM.
Yeah, Iron Condor could be a good vehicle for sure.
Yeah, we could take a look at something like that, XOM. Let's see what the premium is looking like. Let's not get too directionally biased, and then maybe depending on how wide we can get on these wings, we can pull some of them in, get a little bit more directional if we want to. But let's see how much premium we can get. I mean, it's not looking too hot based off of the expected move that I'm seeing just visually right here down the middle. But let's quickly see, because we might be scrounging that Iron Condor for pennies on these contracts at least.
COP has greatest exposure to VENS, having already won a $10 billion verdict for having its VENS assets. Oh, Venezuela. I thought this was a ticker. I was like...
VENS, like the Benz.
Yeah, I was doing some gyrations in my head trying to think of what ticker that is or what like index we're referring to, just shortening Venezuela. Okay, well that's a good note. ConocoPhillips has won a $10 billion verdict for having its Venezuela assets expropriated. Always a tough word for me. That was
expropriated.
Hence the hesitation. I know the word. I could define it, but that's one of those ones. You know, everybody's got words they can't spell. Drop your words you can't spell in the chat, everybody.
Hold on. I got one. It'll come. There's one of those ones. One of those ones that you learn in first grade.
I can't spell prosciutto.
All right, but we don't learn that in first grade.
Yeah, but like that's a word I feel like I should be able to spell.
That's valid.
I run into that a lot.
That's the meat, right?
Yeah.
Okay,
yeah.
Paris loves prosciutto.
There's like a C-I-U...
P-R-O-S-C-U-I-T-T.
C...
Something like
that. I think you had it. I think
it's just because I seen it pulling it off the grocery store rack.
Yeah.
COP ripped 100 to 10 overnight. Yeah, it's looking like it had a little bit of a pullback off the gap up and then selling off a little bit here into today. I'm going to hold off a little bit on the oil. It's really tough to figure out exactly what we want to do there, especially not having any type of directional bias there. So I'll be a little bit patient there. Anything else top of mind before we jump into the TradingView platform?
Crypto. Bitcoin finally catching a little bit of a bid.
Okay.
Which is
94,000.
Yes.
Here we go. It's alive.
Quite pleasing to me.
It's been rejuvenated.
Yes. I was waiting and it just kept dipping and I just kept buying. But we finally have gotten a little bit of a substantiated move here. So all of my naked calls are looking strong.
Oh, that's fire.
Also, love, and here's a funny one too. That's something that I always confuse. Year to date versus just like 1 year. Like I always think year to date means year over year.
Okay.
In my head.
Right.
But it doesn't, obviously. It means calendar year.
Right.
But like, and every single year I do this. The first trading day of the year, I log into my platform and my year to date P&L has reset. And I'm like, oh, this is awesome. It surprises me every year. I can never get it right for some reason. And somehow every year by November, I'm thinking it's just talking about back to last November.
Just because you mentioned that now, we're going to see YOY every time we get in.
Yeah, I would love it. If I had them both next to each other, I think I could catch it. But yeah, year to date and year over year, for some reason, those very basic concepts I get mixed up. But yeah, shout out to anybody who had some red going on in the P&L year to date that got to reset that.
YOY.
It'll take far longer to get that oil than anyone is trading on. Yeah, that's sort of what I'm saying, BDH. Not suggesting they're all good short-term trades for now, but the idea that peeps rushed in to buy shares of CVX. Yes, precisely. That's what I'm saying. I mean, this isn't like, it's not like there's going to be oil being pumped into the United States next month from Venezuela. Like, these things take time. I mean, there's all sorts of administrative things, new leadership regime over there. I mean, like, people are acting like we got Maduro and now it's let's go get that oil, and it's gonna take a little bit. There's going to have to be deals signed and things. So, yeah, I mean, and obviously efficient markets are supposed to price in all relevant information, including future information, and I understand that. But, yeah, this is one where I think that we could see some of these names get overextended with the excitement in the news cycle surrounding oil right now. And then, a potential pullback isn't even the word, because I don't mean like lower lows. I just mean maybe we dip to half the highs or something while the market processes for a bit. Can you discuss trading view and thoughts about it? Worth the additional data fees, etc. Errol would love to discuss trading. Go ahead. We can kick over there.
On that note, yeah, we can go ahead and jump over to the trading view platform. But no, very easy to connect. If you want to go down here to the bottom and just hit trade, you can connect your Tasty Trade broker to it. In terms of the data, if you want extra features, if you want extra indicators, and there's a little extra features that you can look into whenever you do your own research, but the free features have more than enough tools for you to be able to trade on the platform, see your executions, and pretty much use everything that you see us use every day here on the free version as well. So sometimes we use extra features, but for the most part, you can get all that for free. But very ezy to connect. So that's what's really nice. Very easy to connect.
Yeah, good integration. I've used Premium back when I was like crazy into technical analysis and really used all the features. And I would say it's worth it if technical analysis is like your primary vehicle for discovery and execution. Otherwise, the free version is incredibly robust if you're just using it as like a second monitor to have charts running sort of situation.
Oh, 100%.
My son is wanting to start trading options. Do you agree with Dr. Jen that a short vertical put spread is the best starting point? Interesting. I guess I would say so. Honestly, I mean that's a very binary thing. Well, it depends. I mean, it depends on the angle that you want to take to educate him, because it is you do need to have a fundamental understanding of how calls and puts work to be able to grasp what's happening with the short put vertical. But the short put vertical is a very good binary way to make a first trade where you can just say, we are looking for this to finish over X amount. And it's an easy way to gauge it. But, and I'm not going to say your son should start slinging naked calls, but there is, you got to make sure that there's actually a understanding of calls and puts before diving into that. Otherwise, it's all going to become a little bit confusing. And the whole because short put is a double negative. That's something that was a little confusing for me when I first started out when I was 18, 19, is the fact that a short put is a double negative, meaning that you're long. So, but yeah, if you explain long versus short, explain call versus put, I think that a short put vertical would be a great starting point.
Yeah, 100%. And I mean, I know we got jokes. Tell your son long calls YOLO, but honestly, not the worst idea. And the only reason why I say that is because the vertical spread is fire. Like, I didn't even know you could trade things like Meta, Apple without using the vertical spreads. I was like, how do other individuals with not a massive account get involved in some of these products? Like, how do we reduce that buying power? And the vertical spreads allow you to do that. So that's what's really nice. But to get started, honestly, knowing buy go up, sell go down, if this number goes up, I make the difference is really helpful. And I think buying a naked call, even though you said it jokingly, even though you said it jokingly, I was like, low key, that's a great way, I think, to get involved in the market. It's really not bad.
And if they're long calls or long puts, it is still defined risk. It's going to be more volatile, but you're not going to get margin called or anything crazy if you're just doing calls.
It just helps you think about the risk a little bit easier, I think, whenever you're dealing with one leg, or if it's just like one single share, it's easier to do that plus minus calculation and understand how that.
Well, yeah, and especially if you've traded some puts before, it suddenly becomes much more intuitive, the mechanics of what's happening with a short put.
100%.
I actually, and unironically, I think it would be a good idea to blow up an account so he learns he's not smarter than the market. That's not a bad idea either. Honestly, I mean, I blew quite a few accounts before I figured out what was going on. It's worthwhile. I mean, you kind of gotta go through those emotions, because I was fortunate that I discovered options trading when I was 18 and was just able to blow $500 account after $500 account for a couple of years, but it was never massively consequential in my life. It would be a very different situation if I was, grown and had $20,000 in savings and I decided I'm going to start trading options with 10 of it and then blew that as my first account. So yeah, I mean, there's obviously a lot to be learned through losing.
Yeah, 100%.
In broader life, I suppose.
Yeah,
and not just in the market.
And I think a really great book actually is The Psychology of Money, because this really breaks down risk tolerance, how people handle money, why people spend money the way that they spend it. And it just breaks down a lot of the behaviors behind the decision making when it comes down to money. So I think that's another great I think a great place. Like, for example, you might see somebody like Tom. It's like, I can never use that type of capital in my account. But it's like when you break down certain things, it's like, okay, that makes a little bit more sense on, why certain individuals might do certain things. So it's another good starting point.
Absolutely. It's going to happen either way. Yeah, that's true. That's true. I think you'd be very hard pressed to find any successful trader in the present who has not blown up a single account in their life. Like, I'm sure that just about everybody has. Exposure to leverage is an important thing to understand, and a long call does that well. Yes, absolutely. And they're both equally important, because if you obviously need to be aware of the fact that you can do things that are defined risk, and that there are more advanced mechanics out there. But yeah, from a very starting perspective, I think maybe just some calls and puts for a little while could be a good idea. And you'll be super mad when he wins his first 7 trades in a row, because that's the way it always winds up going. That was what got me hooked at the beginning. I ran my first $300 account into $1,300 in 4
Bro, that's
days.
The worst thing that can happen to a beginner. Is
so
just make
terrible.
A bunch of money.
Yeah, exactly. I was like, this is free. This is free money.
Right.
And then it was all gone. And then it was all gone.
That's hilarious. We did a little bit in the NASDAQ market today. Really not too much. Market's selling off right now as we speak. We can see it's getting a little bit weaker here now too. But we were looking to take some shorts today, Gus. We got chopped a couple times. We were a little bit early on it today.
I was gonna say, yeah.
And honestly, I felt myself getting frustrated, so I was literally like, I'm done. For real, I'm done after the first 2. So it's a little bittersweet, always kind of seeing it play out well in hindsight after the fact. But honestly, in the first 2 trades, I was like, yeah, I'm done, because if I get chopped up again, I'm going to try and get chopped up again. Then I was like, you know what, I'm going to sit this one out, and we'll see what the market wants to do into the afternoon session and the rest of the day. But if we zoom in a little bit closer here, we'll show how we manage the risk on this trade for the day, especially getting into the new year. It's the first week of the trading year. Don't want to get too frustrated and start off on a negative. So I was like, you know what, we'll take the positive by being able to manage the risk on both of these executions. So we had a rally up to this value area high. And structurally speaking, we understood that there was a potential that this is a little bit of an early trade, right? Not to get into the weeds of the technicals, but we are on a complete uptrend. So the trend is your friend. Take that information, if you will. So understanding that we're on the uptrend is one of the reasons why I didn't want to be so stubborn with this short to the downside, because we don't want to really try and be so stubborn trying to call the top. So we ended up letting that trade go. But then we ended up getting rejected, and now we're selling off down here, down to the lows. So other than that, if we zoom in over here, you can see we took one contract over here, got stopped out. And then we looked to get long here, and then we got we got stopped out to the downside. So we just stepped away from there. And that's kind of how the cookie crumbled today. So honestly, not that exciting on my end, but it's been interesting seeing how the volatility is panning out through the rest of the day. I didn't think that we'd get too much more volatility in the market after we were chopping around for maybe the last hour or so. So that's what we got on the day, brother. We got on the day.
Yeah, I always think it's interesting, just the difference in our time frames, but how just the same phenomena will manifest across multiple time frames. Because I will have 100%. Trades all the time where I am just 2 weeks too short. I'll take something 3 months out, don't get the move, lose, and then 2 weeks after I'm out, suddenly the move comes through. Yeah. And I'm like, oh my gosh, if I just made this time frame longer. And that's always a little easier to stomach because there's days between them. I don't know if I could trade the way that you trade, because a situation like this would make me so mad. And you're just like, it's fine.
Bro, it's just like
that's what you have to do. You're doing it the right way. I'm by no means we're gonna be more emotional.
No, we're gonna come back to this someday this week, and we're gonna get a 100-point banger top tip, and we're gonna be like, all right, all that frustration was for good patience.
Absolutely.
Other than that, though, want to look at some of the metals, maybe some gold, some silver?
Yeah, for sure. Yeah. Something else that's been on my mind too is this psychological resistance at 7,000 SPX, I think is going to be really immense.
SPX.
Yeah, there's always psychological resistance at these big I mean, psychological levels would be the best way I could describe them. No reason for there to be a resistance at 700 any more than 699 or 701, but it's the way that it works out. But I just have a feeling that this one could potentially be a big one. I remember when we touched 500 for the first time, and it was like this week-long thing where there was this psychological resistance at 500 before the breakout finally came.
Right.
And I think we could very likely see another episode in that regard as we start to get close to 7,000. Sorry, I started talking in SPY terms in the middle there. 5,000 is what I was talking about in big boy numbers.
Put that in SPY terms for me, please. Put that in Fortnite terms for me, please. A little bit on gold, and haven't been doing too much in the metals. Let us know what you're doing on the metals. Let us know if you're trading gold. Let us know if you're trading silver. We're getting a little bit of a rally after we kind of maybe put in a short-term bottom on the last day of the year. Any opinions over there on the metals, or what you got going on?
Why do we keep going higher? I mean, like we're not at higher highs right now, but
right.
I mean, it's just every single time that I think these might finally be running out of steam, suddenly it's wham, and there's the big bullish engulfing, and we're just right back on right back at full steam. It's incredible. It's incredible what we're seeing with these metals.
No, it's interesting because it seems that opportunity might still be there. It feels like the story can't be over. It can't be over. We're still near the highs. We barely had a bit of a pullback. Now we're kind of trading within a range over here. So it's going to keep us on our toes until we get that break, whether it's at the upside or downside. So we have no choice but to sit here and ponder on if we want to get on a directional position maybe.
Yeah, and something I am the worst about in general is like getting long into something that is already running like crazy.
100%.
Which, in general, I think is a good policy that certainly saved me a time or two. But I really have a hard time differentiating, I feel, between what could be a sustained run and what is, something that's a little more short term. Like I always struggle to, as something is beginning to take off, isolate whether this is actually something that could be substantiated and continue for months on end, or if this is some crazy thing that, social media and Reddit are churning up that's just going to go right back to the original level in 4 days from now.
Right.
Beyond meat. Hate it. But gold, I feel I should have that sentiment even more strongly. It tends to be cyclical isn't the word because it does work up with time as a hedge against inflation, but it's not. Gold is not something that you consider to be a parabolic mover in general, nor silver, nor platinum.
Right.
It is platinum, right?
Yeah, platinum, silver, yeah.
I always think of titanium. I don't even think I don't think there's a market for it.
Yeah, we're gonna have to look into that.
Good song though.
It might be cobalt or copper soon. We'll see.
That's true. Yeah, copper is the same deal. But it's not something you would ever consider should go on a parabolic run, especially when conditions seem to be fairly stable, but it just keeps going. So, to your point, I think I would have to get long if you made me trade this directionally.
Yeah.
As insane as that is to say. And as much as my brain screams, we must short, I think I would just be forced to get long because if it hasn't stopped yet, what's stopping it?
Yeah. I mean, again, who knows? I mean, we're not too far off the highs over here, trading at 76 over here on silver. And I mean, just from a volume analysis perspective, from the swing high and swing low on silver, I mean, the point of control is sitting at around 75, 73. This is just objective information that we're just extracting from the market right now. Do with it if whatever you will. But trading right above there today. So a lot of, from that perspective, it's been a little bullish, over the last 24 hours at least.
Absolutely. Jared, fantastic point. There's a difference between FOMO and momentum.
No, there's not. Just kidding.
That's absolutely true, but it also they do sort of go hand in hand. Like,
is it a self-fulfilling?
Well, I would say like Palantir is something that I would apply this to. Palantir on the initial run, the 500% year or whatever.
Right.
Literally once a week, if not more often than that, I was like, I should get long, and then I was like, no, there's no way this can go on for much longer, and then it just kept going. And so the FOMO, there was momentum, but I was creating the FOMO for myself by misidentifying it. So yes, there are definitely different things, but it's identifying whether you are feeling FOMO,
what is
feeling that there is legitimate momentum. That's the challenge.
What are we feeling right now? Is this validated momentum, or am I just am I missing out right now? I don't know.
But
that's a great differentiator.
There's 100,000 other things I can trade, so I don't even have to worry about it, which is what it ultimately comes down to. And that's the greatest cure for FOMO, everybody. Just remember there's a million good trades every single day. Think about, why would you have FOMO? Because there's 10,000 trades today that could have made you thousands of dollars that you don't even know about.
It's true.
You just have FOMO about the one that you know about. So Pretend you didn't see it.
The half glass is full.
Yes, half glass, half full. And yeah, I know we're getting close to our time here, but bold prediction from Strategic Resistance here, which I see the line of logic, but gold will continue to rise, silver will crash along with the tech bubble due to an overall collapse in the economy. Copper will also crash with the tech bubble. Interesting. I personally find it hard to see a world where silver could crash, to use that word, and gold continues to run. I feel like that would at least knock gold down a peg along with it. But I absolutely see where you're coming from. And copper does seem more removed from the two. I think copper could do whatever it wants without necessarily affecting gold and silver as much.
Copper does whatever it wants. That being said,
Your neighbors' houses have free copper in the walls.
It is free.
It's free.
I don't see any signs.
Just take it.
No, with that being said, there is the big deal match. Remember, there's a 4% match on up to 10K. That's going to be 30 days commission-free trading as well. So especially if you're somebody that gets in and out of the market, maybe is a pretty active trader, you can definitely take advantage of those 30 days free commission, because I know I'm going to take advantage of that. Even though we took 4 or 5 today. I'm going to upload the rest of the trades to the follow page, but I think we're pretty close to updated on all those trades.
Yeah,
so.
It's a great deal. If you've been waiting to make your first trade, now is the time. Do it free of charge.
Free of charge, 2026. 2026. That's going to be it on my end. We'll keep an eye on the NASDAQ market, and we'll keep you guys up to date and send any trades through that we put on for the rest of the day. So that's going to be it.
Yeah, absolutely. Ranch, I'm actually about to read The Psychology of Money for the first time. My dad just got it for me for Christmas, so I've heard great things. I'm excited about it. Thanks so much, everybody, for coming to hang out with us today. We dearly appreciate you taking the time out of your day, and we never take it for granted. Be sure to stay tuned for Futures Power Hour coming on next. We'll be right back here, same time, same place tomorrow, 12 o'clock noon Central Standard Time. We'll see you guys next time.
Peace.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the board. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IB rank, and more tools. Tasty Trade. Download today.
We're back. It's still Monday, January 5th, 2025. This is Futures Power Hour sponsored by CME Group. I'm your host, Chris Vecchio. He's Thomas Westwater. Thomas, it's good to be back.
Yeah, it's good to be back. 2026. It is a new year.
I was going to say it's good to be back for hour 4 today on air. But yeah, 2026 arrival's nice too. Of course, we have a market that's, I guess we're going to get into it. New year, same markets, Thomas. How has 2026 greeted us? Volatility is low. We're seeing that gold and silver are moving up. Stocks are kind of trading to the upside in low volumes. I don't think anything's changed since last week, Thomas. Has anything notable happened in the world that might be moving these markets?
I mean, yeah, there might be something in South America, Venezuela. But yeah, I mean, major geopolitical event. Markets working through it. Crude down. That's interesting. I mean, yeah.
It's certainly an interesting reaction in the energy markets today, particularly when you look at what companies have come out ahead as a result of the arrest of Nicolas Maduro, the Venezuelan president, over the weekend. I've mentioned this twice already, so it will be the last time, but hell of a way to end a digital detox, Thomas, where I was off social media and staying away from the internet over the holiday for a little while. And of course, that was one way to wake up on a Saturday. So where does this, of course, leave the markets here? Stocks couldn't care less. I know it's trite and callous and cold to suggest that markets don't care about events like these, but the reality is if the Federal Reserve is not going to change their policy, fiscal spending is not going to change, and corporate earnings aren't going to be impacted, then stocks, generally speaking, they don't pay too much attention to events like these. It's not dissimilar to what happened back in June with Iran and Israel. There was an energy market reaction. There was a market reaction in precious metals. Stocks shrugged it off and kept moving higher. So in many sense, Thomas, it's a new year, but it is the same markets. What does the new year bring us in terms of a roadmap to start the month of January? I'm remiss to say I was not able to finish the review of what products traded well and not well last year. That will be done for tomorrow's show. So do tune in for Tuesdays. What futures products were we successful with in 2025? What were our best performing strategies? What cost us money here? Just to learn, right? We want to learn from what mistakes we made and do a little bit more of what we did better. So we'll start with January seasonality, because seasonality has been a tool in the toolbox, Thomas. I think last year was a good year for folks who were watching Futures Power Hour, particularly if you're a gold or silver trader. Let's see where the month of January 2026 brings us. We're looking back the past 20 years here. 2005 onwards. The S&P 500 typically has a good month of January, and so far it trades higher 52% of the time. But over the past 20 years, this is a market that's down 0.01% in the month of January. That could be an artifact of having some crisis years in there, of course. We do have the start of January 2009 in there. That weighs down on the market performance. 2008, 2009, 2010, January had 3 in a row red years. Same thing for 14, 15, 16. And those were red Januaries, Thomas. 2008 minus 6.6%, 2009 minus 8.6%, and then 2010 3.6. Similar losses of 3.5%, 3.1%, and 5.2%. So when January's bad, it's really been bad. But I mentioned that's really part of the crisis years, because if you look back over the past 10 for stocks, it's been better. 55% of the time the S&P 500 has traded to the upside, notching a gain of 0.86%. In the post-COVID era, it's been similar. We can go back to 2021 because we don't count 2020 in that regard. But since 2021, the market's averaged a gain of 0.54% in the month of January. So the closer you get to present day, the better the market's treated January. We could just leave it there for now. I'm curious, when you think about the stock market this month, maybe a Santa Claus rally that's trying to scrape itself together today. How are you feeling about equities here as we turn into this new year?
Yeah, I mean, I'm feeling pretty decent about equities. I have some single exposure name. I'm out of my ES call spread that I had. But yeah, I think I'm going to get back into just, a long call spread on ES, something like that. I'm kind of trying to rebuild exposure back up this week now that the holidays are past and everything like that. Interesting to see the seasonality in gold there. 3.3%. That's quite a bit. You were talking about outliers. Is there anything a year where gold was up like a crazy amount that is dragging that number higher?
Every year, basically, for the past,
Okay.
I'm looking at the past. 20 years is 3.37%, standard positive 67% of the time. The past decade, 3.48% higher, 73% of the time. Past 5 years, only higher 40% of the time. So only 2 of the past 5 years it's up, but it still has averaged a 1.91% gain. And it's because when January has been good for gold, it's just been so strong. I'm just going to run from 2015 forwards. 8%, 5.3, 5.2, 2.6, 3.4, 4.3, minus 2.4, minus 1.8, 6.5, minus 0.2, and then last year plus 7.4. January typically has been a very strong month for gold. In fact, over the past, I'm looking here just at this decade now, the 3.48% gain in the month of January is its best monthly gain on average. This is tied for its best month in terms of positive performance, 73% of the time. 15, 20 years here, 67%. Not going to find a better month. January is the month for gold. It's a month for precious metals.
Yeah, I think I'm going to stay in my long gold and silver positions in that case. I would imagine silver is something similar around gold's performance.
Yes. Past 20 years, going back to 2005, silver's averaged 3.79%, 67% of the time higher. In terms of monthly performance, it's the best month of the year for silver. In terms of the percent positive, it's been the second most reliable month to the upside for silver. So, Thomas, we take that with a grain of salt in many cases, but for whatever reason, the start of the year, people have been deploying capital ever since the financial crisis to the metals market. And in many sense, that's one of the reasons why just because it's 2026 doesn't mean some of those 2025 themes and price action are carrying over.
Yeah, I'm wondering if some investors, they're like, I had a pretty good year. I'm going to put some in gold now. It's had quite a good year, and I want to see, if my money's going to do good in here instead of maybe a little less weight in stocks. But those are individual decisions. It's hard to speculate on that. The Santa Claus rally. It looks like, what is it? Today's the last day, like technically, right?
Yes, it is.
Oh, yeah.
We need to, I had the math up here. We need to rally another like 0.5% in order to get Santa Claus officially here for the 2025-2026 crossover, which thus far it hasn't happened. Here's a great stat though. There have been a number of times recently that Santa Claus has not appeared during the last 5 days, first 2 of the year. That's supposed to be a window with which a 1.3% rally on average since 1950 has occurred in stocks. The past 2 years, it has not happened. It was minus 0.9% and then minus 0.5% from 23 into 24, then 24 into 25. Here's the rub. When the Santa Claus rally has failed, it hasn't failed that often. I'm counting 6, 7, 8, 9, 10, 3, 6, 7. This would be the 8th failure. Okay. In the previous 7 times when the Santa Claus rally has failed here, we have an average loss of minus 2.5%, and the market's down 71.4% of the time. So something to think about, right? There's a reason why people look to the Santa Claus rally, because when it doesn't work out, then you don't typically see a strong January. And I also point out that when you have a particularly bad Santa Claus window, that's when January tends to be really bad. In 2007, for example, minus 2.5% in that window, January was minus 6.1. 2014, minus 3% in the Santa Claus window, January minus 3.1%. So there's a certain vibe, seasonality, dare I say, when these kind of events occur. So today's close matters perhaps a lot for folks like myself who are momentum junkies, who are hoping that Santa can come to town and Well, stocks are at least trying to save Santa's reputation here on this Monday, January 5th. 69.54 here in ES, Thomas. That's about 0.8%. The NASDAQ doing a little bit better, up about 0.9%. It's a bit of a switcheroo from this morning, however. When we were doing the morning show, Thomas, the Russell and the Dow Jones were lagging for most of that 3-hour block. By the end, the switch and the flippening started to happen. And sure enough, both the Russell and the Dow right now up nearly 1.7% each. Volatility likewise coming in. I think that's the important observation for what we care about. It's a 16.11 on the F contract. It's 18 still, or are we in the 17s? Yeah, 18.23 here for the G contract. So volatility is staying down. I just want to start there because the VIX is up below 15 handle after this weekend's news. Do you find yourself at all surprised about this market reaction? Basically hand waving away this U.S. intervention in Venezuela?
I'm not too surprised. Ultimately, I think the focus for the market remains on corporate earnings, monetary policy in the U.S. A significant military action in Venezuela, I don't think really is going to take the market's focus off of it because really, I mean, what are the repercussions? There's some political fallout, but really there's not military fallout that we can expect from it, or at least any kind of significant action. So I think the market is, right to not have kind of fear on that happen. So, I think it is what it is right now. It's going to generate a lot of news headlines, a lot of political commentary. Outside of that, it's, it's surprising, but I don't think it's anything to worry about in terms of the market.
For equities right now, it seems to be a non-concern. It's always about what happens next, pricing in the future. And at present time, it does not appear that there's going to be any additional escalation beyond what's happened. That's obviously prone to revision, and change of judgment in the future. The level that we're watching in the S&P 500 here is the close that we had on Tuesday, December 23rd. That marks the end of the period where you're in normal conditions, and then thus begins the Santa Claus window, 24, 26, 29, 30, 31. Final 5 of last year. The first 2 of this one are the second and our today, Monday, January 5th, on our daily chart. The close on the 23rd here, we are looking at 69.61. So we're currently trading in at 69.54. 7 more points, Thomas, a little bit less than that. And you've technically triggered a positive Santa Claus rally window, another 0.1% from where we stand right now. It feels like that's going to be something the market's going to try to reach for today, but it's a really nice day to try to reach for it. The downtrend from the highs that we had post-Christmas appears to be breaking today, insofar as we likewise clear out that horizontal level, the former swing highs right near 69.40, we'll call it, over the course of today's session. And when we take a look at our daily chart, that's the beautiful candlestick pattern that I like to see here. Those 3 candles are shaping up to be a Morningstar candlestick cluster, where the support no less is coming in at both 68.50, 68.60, which has been a swing level over the past few weeks. But importantly, it's coming at the 1-month moving average. We're getting a bottoming candlestick pattern right at the 1-month moving average, which is not so different, maybe a different form and fashion, but not so different than when we got this inverse head and shoulders pattern here coming out of the downtrend off the highs that we had earlier in the month of December. So these little clues, Thomas, within the price action, the volatility staying low, the technical momentum building up, these bottoming signals occurring at important swing levels. They say that the path of least resistance, at least in the short term, may still be to the upside. Is that a disagreeable thing to suggest here as we start 2026?
No, I don't think it's too disagreeable. I'm trying to get an order in right now on a call spread for ES. I think we're, I think we look a little like a coiled spring a little bit to the upside. I think we got a breakout. I don't know if there's any news that will get us there. I think it's going to be a technical move. And, it's early in the week. It's a good start to the week. I feel pretty good about it. I wish I had more than kind of a vibe going off of it, but that's kind of really what this trade is for me. I like how the technicals look, and it just feels good at the start of the week.
It does feel good at the start of.
I'm in a 2-day out call spread. Yeah, 69.60, 69.70. Just gonna try, strong close today. Good move tomorrow. Probably take it off. Hopefully tomorrow afternoon for a nice little gain here.
Yeah, getting a push higher into that Santa Claus window positivity area. That's one way to phrase it. That would be north of 69.61. So if we do close there today, then you have a market that's perhaps giving a signal that it's not going to be one of the bad years where you have a rough month of January that, again, typically loses ground over 70% of the time. 5 out of 7 occurrences, Thomas. I'm with you. Today, I had to reinitiate a new S&P 500 call spread position, in part, at least here on the follow page, because we see that the one for 7,000 set for the December 31st expiry expired worthless last week. Delightful. However, getting back into the position today, we posted this on the follow page, so it's the first trade of the year, sitting out 46 DTE, long the 70.50, short the 7100. I like the setup right now. I like the technicals. I like the fact that it appears we could be on the precipice of the Santa Claus rally window ending on a positive foot. If it were, that's a good omen for January, in my view. The volumes today are light. It's the first day of the year after the Maduro news, and we're only at 861,000 contracts traded. That is the shocking part of today's market to me. I figured there'd be a lot more volume on the first day back. So here we are. What was going to bother us this week? And apparently nothing. So we have a market that's melting up. Is that what we're allowed to call this? Low vol, low volume. It's a melt up of sorts. A melt up that, gosh, is that a symmetrical triangle, Thomas, after an uptrend?
I say that, maybe a little bit.
I usually feel really good about those kinds of things, which is why I'm doing what I'm doing, which is both long this new ES call spread and holding on to the MES position that we've been riding for several weeks now.
Yeah, I mean, triangles have always worked well for me. I've always liked trading them. And they're fun to trade too, so.
Fun to trade. I find them fun to trade. It's a situation that the NASDAQ finds itself in similarly. There's your Morningstar cluster getting back above the 1-month moving average. We're not quite through that 25,650 level that we've been eyeing off here since December 2nd. It's been both support and then resistance and then support and kind of still resistance today. We haven't been able to crack on through it just yet. But the pieces are kind of lining up here, right? For at least another attempt to the upside in the short term. It is a little perplexing from where I sit, though, because the second year of a president's term is usually not a good one, if history is any guide. On the other hand, the 6th year of a president's term is usually a very good one. Is this Trump's 2nd year in office, or do we call this his 6th year in office? Do we want to pay attention to the 20-year January seasonality or the 10-year January seasonality? That's why I want to see the Santa Claus rally window close positively today. Just a little bit more confidence to make me feel good about what we're doing. I'm doing it either way, but I'd rather feel better about it. Holding a position over the next few sessions, which I suppose, Thomas, is something unto itself to consider. Do you see any significant risks today, tomorrow, the next few days, leading into non-farm payrolls on Friday? Because I'm looking for something that could potentially offer us a catalyst. Jolts? ISM? What say you?
No, I think it's the NFP, really. Until then, I think, this positive vibe we have in the market, I think it's going to continue until then. I mean, we've had major risk events occur, and they haven't scared the market at all. Like we said, the Venezuela thing, it happened. The market's fine. It's chugging along. You get a JOLTS reports. I mean, those are high frequency data points, and I don't think it's really going to. If the market was a little more sensitive right now, but it's not. It's doing good. You know, we're almost a full percent higher. I think I don't really see much that's going to throw us off, unless it's like a black swan type news headline.
Black swan type news headline. That wouldn't be good. Well, hopefully it's not one of the gray swans that we covered last week. I'm looking at the CME FedWatch tool right now, Thomas, thinking about how the market's behaving in the wake of at least the little bit of data that we had out today. We did have the ISM manufacturing report today. Came in at 47.9 versus an expectation of 48.3, which would have been a slight improvement from the prior 48.2. But again, instead, it's a slight loss. It's the start of the year, so I'm going to give a quick refresher on the ISM. It's a diffusion index. If you're a respondent to the survey, you're afforded 3 answers: 0, things are getting worse; 50, things are staying the same; or 100, things are getting better. You blend all those answers together, and you're going to get a number that's anchored around 50. Above 50, you're growing. The higher you are above 50, the faster you're growing. Below 50, it's the reverse. You're slowing down, you're contracting, and the deeper you go below 50, the greater the rate of contraction. So, ISM manufacturing survey is telling us that not only is the manufacturing sector staying in a period of contraction, the rate of contraction is accelerating. It's getting worse. We have a CME FedWatch tool today that's telling us that there is a 16.1% chance of a 25 basis point rate cut in the month of January. In a few weeks' time, the Fed's meeting on Wednesday, January 28th. A day ago, it was 16.6%. A week ago, it was 16.6%. A month ago, it was 24.8%. So this is why I can't help but wonder what could move the market before non-farm payrolls if it's not an increasingly, I don't want to say dire, but declining ISM manufacturing against the backdrop of what's been almost K-shaped recovery, some part of the economy is in recession type of data. If we're not going to react to ISM, then why would we react to anything the next few days? Services, JOLTS, weekly jobless claims, ADP. It's almost to say nothing matters.
Yeah, I mean, the services, maybe it could have a little more of an impact, but that's because the U.S. economy is about 1/5 only manufacturing, a lot more heavy on the service side. But I agree. I don't think the services, I don't really think anything is going to really be able to kill the optimism right now.
We could be wrong. We've been wrong many times
Could
before.
always be wrong. Yeah.
But the setup right now, I know vol and the Nasdaq's a little bit higher at 19.7. It trended up a little bit today from where we were at the end of last year. Triangles and uptrends, they warrant a bullish posture typically. It doesn't work out all the time, but when it works out most of the time and the volatility is staying low, it's not indicative of a top. If this was a topping process, volatility usually increases as you top out, right? That's not today's market. And of course, subject to revision. The Russell, though, this is really encouraging because the past 2 sessions, we have a really firm bounce off of that 50-day moving average. We reassert ourselves back above the 1 week, back above the 1 month. Now the 1 week and the 1 month, as well as the 50, all 3 have positive rates of change, just underscoring how firm that momentum is to the upside. We take a look at the chart from the highs that we had recently, and sure enough, that's a break of that downtrend. This is all being fueled, Thomas, by the banks. It's the big banks, which are worth pointing out here, up at new highs. And this has been a beautiful chart we've been watching and observing, not trading, unfortunately, much to my chagrin, because that's a self-decision and not anything else other than me not trading it. But this is looking great. Playing out exactly what one would expect. Breakout into new highs, pull back into the breakout level, finding support at the 1 month moving average, cycling into a new high. It's the regional banks, not just the big ones. Regional banks back on the breakout path, bouncing at their 50-day moving average in Friday's session. We can scroll back a little bit longer here, Thomas. This is a market that's not ready to say that this triangle inverse head and shoulders pattern has failed. It's really in strong defense today. So if that's where we're starting the week, where the banks are leading, where tech's leading, where semiconductors, SMH, are sitting up at what would be an all-time closing high, where the Dow is sitting up at what would be an all-time closing high, the bears may have to bide their time and wait for something more serious than a U.S. incursion into Venezuela or whatever data is coming up before NFPs to actually get a swing at knocking this market down.
Yeah. The Russell is interesting. I mean, energy is doing good today. Financials are doing good today. So it makes sense that the Russell is having a really good day. I just realized I said oil is down at the beginning of the show. I don't know why I said that, but obviously
It's back up
oil
today.
is up today. And yeah, the Russell, it does have a good amount of energy, even more so the financials and the regionals, but those rate cut odds. I'm kind of interested on how the Russell is going to react if we have a bad jobs report, because I think that shows if rate cut bets are going up for the wrong reasons, the Russell would do poorly. If rate cut bets are going up for the right reasons, then the Russell reacts very well, I think.
January 16th is the day of the last jobs report. It was released on December 16th for the November 2025 report. The Russell did not have a good session. It was a modest gain of 64,000 jobs, but the net of that was rate cut odds are modestly lower. So what happened to the Russell? It fell off. It kind of wants the rate cut. It wants the rate cut for the right reason, to be clear. If it's a K-shaped recovery and the Fed sees more of a reason to cut because of whatever's happening in manufacturing and various subsectors of the economy, maybe the Russell can eke it out if energy firms are staying strong and the banks are holding up, even if it's for spurious geopolitical reasons, right? If this is an oil rally, Thomas, do you really have a lot of faith in this being the driver for the Russell? I would say no. I think you need something more than that to get a significant breakout going.
Yeah, you need more than just energy prices, which is really if oil prices go up or down,
We can keep this moving. So long stocks, it's working today a bit. Bonds, however, not working if you're on the long side. At least they weren't last time I checked, and they're back on the up. So much for that. Here we go. ZB is up at 115.5. Can't quite lose the uptrend off of the recent lows. We eked ourselves outside of this, what should have been perhaps a bullish falling wedge. It hasn't provided much of anything to the upside. Makes me think that maybe we're in a bear flag instead. But the bear flag did not break today. Okay, so whatever we're doing down here, it still needs more time to develop. If you really want to get bared up, I think you're going to have to wait for 114.5. I know that's unappealing to suggest because that's so far away. It's a full point. But in doing so, then you would finally break the December lows and get some indication that you have continuation here if you're more of a directional person. Otherwise, for me, I'm still holding short deltas right now. And until 116 gives way, I don't see a reason to give up on that. Head and shoulders pattern. I've decided, though, that one of the problems I had last year, having looked through some of the data, is that I had some strong views on the bond market. And the bond market did not have a strong performance. Instead of trying to adhere, at least for this particular asset, unlike gold or silver, which in stocks, like having North Stars and adhering to that process and that vision over the course of the year, I think bonds, I just have to take trade by trade. I don't want to look at the chart and say, well, XYZ is happening, so let me find an opportunity to get short this. Because directionally just hasn't worked out so far. And if we get directional, then I'll, get back on that path. But I can't say that I'm loving what we've been doing here in bonds, Thomas. Either end, looking for something to move, looking for something to go up or down or just go anywhere. Been a stick in the mud. And this is not the week where it seems that we're going to get much movement outside of this recent range, 114.5 to 116.5, given the channel that's up here on the screen.
Yeah, I've been long ZB all the way since the start, or probably the end of November, I think. And it just hasn't worked out for me. I don't know. I don't like the price action right now that much. I just don't like the trading that it's been doing. I'm going to take this position off. I have to. My call spread, because it's 18 days out. And I'm going to eat the loss here. I'm not going to roll it or anything. I need more clarity on, how the economy and the expectations are going to go with inflation and growth over the long term and how that's going to impact ZB. I might just stick to ZN for now. I think I might have a clearer read on that, or it might be a little easier to read it based on what the Fed does. I just don't like ZB right now as a trading instrument, so I'm going to stay away for a little bit.
Yeah, I'm with you. It's been frustrating for me as well. Yeah, I see the similar price action in ZN. I'm still leaning long. It's 46 DTE. So incidentally enough, right? One of the reasons why we went out a little bit longer when we put on the notes position a few weeks back was effectively by the time you get back from the holiday, it would be a almost a typical tasty trade, right? 45 in, 21 out. So given that volatility, we had negative IVRs at the time. Why wait? Why not put on a position, use a little bit more of that duration as a tool in our favor, because we're looking for vol expansion. And maybe it doesn't happen over the holiday, but we want to get our foot in the door. So in case we come back from the holiday and something's happened, okay, we didn't miss the trade. It's cheap to put on, cheap to take off. This has been miserable so far. I just need to get this away from 112. The reverse iron fly is put on in a situation when you have negative volatility readings in the IVRs, because you're effectively playing for vol expansion. You're not trying to collect premium. What you're trying to do is say, this thing is just going to move one way or the other. As long as it moves away from current price in this window of time, it will be a success, right? It's a long gamma kind of trade. 112 and a half so far, not nearly good enough, Thomas. I'm glad there's 46
No, that's
days.
not good enough.
This is why we structure this the way that we do. So reassessing it here today, this was always part of the thought process. We get back to January 5th. If this is a trade where we still want to have it on, will we keep it on or will we take it off? That's a great question. It's a great question. Is it working? Where are you, ZN? Down about $200 so far, Thomas. Up about $7.81 today. There's a lot of time left. And the vol is starting to go up. It's no longer that negative IVR environment. It's a 17 now. If this was still a negative IVR after all this time, I would say just abandon ship. But because at least we're seeing one of the two things occur, right? Vol was too low. It was going to rise, and this thing will move. Half the thesis is still intact. And as long as one of those two tenets are remaining here today, I have to stick with this trade. As much of a drag it's been the last few weeks, it's been kind of a drag by design in order to allow for this to occur and reassess with a small potential ding. It's a small ding, so I'm just going to keep at it. I'm not happy with it, but volatility is creeping up again, and that is part of the thesis here.
Yeah, you just need a little more.
I just need more. Give me like a 57 IVR. We'll be fine. Yeah, just like a 30 IVR plus a move to 113. That would work. That'd work.
Yeah, I mean, I am interested to see what bonds will do this year with how the Fed is changing structurally, or I guess you could say politically. But I think those cards will be unveiled a little later in the year.
Apparently, we're going to get a new Fed chair this month, so that is something to consider. Maybe that's why we're seeing bond vol start to rise here. 3-year note, 10-year note, 30-year bond auction. Those are next week, Monday and Tuesday. 3 and 10s on Monday, 30 on Tuesday. So we're not going to have anything major in the Treasury Department this week. Again, if we can't get a move in Fed cut odds after the ISM. Well, here's the fun part of the show. Bonds are having another one of those days. No, excuse me. Metals are having one of those days here, Thomas. Silver's now up 7.2%. It was up closer to 9 earlier. And so it's, at least over the past several hours, this is a session low. Let's take a little bit of a closer look here. Yeah, 75, sitting right near $76. the lowest it's been since about 9:30 this morning when U.S. cash equity markets opened. Gold's up 2.8% here. Either way, the key observation that I'm making is looking at that 4-hour chart in both of these cases. Maybe we'll go to 8 hours for gold. We're going to go to 12. We sure about that, Chris? There we are. Okay. The uptrend from the lows that we have in August 2025, November 25, and then here at the end of December 26, that's still intact. Today's action brings us back above the former highs that we had in mid-October. And what else do we have going on here? Oh, yeah, all of this is occurring right at that 1-month moving average, hugging that uptrend from the August low. So the price action speaks for itself. Volatility is staying up. Prices are holding momentum levels. Why fade this right now, Thomas?
Yeah, gold having a really good day, the best day so far since October 20th. So it's quite the move. I would like to see us, reclaim the recent highs and then just continue to move higher. I don't think we're in too much danger of a big pullback with that just happening last week. I think we continue to grind higher, 4,500, then 4,600, do it in steps. The way up has been incremental, pretty orderly. Then, going all the way back to October, you get like 3-4 times where you really get any kind of substantial pullback. Outside of that, you pick your spots and you leave a trade on for 3 to 5 weeks, and you're doing well. So I think we continue to do that. I'm in a gold long call spread. I'll stay in there. I'm in a long call spread on silver. I'll stay in there. The only metal I'm not in right now is copper, and so I think the precious metals, they'll do good this month, especially with what we talked about, that seasonality effect coming into play. I'd say it's probably gold and silver are what I'm most bullish on right now, and I'm going to trade accordingly.
I had a lovely tweet the other day saying, I thought Futures Power Hour was sponsored by CME Group. How come you didn't know about the margin changes? There's ethics, there's laws, there are rules that exist in a society. So they're not going to share that information with folks like us. Also, would I have stayed long silver if I knew a margin change was coming? Going to whack it down 8% in one session? No. Come on. I thought it was just patently absurd that it even came across the desk. Not as absurd, of course, as silver holding $70 last week, because it's getting punched in the face by these. I have to think that there's probably going to be another margin change, just given the price action, right? Everyone getting ginned up again. You had nearly a 9% gain earlier in the session on the back of this Venezuela news, which are fragmenting global order. You need an intermediary outside of the dollar. You can't trust any of the Western fiat currencies because they are all, and their strength and survival is largely predicated on the backing of the U.S. security umbrella. You don't trust the yuan, certainly not the ruble. You're not going to use Bitcoin, which can be easily traced by the U.S. government or other sovereign entities. So what do? You're kind of left with the metals as an intermediary, Thomas, which for today, it puts us in an interesting spot because as far as we're concerned here, there's a few things that do need to be changed DTE-wise. We're getting into the teeth of some stuff. We'll go over to gold first. We're at 22 DTE, 4,400, 4,425 call spread. So that is working out. It's right at the place where we'd want it to be. Okay. Should we be, I don't say greedy, but should we be of the mindset that this thing has a little bit more room to run? I am. I outlined yesterday on First Call. Let me just clear up the screen for a quick second. There may be a little bit of an inverse head and shoulders pattern down here. Left shoulder, head, right shoulder, with a neckline at 42.85 and a head at 42.85 and a neckline at 44.20 or so. We'll call that $140. $140 brings you to 45.60. 45.60 is in the teeth of the highs that we had on December 26th, that session after Christmas. If we're operating in that Stanley Druckenmiller 8 to 20 times multiplier on your time frame to look for when such an occurrence could occur, on an hourly chart, this means we could see resolution by tomorrow. So yeah, I'd like to stay long. I'll wait until 21 DTE here and then find another way to express a bullish position, which already is being done in some regards. I am long the 5,000, 5,100 call spread, sitting at 112 days to expiration, something I put back on before the holiday. That's going to be a central part of what I'm doing in gold for the next few months. That's not changing no matter what, unless something, you say black swan. I say Trump giving Powell another term, right? Like something of that stature that fundamentally changes our understanding of what's driving the market, so to speak.
Yeah. I've said this a lot, the past few weeks. I don't expect much to change with the fundamental outlook for gold and or silver. I think it's just to pick your spots. Pick your spots and you wait a few weeks and do the trade again. I'm going to keep doing that until it's not working.
The rolling 1 month correlation right now, by the way, between gold and gold volatility, if you're tracking something like a GVZ, measuring it against GC, the rolling 1 month correlation is plus 0.75. It's one of the reasons why I continue to point to volatility being foundational to this significant run. In silver, the rolling 1 month correlation between silver and unfortunately, there's no silver volatility ETF anymore, but what I'm pulling up here, just with GVZ, is also plus 0.9. So just as a proxy, like metals volatility expanding has been good for the metals. And we look at a market today coming out of the holiday where volatility is pinned up, 58.8 IVR here, 86 in silver, a hold of the uptrend off of those late November lows coming out of last week. Now you get a little bit of a triangle or a wedge that's broken out here. You could make the argument, Thomas, that maybe 78's a line in the sand. Because once we've gotten through 78, we've had the CME margin hikes announced. We had this on the 30th. We had this going in out of the 26th, right? Going into the 29th session. We're seeing here today, we get up towards 77, 80, and the market starts to sell off a little bit. Maybe there's a little fear out there that the margins could go up again. But heck, as long as this uptrend remains, I think you got to stick with it. And as we said over the break, there's a fundamental difference between the margin hikes now and the ones that we saw in 2011 that killed the silver rally. Back then, when those margin hikes started, Thomas, you could get 26-1 leverage in silver futures. Prior to these margin hikes starting, you were looking at more like 6x leverage. So the speculative forces that were driving silver higher in 2011, those are short-circuited once the margins went up. The people who were pushing that thing to the upside could no longer afford to hold their positions in the size, the quantity that they wanted to. Going from 6x leverage to 5x leverage to 4x leverage, those are a little bit easier to digest. So I would just, hey, I'm going to stick with it. I know it's been uncomfortable the past week. Silver's been working out really well for us. Silver here is not something like gold that needs to be changed. Still at 50 days. This is deep in the money from 67, 68. Pullbacks looking to get longer, need to get more exposure. Copper, Thomas, you talk about the stockpiling of everything, and what a beautiful looking chart here. Sometimes the best plan of mice and men do work out, where our target initially was for a measured move up into about that 575 figure, which is why we looked for the 5758 call spread. And as of today, it is deep in the money. Love to see it at 597.55. I don't think this trade could have worked out any better. We're sitting basically near the all-time highs. And mind you, this would be an all-time high close for copper in the HGH6 contract, should it occur today. Take profit, wait for a pullback to the 1 week, and load up again is going to be my plan.
Yeah, copper, it looks really interesting this year. I think it's going to have a really good year. This move in copper, it dissuades a lot of, if there's fear in the economy, copper wouldn't be going up like this. It's just, I guess same thing with oil today. It's showing kind of a pro-growth tilt, even though, you get a manufacturing number that's under, it's just showing the optimism for this year, that we could have a pretty good year, I think. And I got out of my long copper trade last week. I was long via short put spread. I didn't get back in, of course, regretting that now. I didn't think it would rebound just as fast as it did, but this is a very strong move. 5%, the gap is closed now from that big pullback back in late September. And, now that kind of liquidity zone or that lack of liquidity zone is out of the question, I think we could rebuild, potentially a base here, or maybe just keep ripping higher. Either way, it's going to be something that I'm looking at getting back into as soon as I can.
I like that you bring up the volume profile. I wanted to go there as well in copper. You had pointed this out to me, so kudos to you. But when we started to break out and we started to make our move north of 550, you had mentioned that we were looking at a little bit of a zone where there wasn't much trading going on, and that may be a reason for a squeeze of sorts. It feels like that's played out here, like exactly as one might hope for if you were sitting on the long side. So as far as I'm concerned, new year, same markets, metals, they remain hot. The news over the weekend vindicates very much our macro thesis that's been helping the metals move to the upside. A fragmented world, you got to trust something else other than the dollar at present time. You're going to stockpile stuff if you can. And there's a strong reach for everything metallic today. We haven't traded platinum futures here. Unfortunately, there aren't listed options for platinum futures. But if you're trading this as well, if you were just doing it long the futures itself, it's a big trade to do, right? But if that's something people were trading coming out of last week or in December, it's up another 6.4% today. So the metals are doing the things that the metals have been tending to do. I think getting away from short dated exposure may be best, right? One of the reasons why I'm so adamant about like taking off the copper and the gold positions, and I'm thinking about it as opposed to really like, let's see if we can squeeze some more and have some fun with it, as we've done so many times, is because of this CME looming. They could hike margins again. And I just don't want to get caught in one of those like 1 or 2 day downdrafts on the other side of the decay curve, where then I'm almost like, I lost this money. Now I have to stay in this position to get it back. It's just not a headache I want, or an emotional state I want to be in, because it's not a good place when I'm there for trading.
Yeah, and I see on Twitter and stuff like conspiracies about they're raising margin to kill the rally, right? And it's really not about that. It's about protecting clearinghouses. And when you raise margin, what you do is you pretty much you reduce leverage. That's pretty much all you're doing, and it's to protect against volatility and positioning for them. Reduces risk.
Reduces risk. Hopefully we're through that. Oil up, nat gas down on Maduro. Oil was initially down last night. It came out of the gates up about 0.5%, then immediately sold off. Now it's bouncing back a little bit here today. The read through is that volatility's gone nowhere, 16.3. We hypothesized last week, and this has been a discussion point on the show since late November. Quite frankly, from the time I started putting on the trades in CL until now, crude has gone absolutely nowhere, because in the intermediary, buying $60, 61, 62 calls, the thing is selling off. So now we bounced back. Okay, so we're back to 58 and change after the U.S. has arrested the head of Venezuela, the country with the world's largest oil reserves. Why isn't this doing more? Wouldn't the arrest of like Mohammed bin Salman or the Ayatollah have a much more significant impact? Yeah, because there's different levels of input into global oil supply or ability to disrupt global oil supply. I know I've mentioned this stat before, Thomas. I've heard you talk about it, but it is worth reiterating for new listeners and viewers who are trying to figure out why oil isn't at like $70 today after Venezuela's president was arrested by the U.S. It's because Venezuela has really been a non-participant in the global oil market for the past decade or so. They were a country that was pumping 4 million barrels plus a day out of the ground in the early 2000s. And then a lot of mismanagement occurred. The state oil company never received what it needed in order to keep the machinery up and running. The funds were raided. It's like share buybacks instead of investing in R&D, except all the share buybacks went to the Chavez regime and all of his inner circle folks. And running a drilling business, E&P, Thomas, that's so expensive. We can look at these companies' balance sheets. The margins are like less than 10%. These are not cash cows. They're not Nvidias of the world where their margins are like 50, 60, 70% on these sort of items. So when you think about what's happened with Venezuela, there's been a lot of degradation. What about getting that supply out of the ground? Maybe $30,000 per barrel in terms of investment required to set up a permanent drilling operation, which means to get at least another 1 million barrels out of the ground. Oh gosh, that's a lot more investment that we're going to need. We're talking about the scale of tens of billions of dollars now just to boost production back to where it were, according to industry estimates. So supply isn't going to all of a sudden be flowing everywhere in terms of oil. It poses a problem for China, maybe for Russia in terms of where they're getting their oil from in the short run. It potentially gives the U.S. control or at least influence over the plurality of global oil reserves now outside of OPEC. There's a lot of different geopolitics there, but this being a big event that is disruptive to oil, there's so many more interesting things to trade. What does it really mean for the global order? That's a gold and silver story. That's not an oil story. I am curious, though, natural gas, right? Should have put on that trade, by the way, at the end of last week. Too bad this happened around the holidays. Those long calls in oil would have at least worked out this time. Natural gas here down 2.85%. It's no longer the 6% loss we were staring at earlier in the session, Thomas. I know the weather doesn't look great. Talk to me, though, about this big divergence between oil and gas on the other side of the Maduro arrest.
Yeah, I mean, we're going pretty low. It's intraday we've rallied a bit here, but still, it's we've gone down a little further than I expected. The weather's come in; it's given no support at all. Really, through now the early part of late January, where we have no chances for a big cold snap where it really increases demand in any substantial way. So, there's no excitement there. And of course, oil is going to react a little bit more to news out of Venezuela than something like natural gas is. Natural gas still, besides for the weather, still focused more on geopolitics in regards to Ukraine, Russia, not Venezuela.
Well, Thomas, it's about the darndest worst thing that could have happened to my natural gas position today. And this has just been such a terribly frustrating trade for me. I imagine it might be for some other people. Now, this position is going to be what? NG here. Yeah. I mean, it's a small loser over $300, but today off 130. I'm at 22 DTE. Like, this is the edge. This whole trade's been a disaster. But if we get a rally back to like even where we were on Friday, I can close it out at a smaller loss. If we all of a sudden have a great day tomorrow, a smaller loss, I'm going to hold on to it because we're technically sitting right at my strike. Not loving how this has been managed, not loving the price action here, didn't anticipate whatever this was, this $1.50 decline, this 30% decline, Thomas. Definitely not in my cards. Yeah, energy though, crude, that's the one for me. That still works. The directionally neutral stuff in crude, longer term, outside of geopolitics, what do we really care about? Oil's been chopping around, moving sideways to lower. That remains the path forward for now. We move over to the dollar here real quick, Thomas. It's a strong start for the month of January here for the US dollar. On the other side of this, and geez, everything's turned around during the show. The euro's back to flat. My mistake. Look at that candlestick. That's a nice looking candlestick there. Nice looking bounce at that 50-day moving average in the euro, which resistance all the way down until it becomes support here. Interesting, Thomas. Everything's turning the corner versus the dollar now as the session goes on, and the British pound is trading to its highest level that we've seen since mid-September. So old greenback here. It's been, again, earlier in the show, a dollar, okay, start to the year. Euro typically declines. That is not the kind of action that you want to see on a day like today. So is that more of the same as last year, Thomas? Gold and silver up, stocks up, dollar down. Continues to work, I guess. Maybe that's 2026 in a nutshell, happening all over again.
Yeah, I mean that's pretty strong rejection there intraday. I don't know. I think it will make sense to get long dollars sometime soon, but just not yet.
I know Ilya is going to bring this up, but you look at this just straight line on the chart, right around 98.75. Support, resistance, failure today, right at the 50, falling below the 1 month, falling below the 1 week. All three may have a negative rate of change come the end of today's session. Yikes, dollar. That's no good. Where do we find ourselves looking for tomorrow? What's next on the calendar? German inflation. Keep an eye on that euro. Big decline expected, 2.3 to 2. What does that do for the ECB? One Fed speaker tomorrow. And outside of that, not really a day that we care about in the US session. Tomorrow evening, once futures open for technically the Wednesday session, we're going to have Australian inflation data. So some things now coming back online, Thomas, particularly for the currency space tomorrow, as we start this new full week of 2026. But you know what? I've said enough for now. I will be back later on, sitting in for last call today and then for overtime. So if you want to hear more from me, here's your chance. Hour 5 going on, Thomas. It's a nice day. I have a lot on my mind after the holidays. It's a good day to talk. We're done. Dr. Jim's coming up next. That's right. Got to get it out. Dr. Jim's coming up next with From Theory to Practice. You're watching Tasty.
This is Jimmy. He's 55 years old, married with 3 kids and 3 grandkids, and he's been investing ever since he graduated from Central Michigan University, Fire Up Chips, over 30 years ago. And given how strong the market has been these past 3 decades, he's done really well for himself. In fact, his retirement portfolio just crossed over the $1 million mark. But he's stuck, earning the same old 7 to 10% annual gains from the market each year, and he's at the mercy of market volatility. With hopefully only 5 more years to work before he retires, Jimmy wants more control. He wants to take hold of his future and his returns. Well, my name is Jim Schultz. I'm a finance PhD, and I've devoted my entire professional career to understanding the markets, starting as a professor in academia, where I taught undergraduate and MBA classes, and also did my academic research solely focused on the markets. I've since been a practitioner in the markets, actively trading since 2007. For the purposes of this video, I'm going to be Jimmy. So I've had a great run in the market over these few decades, but now I want to really unlock the full potential of my portfolio. While the 10% average annual return that the market has given me has been great, I'm intrigued at the prospect of producing portfolio returns that are even higher than that. I've heard with enough skill and ability, it might be doable. And maybe even more importantly than boosting my returns, I'm very interested in reducing my overall portfolio risk. Being that I'm closer to the end of my career than the beginning, I want to be better prepared to handle extremely volatile conditions or big market meltdowns, like we had during the internet bubble in 2002, the financial crisis in 2008, the COVID crash in 2020, or even the trade wars and tariffs that we're experiencing right now in 2025. Well, whatever the reason might be for you or Jimmy, if anything about his story resonates with you, then you are in the right place. I'm going to show you how to begin to make the transition from a purely passive approach with your portfolio to a much more active approach that steps into the world of derivatives. And we're going to break it down into 5 simple steps as I take Jimmy through a first-hand example. And we start with step 1. Taking inventory of where you're at. I've taken the passive approach and it's worked out great, but it's important to remember that those 10% average annual returns are exactly that, an average. While the market does go up most of the time, it can also go down and sometimes seemingly out of nowhere, just like we've seen to start 2025. Well, that is what I'm trying to avoid. Until now, I have been simply buying and holding, absorbing whatever blows might come my way. But I am tired of this lack of control. I want to be more involved. I don't want to be so reliant on market direction for not only generating returns, but mitigating risk. Now, you may be just like Jimmy. You don't want to stand passively by, needing the market to move higher to hit your return projections. All the while, the performance of your nest egg seems to be directly tied to the next Trump tweet. You want to take control and add a brand new strategic component to your portfolio. Well, once you fully immerse yourself into the world of derivatives, all those things can happen. But before we dig into the real details, we have to progress to the next step in the journey, where we are now going to tap into all the tools that were available to you as a passive investor who was reliant on the market moving higher. Specifically, let's talk about the power of dividends and dollar cost averaging. Step 2, the tools you need. Now I'm ready for action. I'm going to ditch the purely passive approach, but to be fair, I have done really well as a passive investor over the last 30 years using the 3 Ds, direction, dividends, and dollar cost averaging. So naturally, there is still a part of me that really likes all these strategies. The thought of abandoning those long bias strategies completely has me feeling a little bit uneasy. Well, here's the great news. Continuing to collect your dividend payments or improve your basis through dollar cost averaging are both still very much in play. You're going to see that there will still be a home for you to carry some share positions in your favorite stocks. And even in the options portion of your portfolio where you might not own any direct shares, any dividends that the company might pay automatically get factored into the option pricing. For example, if instead of buying stock in Apple, you decide to use a short put position, which is a classic option strategy, you are still going to collect any upcoming dividends that Apple might pay with that short put strategy. This happens because you're able to sell the put for a higher price based on the simple fact that the extrinsic value moves higher due to the dividend itself. But all of that is way beyond where we want to go here today. Not to mention, we've already done a video that covers all of that in depth, and you can watch it right here. But what about dollar cost averaging? Well, I learned early on that it was a great long-term strategy to add to my investments in individual stocks or broad-based indexes when the price of those stocks or indexes was falling. If the company was solid or the overall economy would be strong again, then I knew there was a really high probability that the stock prices would recover. Well, with derivatives, high probability trades are at the core of what we do, and here's the best part. It happens right at trade entry. You don't need to wait for the stock to drop or things to go south. You start improving your basis right from the very start. Now, I'm very happy to hear that both the returns from dividends and the spirit of dollar cost averaging can be alive and well with the option strategies inside my portfolio. But now, I'm even more intrigued to hear about how I can actually make money without needing the market to go higher and without being so reliant on market direction. That sounds crazy to me. Well, both you and Jimmy are in luck because that is exactly where we're headed next. Step 3, trading time and volatility. Now, I have to be honest, this completely blows my mind. I was under the impression that to make money investing in the stock market, you buy stocks and you need a move higher in the stock to make money. Well, it turns out that's not necessarily true. It's important to understand that in the world of options, any position you might have can and will make money from 3 different parts: direction, time, and volatility. So let's start with direction. Now, working through all the inner workings of calls and puts and option pricing is way beyond our focus here, and we can't get into it in this very video. So I would encourage you to watch this video right here. For the sake of Jimmy's goal, we want a broad overview, and it works like this. There are option strategies where if I'm bullish, I benefit from the stock price going up, and I'm hurt by the stock price going down. So very similar to being long stock. There are also option strategies where if I'm bearish, I benefit from the stock price going down and I'm hurt by the stock price going up. So very similar to being short stock. But here is where things get interesting. With options, if I'm bullish, I can set up a strategy that benefits from the stock going up, but can also make money if the stock goes nowhere, and even possibly make money if the stock goes down a little. And similarly, if I'm bearish, I can set up a strategy that benefits from the stock going down, but can also make money if the stock goes nowhere, and even possibly make money even if the stock goes up a little. And the reason we can do that is because with options, we're not only trading direction, we're also trading time and volatility. You see, with options, there are various components to an option's price. The underlying stock price of the stock the option is on is a component. The risk-free interest rate in the economy is a component. Even the dividend that the company might pay is a component, just like we saw in the last section. But one of the largest components to an option's price is the time that is left on the option contract. Every option contract expires on a specific date. So some contracts might expire in 7 days, some might expire in 45 days, and some might expire in 360 days. Simply put, the more time the option contract has, the higher its price. As time passes, the number of days left in the contract decreases, and so that time value follows suit and also decreases. Here's the best part. You can play any directional bias you want, but you can also play time along with that same strategy. More specifically, you can benefit from the simple passage of time. As the days go by and the time value dissipates from that option's price, it helps the P&L on your position. Now, for our strategy examples coming up, we're going to focus exclusively on time, but it's important that you're made aware that you can also trade another non-directional metric, volatility. Now, volatility does share a reliable relationship with direction, but we'll leave that discussion for a future time. For us, we want to understand that much like time value is added to an option's price, a volatility premium is also added to an option's price. And also very similar to time, more volatility means higher option prices, and lower volatility means lower option prices. This will come as no surprise, but this video right here explains volatility in great depth. But for our purposes, here is what we need. Market volatility moves up, it moves down, it moves all over, just like everything else in the market. But generally speaking, on average, volatility is in a state of contraction, so it's moving lower. And just like we did with time, we can set up option strategies to take advantage of that natural volatility contraction. But now you've got to be wondering, all right, I see how time can help me, but I still can't for the life of me understand how I can make money without being directionally right or even being directionally wrong. Well, that's where we're going next. Step 4, strategic breakdown. So let's unpack 3 different strategies, starting with a covered call. I'm used to owning stock, and one of my favorites over the years has certainly been Apple. Well, the beautiful thing about a covered call is that it starts the same way that all of my positions have started, with long stock. The difference is, on top of that stock, we're going to add an option component, specifically a short call. This is what is called a covered call strategy. Let's suppose I own some Apple that I bought earlier this year for $180 per share. Today is April 9th, and right now in the option market, I can sell the 200 strike call in the May cycle that is 37 days away for $2.50, which is $2.50 per share, or $250 for the whole contract, because option contracts are always in 100 share allotments. Now, a key part to understanding how a covered call works, or really any short premium strategy, is this. If the stock price is above the strike price on a call, the call is in the money, meaning it has value. But if it's below the strike price on a call, the call is out of the money, meaning it is worthless. If the stock price is below the strike price on a put, the put is in the money, meaning it has value. But if it's above the strike price on a put, the put is out of the money, meaning it's worthless. And when you sell options, you always want the options to be out of the money. That is because that allows you to keep what you sold it for. So back to my covered call. Let's explore 4 simple scenarios by May expiration. Apple goes to 160, Apple goes to 200, Apple goes to 220, and Apple stays right at 180. If Apple falls to 160, then I'll lose $20 per share on my stock, but my short call will expire out of the money, so it will be worthless, which means I'll get to keep the $2.50 I sold it for. So my net P&L is improved to only losing $17.50, which is good. If Apple rises to 200, then I make $20 per share on my stock, and my short call expires exactly at the money, which is the same as out of the money at expiration, which also makes it worthless. Again, this means I'll get to keep the $2.50 that I sold it for, so my net P&L is improved again up to $22.50. also good. If Apple rises all the way to 220, I make $40 per share on my stock, but now my short call slows me down because it is in the money. I do get to keep the $2.50 I sold it for, but now the short call loses the difference between the 200 strike price and the 220 stock price. So again, my net P&L is plus $22.50, which is good, but not as good as it would have been if I just held the long stock only. But lastly, what happens if Apple stays at 180? It moves around, up and down, sideways, whatever, but at May expiration, it's right back to 180. Well, I don't make or lose anything on the stock, but again, my short call expires worthless, so I get to keep the $2.50 per share. So in other words, I generated a positive P&L on my position without needing the stock to go anywhere. And that, my friends, is the power of options. Not to mention, I also improved my net P&L in 2 of the 3 other scenarios too. Okay, so next up, the vertical spread. And specifically here, we're going to talk about a short vertical spread using put options. So this would be a short put spread. Let's use Tesla as our example. Here, I won't have the familiarity of long stock to lean on, as my position will be solely options. But I'm bullish on Tesla, so I want to set up a short put strategy in the May cycle with 37 days to expiration. To do that with Tesla at $250 per share, let's say I set up a 225 220 short put spread that I'm able to sell for $2 in the May cycle. Now, an important aspect of short vertical spreads like the one I have here is that my maximum gain is always whatever I sold the vertical for, so $2, and my maximum loss is always the difference between the width of the vertical and what I sold it for. So $5 width minus $2 credit, or a $3 max loss. So let's work through 4 different stock price scenarios. Tesla rises to 300, Tesla stays at 250, Tesla goes down to 230, and Tesla goes down to 200. First, Tesla rises to 300. In this scenario, this short put spread expires out of the money, so it's worthless, which means I keep what I sold it for, and my P&L is plus $2. Next, Tesla stays at 250. In this scenario, again, the short put spread expires out of the money, so it's worthless again. I keep the premium, and my P&L is plus $2. Next, Tesla falls to 230, so it went down when I wanted it to go up. But here's the crazy thing. Again, the short put spread is still out of the money, so it's worthless. I keep the premium, and my P&L is plus $2, even though I was wrong about the direction of the stock. And lastly, Tesla falls to 200. In this scenario, the short put spread is fully in the money, so this trade would be a loser, where I would lose the most I can possibly lose for a P&L of minus $3. Now, as you can see, I'm not hitting home runs when the stock moves in my favor in this Tesla example. Not at all. But it's pretty crazy that I'm able to make money when I'm wrong on the stock price direction completely. Well, that is exactly what we meant earlier when we said you're able to benefit from the passage of time. When you sell out of the money options, if they stay out of the money, then you are able to allow that time value to drive your ultimate P&L. So now, the third and final strategy, the short strangle. Here, let's say I want to do an option strategy in Starbucks. And for this one, I don't think Starbucks is going to move much between now and May expiration in 37 days. So I want to set up a strategy that is a pure time play. It could be a volatility play too, as we alluded to earlier, but for these examples, again, we're just focused on time. So with Starbucks at $95 per share, let's say I sell an 80-110 strangle. So an 80 put and a 110 call in the May cycle with 37 days to go for a $4 credit. As long as Starbucks stays between 80 and 100 at May expiration, both options will expire worthless, and I'll keep my $4. So that means it could go up to 105, it could go down to 82, and it could do everything in between. It won't matter to me, and it won't matter to the position. As the time value comes out of the option by expiration, I will make the $4 profit from time alone. But here's the catch. Anything above 110 or anything below 80, that's where my risk is. And even more specifically, I have an unlimited amount of risk on both sides. Now that right there, you might be thinking, man, I am out. I am not interested. No thanks. Well, that makes sense because you're just getting started. I just wanted to take the opportunity right here, right now, to introduce you to the short strangle because it continues to be one of the most popular and effective strategies that experienced traders use every single day. And you yourself are probably striving to become an experienced trader one day. For now, though, there's no rush. This is not a competition. Start with covered calls and then move into vertical spreads. There will be plenty of time for other strategies like short strangles sometime down the road. I promise you, covered calls and vertical spreads alone are going to keep you plenty busy. All right, so next up is the final step of this whole crash course, where we are going to work out some different ways that you can break down your total portfolio and show both you and Jimmy how you can split up your assets between a passive approach and an active approach. Step 5, portfolio allocation. So now I'm beginning to equip myself with more skills to attack the market from a variety of angles. I can trade time and I can trade volatility in addition to direction. But to do that, we have to figure out how are we going to split up our assets. More specifically, what chunk, what percentage of our assets are we going to keep doing what we've always done, and what percentage of our assets are we going to devote to this brand new derivative strategy? This is a really important question to answer, and here's the most important thing to keep in mind. You don't have to go all in with 100% of your assets into an active approach in the derivatives market. Definitely not when you're just getting started. It's understandable that shifting away from a passive, long only bias in the market that has done you so well for so many years is going to take some time. But practically speaking, what might some asset breakdowns look like? Well, if you remember, my retirement portfolio just crossed the $1 million mark. And in addition to that, I also have a $100,000 brokerage account that I might use to play a hunch from time to time. So in my situation, the starting point here is easy. While I'm certainly intrigued at the prospect of not having to be passively long all the time, I'm still confident that the upward trajectory of the market will continue to some degree or another. So I'm going to start with my $1 million retirement portfolio, still doing what I've always been doing, long some market indexes and some of my favorite stocks, but I'm now going to devote my $100,000 brokerage account to a more actively managed approach that focuses on derivatives, just as we've been talking about today. So that means that $100,000 of the $1.1 million total, or about 9% of my assets, will be actively traded, and 91% of my assets will continue to be passively invested. This is a great start. And over time, as I gain more experience and my skills improve, I suspect that that ratio is going to shift in favor of more assets being actively traded. But maybe you have a $500,000 retirement portfolio and a $200,000 brokerage account, and you want to devote more assets to the active approach now. Again, I think splitting up the approach to whatever is in your retirement accounts to passive and whatever is in your brokerage accounts to active makes a lot of sense. So here you would be about 29% active and 71% passive, so still the bulk of your assets passively invested, but a much bigger chunk devoted to the active approach. Or maybe you have a $200,000 retirement portfolio and a $40,000 brokerage account. Again, with the natural split of retirement assets into passive investments and brokerage accounts into active trading, you're looking at about 17% active and 83% passive. Of course, you don't have to do it this way. You don't have to use your retirement accounts for passive funds and your brokerage accounts for active funds. You can certainly do it a different way. You could even mix it up if you want to. But when you start to learn about things that we were not able to cover in this course, with buying powers and margins and things of that nature, it does make sense to begin with passive funds in the retirement accounts and active funds in the brokerage accounts. There are many, many, many ways to split this up. But whatever you decide, here are some important things to remember. First, by keeping some amount of your assets in passively invested positions, you'll maintain the familiarity of what you've been doing your entire investing career. So playing the natural market drift higher, collecting dividends, dollar cost averaging, all that stuff. Second, remember the strategy I suggest you start with for even your active stuff is the covered call, which we introduced just a little bit ago in this very crash course. So even within the active portion of your portfolio, you'll have that same familiarity of long stock. From there, you can grow into vertical spreads, possibly even short strangles down the road, and many, many other strategies. But lastly, again, do not forget, this is not a race. This is not a competition. The market will always be here. So don't go fast just for the sake of going fast. And don't dive into the deep end before you've even dipped a toe into the water. You're going to mess up and you're going to make mistakes. So ease into the active approach little by little and only do it as you are ready. And I'm here to help you as much as I possibly can. So please, you can always email me. I'm jschultz@tastylive.com, or we can connect on X @jschultzf3. But now, where do you go from here? Well, given the nature of this crash course, there were so many things that we were not able to unpack, that we were not able to dive deeper into. And so, if you want to use this crash course as a catalyst to improve your skills and improve your abilities, then I would strongly encourage you now to dig into the live show on the Tasty Live Network, dig into the archives, and maybe possibly even check out some of the other crash courses that are already available on the network and on the YouTube channel, such as the one that dives deeper into what it means to begin to trade options, and it happens to be starting right now. As a kid, I used to always tell my mom, I think I was born with speed and intelligence. She still reminds me of that. And I'm like, yeah, I definitely have no speed. But on the intelligence side, I think I figured a couple things out. My mom was a stay-at-home mom, and my dad really provided. He was a very blue-collar worker. In fact, my family lived paycheck to paycheck. And so I saw that. I actually said, I want to be financially independent one day. For the better part of my undergraduate career, I was convinced I wanted to be a stockbroker. I actually worked an internship at a major financial advising firm, and they offered me a job. They said, Jim, just go graduate, come back. But then I actually had an experience. So for all 4 years of my college career, I tutored students in accounting, economics, and finance. And most of the time, the students would come to me and basically to do their homework for them. And I would usually send those people on their way because I wanted people that really wanted to learn. Senior year, young girl comes to me. Her name's Carolyn. She needs help in microeconomics. She is completely lost. Her graduation hinged on her performance in this class. Obviously, she wanted to graduate, but I could feel this natural desire, this yearning to actually know and understand the material. I mean, I had to explain marginal revenue to her at least 38 times before she finally got it, but she got it. We go through the whole semester, we say our goodbyes. A couple days later, I'm standing outside waiting for my friends to come pick me up. I get a phone call and I missed it, but I felt my phone buzz to tell me I had a voicemail. And I looked down and it's from Carolyn. And literally, that 60-second voicemail changed the entire course of my life. So she basically said, Jim, I just want you to know that I'm gonna graduate this Saturday, and I'm only gonna do it because of what you did for me. I'm only gonna do it because of the patience and because of the time that you took with me. I never would have made it without you. I will never forget what you did for me. I hung up the phone, and I had a feeling inside of me that I'd never felt before. And I said, wow. I said, I need to explore this. I canceled plans with my friends immediately. I went to the computer lab. I started researching PhD programs. I said, I want to have more of this experience. I said, I think this may be what God wants me to do. Most of financial media is all based off of story and direction. And it's really interesting because it's either you try to find the story to predict the direction, or after the direction happens and you realize you didn't know anything to begin with, you find a story to attach to the direction in a very ex-post type of way. We acknowledge, we own up to the fact that nobody knows anything from a market direction standpoint. So what do we know? What can we rely on? And it's the math, the statistics, the probabilities. It's changing the landscape of investments forever. And to be a part of this team, I count that as a tremendous blessing.
What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind the trade entry, trade management, and the closing order. In this video, we are going to cover the crab trade. All right, let's get into a new position here, something that just launched options and is obviously the talk of the town right now. We're going to be looking at Bitcoin via IBIT, which is the iShares Bitcoin ETF. It's had incredible liquidity in the launch of its options, which launched yesterday. The ETF is obviously at highs with Bitcoin here at 95,000. It's the highs of the year. It's a tough time to get some long delta, but I think it's an interesting play just because of how much skew there is on the upside here. So an easy way to look at skew and view skew, you can pick any expiration you'd like. Let's just go to January. With the ETF at 54, let's go 10 points out of the money and look at the 44 puts versus the 64 calls. These are both $10 out of the money. You can see that the call is trading at $3.10 versus the put at $1.45. So there's almost a 2-to-1 skew to the upside in terms of option premium, which means that it's more expensive to speculate in the upside versus speculating in the downside. It doesn't necessarily mean it will go up. It certainly can. It just means that the value and the perceived velocity of risk is to the upside in this ETF and in Bitcoin in general. What that lends itself to is anything with a ratio type position. And what I mean by that is, like, if we did a ratio spread, let's say we go to the at the money strike. The ratio spread on the upside that you do for basically nothing is going to trade much wider than on the downside. So you can see this is 10 points wide. If we do this on the downside, we'll use the 54 strike. You'll only be able to go really $6 wide for that same sort of value. So $10 wide ratio on the upside versus $6 on the downside for a zero or basically negligible amount of credit or debit. So there is certainly upside skew here, which should not be a surprise to you given the move that we've seen. So I'm going to do a ratio, but I'm going to do my crab trade, which is buying a long option further out in time, closer at the money, and selling two options, shorter duration, further out of the money against it, and then buying the wing just to define the risk. So the way we would set this up, I typically go to around a 40 delta. So let's say we'll go into January, we'll do the 60 strike call here for our long option. In December, we're going to sell two of around the 20 delta short options. To make this an even kind of $5, I'm going to go to this 65 strike call. So we're going to sell two of those. And then you could see this usually about $2,400 in buying power, which is a little bit too rich for this account. So I'm going to go and buy a wing just to cap the risk. So my risk here is really to 70. I'm going to use this wing as just a capital efficiency wing rather than a defined risk wing. So for me here, I want to cut this buying power down to somewhere around 1,000. And I could do that by going to like the 80 strike or even the 75 if I wanted to. The 75 strike would cut it down to $687. So using a little bit more buying power, if I had gone to the 70 strike here, this would make it a buying power equal to the debit paid on this position because I'd be 5 by 5. I'm going to widen it out a little bit, collect another 20 or 30 cents on this trade, synthetically selling the spread very far out of the money just as a way to do this a little bit cheaper. So it essentially sets me up, if we stay out of the money through the duration of the short options, this 30-day duration. If we stay below 65, I'll basically own that call in January for $1.83 here. A cheap upside shot here with a little bit of positive decay, as you can see, theta of $2.70 here, because we are selling, almost $3 of value in this short duration. So we'll see if we can get filled here around mid price. You usually have to go up here just because these trade like in nickels. So I think you can get filled in penny increments, but the options themselves, one-off options trade at nickels. So let's do it. All right, so we got filled at 189 on that upside crab trade. Just to give you an idea of what that looks like on the analysis mode here. We can add this Theo mark in our analysis. We can move time, and you can see how our profit and loss will change as we pass time. A little bit of a buffer to the downside, definitely some profit potential to the upside here. But you'll want to stick around because we're definitely going to have to manage this trade coming up here shortly. Market's up to 6,100 here after CPI, big move, but the story of today is Bitcoin getting back above the 100,000 per coin mark. We're at 101 here on the Bitcoin futures spot, in a similar spot here. I've been trading IBIT, which is the Bitcoin ETF. It is back to 57.26 right now, and we have some long delta here, which has worked out for us. So when we look at the analysis here, you have this upside profit potential because you have this long option that's closer at the money, shorts are further out of the money. One of the benefits of a crab trade is that you're selling short-term premium. And so when we sold these options, we sold the 65 calls. When we sold these, we sold them at $1.47. They're now marked at about 30 cents. So we've gained almost $2 out of those short calls. In contrast, we've lost some money in our 60 strike call, which has been out of the money basically the whole time. We bought it at $4. It's currently marked at $3.55, but that spread is what our profit has been on the position as a whole. So if you remember, we had the $3-ish of credit that we sold. We've captured basically all of that, $2.50 some odd cents. We've lost about 70, 80, 90 cents on the long option, and we've netted out $120 P&L here on just $189 of debit on entry, and that this trade was risk defined. So it was the risk was equal to the max debit. As if everything expired out of the money, you would lose $189. We're going to end up making a nice little return on capital here. So we can actually close the position right from the order chains here. You right click, you click on the closed position. We'll want to go to full, which is all of the legs of the trade. We're going to try and get filled as a package. The 75 strike long call is a tough fill because it's a nickel at a dime ask. So it's very, very, it's a very cheap option. It's very hard to get filled on some of those within the package, but we're going to try and do it all together here. We're going to try 309 and see if we get filled on this to just close out of that buying power. 302. No, we're gonna go to an even $3 and hopefully we get filled here. $3. All right, so we got filled on that crab trade, a nice little trade in Bitcoin or playing Bitcoin in a smaller sized account. Made $111 on that upside crab trade. Great trade there for the boys and girls. I love to take risks. I love the instant pain, the instant gain of trading. I would describe my trading style as a calculated risk taker. I like to play towards volatility, which is something that you can quantify high and low points of. My favorite strategy currently is the diagonal spread. I like the idea of having defined risk, but while also having a little bit of positive decay that works in your favor if you're not directionally correct. But the best part about it is the positive gamma that you get from it. I really like that the position can grow and get bigger as you're more correct on that position. So I think that the variable of trading on a day-to-day, hour-to-hour, minute-to-minute basis is really powerful and really fun to have access to.
Woof! The first half of this year's market has been giving the good guys the business.
It's certainly been back and forth for sure, Pete, and I'm getting whiplash over here.
With good mechanics, we can see Team Tasty stay strong in the second half.
Absolutely. Let's check out our starting lineup.
Tony Bat Batista, the John Jay College of Criminal Justice. Number 69, because it's one standard deviation plus one. And you know, I'm the Bat.
John McLaurin, Wisconsin. Number 2, because I'm Beth's right-hand man.
Vanetta Logan, the Indiana University. Number 3, because that's how many shots of bourbon it takes to make it through the first hour.
I like the looks of that lineup.
Well, be mechanical is always better than just trying to run plays and see what sticks, Pete.
When you got skin in the game, you stay in the game.
That's right. Now get off the couch and get into the game.
Watch Tasty Trade.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Clip thy waxen wings, thou economic Icarus. Discard these feathery adornments, thy flight's too vigorous. Rather, garb thyself with the soft fur of the bear, and dwell in low burrows of the valley fair. Forsake thy previous highs and perilous summit, for lo, I am short, so I must needs thee plummet. O market, I implore thee, make no high. Like some comic Fozzie, unclip thy bow tie. If thou dost tumble, I shall offer thee up a succulent hoagie. So, ye markets, remain as bearish as beloved Yogi. Follow thee the lead of Kipling's Baloo, and may the move be sweet as honey to Winnie the Pooh. With joy I watch descending chart lines straighten, run down with quickness and sweetness, like Lord Walter of Peyton. Let curious traders admire thy Berenstein way, and joyfully stealing some porridge, let us now say, sweet bearish market, never would I cage her, but admire her drop like some terrestrial Ursa Major. Come down, ye markets, to this sylvan glade, and let the bears have their day at Tasty Trade.
Having trouble understanding what your trader buddies are saying? Here is what they mean when they say slippage. Every business has costs. Slippage is in reference to the cost to transact in the market and is most associated with the difference between the price you can buy and the price you can sell at for options or stock. If you can buy at $1 and sell at 99 cents, you have 1 penny of slippage. If you can buy at $1 but sell at 90 cents, you have 10 cents of slippage. The more slippage between the prices, the more likely it is to lose out on value when opening and closing positions. This adds up over time. That is why liquidity is so important.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Hello, everybody. Happy 2026. This is Tim Knight, and we begin a new broadcasting year. As I said the last time I saw you about a week ago, I actually don't remember how many years I've done this. It's basically been from whenever Tasty started. But we are here to talk about charts, and I'm kind of like a weatherman. I talk about what's going on and try to look somewhat into the future about what I think is going to take place. It is a green day. In a way, it's kind of the first trading day of the year. I realized that on Friday we did have a regular trading day, but it was thin volume and not much going on. That changed over the weekend with Venezuela and Maduro, and everyone was kind of waiting to see, like, well, how will the market react? Weirdly, they embraced it. There were some unusual reactions. The least unusual one kind of ties in with my overarching theme that I've repeated so many times last year, which is bullish precious, bearish equities. Bullish precious continues to do great. Bearish equities ain't doing the right thing just yet, but I hold out faith. And it's all predicated on those ratio charts that I showed again and again and again, which essentially suggests the chart's going way lower. That is to say, precious divided by equities. So what would it take for that to transpire? And it's already transpiring. The ratio charts have broken a while ago and are plunging. What it takes is either ascending precious metals prices, got that, or plunging equity prices, don't have that yet, or some combination of the both, which is what I hope happens ultimately. So the ratio charts have worked out great. There's no waiting involved. Those broke months ago. Equities are still being stubborn, with the Dow heading close to 50,000 at this point. When I started trading decades ago, I thought it was very odd because the Dow was like a few thousand points and the Nikkei was like at 40,000, which I thought was very strange for anything to be that high. Well, time has moved on, and now we've got a crazy Dow on our hands, and the Nikkei is not doing that poorly either. So here we are, and I've got some charts ready for you as I've kind of pre-assembled them before we jump in. So let's jump in. And we begin with a spider. And equities are basically up about 1% to 2% on the big indexes. The spider's up about 2/3%. This line is kind of slightly interesting in as much as we had a breakout, it continued, and then it sort of flopped, and we've tried to push back toward it, and when we've been sort of stalled out there. So there's nothing like explosive going on here. We're at the same price now that we were many weeks ago, actually back in late October. So I'll just say it again. We're at the same price now that we were in late October. A lot of tremendous amounts of smoke, very little in the way of real fire. That is not the case with the Dow. If you look at the diamonds, the Dow Jones Industrial Average ETF, it is exploding. Lifetime highs on this. We have blasted well above, well, you can see here, I mean, we're up 1.41%, hundreds and hundreds of points more on the Dow. And as I made mention, 50,000, we could be there this week, we could be there tomorrow at this rate. But for whatever reason, the Dow component's doing very, very well. For example, Goldman Sachs, which is an ancient firm, but actually hasn't been public that terribly long. And, you know, the idea of it being a public company a few decades back seemed bizarre. But no, it's been a sensational stock for a long time. It's approaching its own quadruple digits. And today it's at a lifetime high, 4.21% on GS. So Goldman Sachs is doing just fine. Thanks so much for asking. Also, it's not just the US. In fact, last year, overseas markets beat the US quite handily, and the beating continues. Here is EEM, the emerging markets. I believe this is a lifetime high, up over 1%. And by way of example, and something specific, Japan, ETF EWJ, is up 2.21%, vaulting higher. And Korea, South Korea, obviously, EWY is up 2.38%, lifetime high on that one too. So strength all over the place. I'm sure there's probably some obscure instruments that have something to do with Venezuela. I don't know. I don't have them, and it's kind of irrelevant to this show. But the majority of assets of any stripe are pushing higher today, especially precious metals, which we shall now turn our attention to. Let's start with SLV. This is the silver ETF. And I was looking through my old posts, like when did I get really hung up on silver? And I found if there's a date that I could mark, it would be October 2024, right around here. I found a post I did, which was just unmitigated bullish on silver. And it was frustrating because it broke out and then it sort of withered away again. So silver spent months just grinding away and just getting people excited and then dying down again. It was kind of maddening. In retrospect, we could see that all stopped after the Liberation Day business. And since then, it's been pretty persistently higher. But for example, PSLV, the Sprott Physical Silver Trust, I did a post in October about that, and the post was titled "Silver Has Launched." And like I said, long term, that was very true. It's up about 150% since then. Shorter term, it was maddening because it just kept kind of flopping on itself. Most recently, it's been kind of crazy as well because there was a while here it was just up pretty much every single day. And the tippity top was on Boxing Day, the 26th. Since then, I think some people have probably been pulling their hair out, bulls and bears alike, because it keeps kind of flipping. It plunged the next trading day. It exploded the next trading day. It plunged the next trading day. And then it opened strong and closed weak. And now today, of course, it's soaring. So we're up 5.1%. We are in the vicinity of lifetime highs. We've seen 3 trading days of that. But the clean trend certainly isn't there anymore. It's very noisy. So we have a very clean uptrend here, and then a lot of noise, and a clean uptrend here, and now we're back into noise land. You can only take Maduro once, so we're not going to see, today's kind of unique in that respect. But, ultimately, I think that precious metals will continue to have a great 2026. But things are still very, very lofty. The kind of digestion phase, I don't think has taken place. So, long term, I've never shunned metals at all, but short term, I'm kind of mystified they're this strong. The only position I have is just the physical bullion I've held on to for decades. It's inconvenient to get rid of it, which is great because I'm lazy and it'll just kind of stay socked away. But in terms of any precious metal positions, today I took a teeny dust position just for fun, but otherwise nothing. There is, as I've mentioned, a miners ETF specific to silver, which is SIL, and it's up to, it's got a little shooting star going on here. This is up about 4%, but not exactly poised for great success here. I could easily see this sinking in the days ahead. Silver's just been, the RSI is at record levels. The sentiment is at record levels. What else? Silver's up 150% in a little over a year. Everyone's crazy about it. At some point, you're going to get some selling going. It just doesn't seem to happen. Gold ETF GLD is a better looking chart. I mean, if I was forced, for whatever reason, to buy either silver or gold, I think I would go for gold just because it's a cleaner, more substantive chart, even though the percentage move on silver tends to be more outsized these days. So there's GLD looking pretty good. If we slip below this line again, it's going to look kind of messy. This is, at the moment, nicely positioned. And if you told me gold will be 5,000 in a week, it's not out of the question. I certainly think it'll do that this year. But today, I don't know, it smells a bit like a one-hit wonder to me in terms of this powerhouse move by precious metals. The miners for gold, GDX, obviously also up. As with SIL, we're well off the highs of the day. And it's not quite as clean a chart, but just as GLD is a better looking chart than SLV, GDX is a better looking chart than SIL. So that's looking pretty good as well. And we're in the vicinity of lifetime highs on that one also. In terms of the kind of the secondary precious metals, our old friend palladium, PALL, is also up nicely, 4.35%. very sketchy looking chart, not nearly as nice as gold, and I'm not touching it until such time, which may take weeks, that it seems to have been kind of beaten down to an attractive price. It is not in that condition at this time. And the platinum ETF PPLT, I'd say even more so. What I just said about palladium. This is up 5.79%, and it's had a fantastic time, but it's this is thinly traded. They tend to be very, very volatile, which can be good or bad, and it's got a lot of empty air between present price levels and what I would consider good firm support. And even it's not just precious. Even more like industrial and base metals are doing very well. The companies that find this stuff, Alcoa, 8.83% gain. AA. This is, I believe, a lifetime high. It has had an amazing time here. Going back to just 9 months ago, it's up hundreds of percent. Well, not hundreds, but well into the triple digits, just about tripling in price. Yeah, that's hundreds. An aluminum company isn't exactly one you would think would be setting the world on fire, but it is. So AA is doing sensationally well. And another aluminum firm, CENX, also having a great day, 7.41%. You may not know this, but aluminum used to be more valuable than gold. I don't remember when that changed, but aluminum was very, very hard to, don't know the terminology, don't think it's extract, but suffice it to say the metal aluminum used to be very precious metals, and now you just wrap your roasted chicken in it. Over in digital land, at long last, Bitcoin is getting a break, as all cryptos are. Bitcoin had been beaten down into the 70,000s level just about. We got down to, around, this to be fair, about 80,000, from like 125 down to 80. And it just sort of meandered around for a while. And just in the past couple of days, it's had a very strong run. Today it's up almost $5,000. And I'll just trot out once again my resistance level of about 98,000. We never got there back in these days. So I was sort of wondering if we'd ever see it. Maybe it's coming. I imagine a lot of this strength is driven by the geopolitical events going on around us. And so we're getting a rally there. But like I said, I don't think we're going to cross into the six figures once more, at least in the foreseeable future. But crypto-related equities that had been getting just beaten in the dust are having a kind of a relief rally. DFDV, DeFi development, up almost 24% on the day. Long-term still bearish, but it's getting a nice pop on the day. And then CIFR Cypher mining itself up about 12.7%. So yeah, bounces all around. Weirdly, you would think that, like pre-market, Chevron and Exxon and ConocoPhillips, they were all doing fantastic with this Venezuelan news. They're actually down. Well, XOP is actually down on the day. Very strong open, and they're just fading for most of the day. So one of the surprising outcomes there. True to form, I see we're getting close to the end of the show, but you know what? Let's just add a few more symbols to go. We'll just end on semiconductors. This is SMH, which is at lifetime highs. And there was a lot of strength with ON and MU and AMD and Nvidia. It's the key here is, can it hold above this line? We've broken out, we're at lifetime highs, and AI is still driving 99.9% of all of this, but it's got to retain that breakout in order to be a plausible rally. So we'll see. Today's an odd one. So we'll see how kind of things are shaking out tomorrow. Okay, bottom of the hour. I better go. But again, Happy New Year to you. Look forward to sharing it with you together. And I'll see you here tomorrow. Good night.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the board. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
In the world of investing, a beast lurks between the numbers, ready to pounce. Some traders hide from it, some ride it. If that's you, join us on Tasty Trade. Genius loves company.
Ring the alarm, boys! Turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
Jamal, we are back. It's last call time. It's Tasty Live. It's 3:34 p.m. Eastern here in New York, 2:34 Central Time where Jamal is. Happy New Year, buddy.
Happy New Year, my friend. What do you think about this first trading? I'm calling it the first real trading day of the year. What do you think about this today? I mean, everything is on the move. How about it?
Silver's up, gold's up, so feeling pretty good about things. How about yourself?
I feel like silver has been the first word out of your mouth for the past 3 months. In general, like when I started a conversation with you, hey, Chris, how's the baby? Well, silver is doing this, and the rattle is the rattle silver? I mean, what's going on? What's the deal?
Oh, I changed his name to Silver. I didn't mention that on there?
No, I didn't know that. No, I didn't know this. I wouldn't be surprised.
Oh, yeah. I mean, can you blame me? September 14.5%, November 18.7%, December 23.5%. Any one of those would be a good year. And
yeah,
that was just September, November, and December.
Yeah, it's been a heck of a run. There's no doubt about it. And it's obviously been outpacing things. It's really the main thing to talk about over the last several weeks, really. That being said, it looks like markets don't want to be left in the dust. I mean, it looks like they're trying to mount a little rally here today, contrary to what we saw on Friday. So nice little harbinger, I would say, for maybe the rest of the month. Who knows?
Hopefully. Are we coming to the end of the Santa Claus rally window? That's correct. December 23rd, SPX closed at 6909.79. Technically today we get a positive Santa Claus rally window if we close through that area, and that's 3 points from here. ESH6, it's a little different. The 23rd close was 69.61, so we're about 13 points off, roughly 0.2%, a little bit under. But it's been a pretty good day for stocks considering the weekend news here, Jamal. Of course, if you've been watching any of Tasty Live today, you probably heard me say that the United States arrested Venezuelan President Maduro over the weekend. Ultimately, we find ourselves with stocks trading to the upside at the start of this year. It's really the first official day back. Most traders took off the past 2 weeks. It's a good bit of price action here in stocks, though, Jamal. The volumes may not be heavy, but the volatility is staying in. That vol futures curve is in that steep contango. But let's do a quick rundown here before we get into all of that, of course. S&P right now sitting higher by about 0.7%. NASDAQ 0.85%. Dow Jones 1.4%. And the Russell 7% respectively. Bitcoin and Ethereum likewise having pretty good days. Bitcoin up 5% and getting close to that key 95,000 level. Ethereum getting close to 33,000 here on the charts. Of course, the attention goes to what happened in energy markets resulting from this weekend's events. And we see crude up about 1.8% right now. Is that really all there is to the rally, Jamal? You and I will talk about that in a little bit. And maybe we shouldn't be paying attention to crude itself and its diminished volatility, but instead paying attention to some of those oil companies, your Chevrons, your Exxons, your Schlumbergers of the world. Elsewhere, though, gold, silver, hey, that's the news of the day, where gold and silver warding off those CME margin hikes, as it were. Maybe another one's coming down the pipeline. Can't dismiss that possibility as we see significant rallies once again on the other side of this weekend's news. Volatility sticking up 86.7 IVR there in silver, Jamal. And finally, rounding out in the world of currencies, the dollar was stronger, now weaker on the day. The pound, the euro, those are both back in positive territory. As we make our way to the high options volume watch list, though, here on the platform, we can head over to liquidity and high options volume. You'll see a lot of familiar names here at the top of the scoreboard, Jamal. I know we're going to spend a little bit of time talking geopolitics and the energy, but talk to me about the Teslas, the Nvidias, the Palantirs of the world. I'm seeing some good performance here on the board right now. What was in vogue last year seems to be in favor at the start of 2026.
It is. And although it's not showing up on here, I mean, for me, I think one of the things, two things have captured my attention today that have been a little bit different than usual. Bitcoin obviously is the one. I mean, Bitcoin is making moves, and it still needs a little bit to get to that psychological 100,000 level. But obviously, that's been the thing that a lot of us have stared at since October, right? And the other thing is, MicroStrategies is, of course, moving along with Bitcoin today. But it is interesting to note. I mean, the high that we saw in Bitcoin was in October. It was way longer ago for the high in MicroStrategies going back to July. So they still have some work to do there overall. And then I would say the banks too, Chris. I mean, strong moves in the banks today. JP Morgan and Goldman ahead of their earnings, about 10 days away. Big moves you're seeing there. Big candle there you see in XLF. Big candle you see there in JPM. So big, strong move today. And that's been one of the things I've been wondering about coming into a new year. Again, I don't always, I don't change things, I should say. If somebody asked us, was asking this at the end of the year, do you change things when the calendar turns? No, I don't. But I certainly look to see if there are certain changes that happen, if all of a sudden certain sectors that were kind of middling or struggling start to turn around. Again, this is one of the reasons why watching Bitcoin-related names making big moves today, but then seeing the banks. I mean, again, the banks have been there. The banks have been near all-time highs, but making big, strong moves here as we get to their earnings, I think is something very fascinating. And then finally, those oil names you mentioned. I mean, look, I haven't followed that situation as closely as you have. I would say you probably have way more deep thoughts on it. But honestly, I know that something's been going on in Venezuela. I don't know much about the situation. And again, I don't really pay much attention to political stuff for self-preservation, honestly. But I do know it's unusual to go and grab a president from another country. I do know that that's highly unusual. And I do know that the connection to Venezuela and oil. And so I was curious to see what was going to happen with oil from the overnight to this session. I didn't expect an immediate jump. I mean, I just feel like we haven't seen as much volume in the overnight session a lot of times over the last couple of months here. But I think a lot of people were expecting the markets to be down big and expecting oil to be up big, and it didn't materialize quite like that. However, these names, that's been capturing my attention today. Schlumberger, Valero, Halliburton. I mean, we talked about it just together at the top of the show. Haven't traded those names in the better part of 15 years, and they're making pretty big moves today. So I do wonder if that's going to continue.
Over a decade. It's been literally a decade since I've looked at Schlumberger. And that was a stock. I traded a lot of the oil names in 2013, 14, 15, like going into that big bust of oil. Those names were hot. Had to trade them. And then, July 2014 rolls around and, well, that was the end of oil's trade. So it became a little bit more difficult to play the upside. And then I just kind of backed away and, I haven't looked at them really since. Because they never really made the watch list.
Two of the three sectors that I've wondered about coming into 2026 was banks, was oil, and healthcare. Sure. And two of those are moving today.
So interesting. I was looking at charts over the weekend of exposure to various sectors, right? And they're weighting in like the average person's portfolio. Precious metals, commodities right now have the lowest weighting ever in the average American's portfolio. It's less than 0.5%. So if you talk about an unloved, underappreciated sector, Jamal, energy is part and parcel to that. And, given some of the moves that we're seeing here today, I know we've looked at other energy ETFs like DBC and DLP. What am I thinking of? DBC, sorry. Is the commodity tracking ETF breaking out perhaps? We got to go back a little bit further here, right? You have this potential bottoming occurring outside of a long-standing downtrend in commodities. We go to DJP. That's the other one starting to break out. Nice little cup and handle type of action going on here. These are weekly charts going back to the start of 2022. So commodities right now, outside of the metals, they really have been hated. And maybe that's the contrarian play for 2026. Think about the non-precious metals commodities.
I mean, it's true. It's the thing. But, nobody wants to just throw money at something that they might take, 3 to 6 months, right? I mean, pull up the SLV chart. Pull up the SLV chart. If you could pull up the full year, right? Like, go, well, just, that's fine. Yeah. And going back to early last year, that's perfect. Go back to early last year. Look at that at the beginning of the year. Did you really want to be in that? Did you really want to throw a lot of chips in that? I mean, not necessarily. But once it started going, you and we've had a lot of talks about this. Once we saw the strength, then it became interesting. I'd rather wait till I see the strength in the oil names and the you know what I mean? Like I'd rather see that because, like you said, they've been borderline dormant for the better part of a decade. I know they're up. I know again, ExxonMobil is higher than it was in April of last year, but still they've been kind of a boring trade.
Okay, so hit me with this then. You want to see the market get some action and start to break out. Is that going to be something like an ExxonMobil, 10.8 IVR? Are you really getting compensated to be a contrarian here and fade this move?
No.
I don't, that's part of the equation here. Like CVX, 19.5. That's a lower IVR than you see in the NASDAQ right now, which has a 19.7. You can go over to ConocoPhillips, 13.7. That's basically in line with the S&P 500. So, I mean, if you're going to be a contrarian about this, part of me thinks that this rise in oil prices, maybe this is predicated on geopolitical tensions, right? And people just now benchmarking the new world that we're living in, right? And I say the new world that we're living in. I've seen a lot of commentary over the weekend that, well, if the U.S. can just go into Venezuela and do this, then who's going to stop Russia and China from all doing the things that they've been doing? Well, that's the whole point. I don't think Xi Jinping or Vladimir Putin is particularly worried about some sort of UN resolution condemning them for their territorial expansion efforts. The only thing that's been stopping Russia and China has been the U.S. military. Okay. And so, does this stop Russia and China? Well, it shows that the U.S. military can accomplish a lot. I forgot to use my joke earlier. American helicopters and American jets intercepted the Venezuelan president this week, and that's one more interception than the New York Jets had this season, Jamal.
I'm glad we can laugh about this.
We're all having fun. It's a good time. It's a great time, Jamal. Cool.
I mean, that's a hell of a statistic, though. I mean, come on. I think it was the first team since 1930. Matter of fact, I was listening to local Chicago radio. Yes, local Chicago radio is talking about it, even though they don't need to. But since 1930, I think it was, and the dude who led the league that year, how many passing yards do you think he had? Whoever was the leading quarterback.
Like 78 acorns. I'm sure they measured it differently back then, too.
Come on, give me a number. Yards. Doesn't matter. I mean, it would be hard to
Leading passer.
Yeah.
What was it, a 14? Was it a 14
I think it
game
might have
season
been.
back
Yeah,
then? I
14. Yep.
think? 1,800 yards.
It was like 974 yards or something like that.
Wow.
Yeah, right. Right. You know,
I was going under 100. I was like 100 a game.
I think it was on like 170 pass attempts or something like that.
That's disgusting. And I guess that's why they call it football, because the game was mostly a running game until recently.
So previously, that was a qualification for getting 0 interceptions in the season, not 700 pass attempts. Is really what I'm getting at.
All right, enough. That's a little too much.
You know I love numbers. I know you do too. I just thought you want to know little numbers.
The Jets had fewer interceptions than before they started even throwing the football. I mean, like, that's how bad it is. No, people weren't even throwing the football back then. Oh gosh. Hey, listen. At least I have the Knicks, which is pretty terrible these days too. But
that's a long season. It's a long season.
We're playing the Pistons tonight. I'm looking forward to that game. Jamal, the energy names here, right? We've seen with Israel, Iran, that's a much more substantial threat to global supply. Over the summer, we had that brief 2-3 week window where prices shot up. They were at 61 or so before the conflict. They were at 61 after the conflict, the 12-day war. The IVR to me is the tell. When we were seeing real geopolitics go into focus back in June, July, what was going on with the volatility? As prices were moving up, vol was expanding rapidly, signaling that this was different and outside of what was expected. Here, the U.S. has had its largest aircraft carrier fleet in the South Caribbean for weeks. It just doesn't happen. You don't just park those things anywhere. So the odds of some sort of action, I think, were running high. As for me, knew it was coming. We've been looking at long trades in crude for the past several weeks. Did we manage to make a single dollar on it, Jamal? No, which is why structure and timing matters so much in this market. So originally those $60, $62 calls that I was buying and rolling out, how they looking today? Not worth much more. In fact, I don't even have anything doing that's making any money in crude today. So sometimes the best laid plans, your timing and your execution has to be right, even if your prediction is correct. In this case, hasn't worked out. We're going to keep an eye on those energy companies, though, Jamal. I think we're going to pay attention to them over the course of this year, because if they maintain their gains, that's going to be the tell over the next few sessions. Can they hold their gains? Speaking of gains, speaking of big moves today, did you know that we have something called the big deal going on?
I've heard the big deal. It's almost like the New Deal, but different.
And a little bit different, a little bit like the fair deal, but even better than that, because the fair deal didn't have a 4% cash match plus 30 days of commission-free trading. Take that, Truman. Go to tastytrade.com/big deal. 4% cash match on qualified deposits up to $10,000 in the first 30 days of funding. It only takes $1,000 to qualify. So that's 30 days of commission-free trading. If you're someone who's just watching us and you're thinking about switching, if you're a high-intent trader, if you're new to the world of trading, come see what we're about. Come take advantage of this promotion. It runs from now through March 31st. Are you kidding me?
Yeah, first quarter, all first quarter.
That's actually all first quarter. That's really nice. This is compelling for traders who want to get in. They want to get funded. They want to start trading right away, in my view. And I think if you look around at other brokerages, you would see that this is probably as competitive, if not more competitive, than some new 2026 offers here that are out. So again, tastytrade.com/big deal, 4% cash match up to $10,000. Jamal, we go back to our charts. We take a look at our market here as we get into the final 10 minutes of this last call. Stocks here slumping off a little bit in the second half of the day. Not sure if we call that substantial right now. 15 points off where we were at the peak near noon. Tell me, I'm looking at the volatility futures curve here, though, and I see a very steep contango.
Yeah.
Front month is... see 1255 here for the Jan 16 expiry out to October 2196. What do you make of a stock market that's showing this kind of steep contango in volatility futures?
Well, we haven't, look, when you look at average daily moves that we've seen more recently, I don't know how many of them have even eclipsed 1% too often. It really hasn't happened that much, particularly over the last couple of weeks. So I'm not that surprised. A little bit more of the same today. We were getting close to a 1% move, but didn't even happen. So I'm not that surprised, honestly, overall, when I look at vol. And then you wonder, what things could possibly change that. We do have jobs report later this week, of course, which even that is not garnering the chance of a 1% move on Friday. So I don't know. I don't know how much that's going to mean. And I'd like to get your thoughts on that in a second on what we would expect. But I would say the other thing maybe in the very near term to look at is the CES conference. I think Nvidia is supposed to, the Nvidia CEO is supposed to be the keynote speaker today, I believe, if it's between today or tomorrow, in the next 24 hours. So that's probably one thing to look at. Who knows if Nvidia pops on that? They're going to discuss a few things, but those are about the only two things I'm looking at as far as events for the week. But what do you think about this jobs report?
It's a good question. I saw today that the BLS and the administration noted that something like 40% of senior data analyst jobs remain unfilled after the wave of Doge restructuring last year. And something like 25 or 30% of more junior positions remain unfilled. That begs question in my mind over reliability of data, which the data series has been on the path to less reliability in recent years. This is a post-global financial crisis phenomena. The response rates to all the surveys that the BLS and these other institutions have put forth have declined from like 85 or 90% to in the 70s, 60s, and then COVID happened. And then those response rates plummeted thereafter, 30, 40% in some cases. So this is now just another hurdle that we've had in a difficult environment from really ascertaining true data, which is, again, why over time the error bands for these reports and the scale of the revisions has increased. For the market then, if you know that the data is becoming less reliable, even if this is data that's not theoretically in actuality, registered post-government shutdown, right? There's no hijinks this time. It's a regular collection period. You can't help but think that this isn't going to be enough to move the needle for the Federal Reserve still, because it's a single data report coming out of a period of deeper uncertainty regarding the data viability. So I see a market 63 points priced in. There's part of me that thinks that's desperately undervalued and we should be playing for vol expansion by Friday. And then there's that other part of me that says, yeah, of course not. The Fed's pricing, 16% chance of a cut this month.
Mm-hmm.
A single report is not going to move the needle on the cut unless it is apocalyptic, right? You don't want a Fed to cut rates this month because of the non-farm payrolls report if you're a bull. So that to me is the dynamic there. If I see Fed cut odds rising on Friday following the data, I'm going to think that we're going to have a pretty big day that outstrips this plus or minus 63 and 10-cent point move priced in.
Yeah, I mean, I think the market is telling us everything we need to know about that report, and you just sort of added onto that because you can just tell the market doesn't seem to be that worried about anything overall. Of course, we've seen times where these moves have been eclipsed. The expected moves have been eclipsed by more than what we thought. So I don't know, but we just haven't seen that in a while, honestly, with some of these major reports, and I think that's the main reason why, as you just laid out. So I'm not expecting much behind it. Same thing with Nvidia. I'm not expecting a whole lot on this move. It doesn't seem the options market is telling us a whole lot, so why should I expect anything to really happen? But I guess we'll just have to wait and see.
Yeah, Nvidia was having a better day. It's since come off, and semis, for what it's worth, they were a leadership group at the turn. They've had a pretty rough session, I want to say, if only because they gapped open higher and have since traded lower. That's not exactly the most appealing or alluring candlestick. Do they call that an abandoned? I think it's called an abandoned baby. I don't know a lot of the terms that don't apply to futures because those are continue. Yeah, all right. Japanese candlestick charting has some fun names in it. But to that point, though, this would still be an all-time high close for semis. How do you square the circle then, Jamal? Right? I'm looking at a market where volumes are low, even on the first trading day of the year. Sure, maybe things take time to get started. But after this weekend's events, find me a person out there who would have said, no, Monday's volumes are going to be lackluster. You're barely going to get by 1 million ES traded 5 minutes before the close. I don't think any of us would have signed up for that. We would have all taken the other side. So the volumes are light. The volatility is staying low. The technical patterns look decent. I'm loving this little Morningstar candlestick cluster pattern here at the 1 month moving average. Are we just all complacent? I guess that's my question. Because I'm looking at this AAII survey, which is going to be pulled onto the screen here. And the spread is now 15 points between bulls and bears, 42% to 27. This is among the lowest readings that we've seen all year long. I think this is actually the low reading for the year for bears. Investors just they're not concerned about anything. They don't care. That's, everyone's turned off the lights and said, just buy and buy the dip and don't worry about anything. It all gets resolved. Isn't this a mess? Is that like a bit of a mess sentiment wise, psychologically speaking?
I mean, I don't know. What is there to be worried about? I think until there is something to be worried about, you're going to see surveys like this, honestly. I mean, look, if this weekend's geopolitical events doesn't seem to worry people, and it was largely telegraphed, it would seem, then what is there to be worried about overall in markets, I guess, and why is there any reason to do anything different than what has been going on, which is largely getting long tech names over the last couple of years. So I think, I kind of hope a little bit we see a little bit of a rotation, a little move more into maybe healthcare or something like that. I think it would be fun. I mean, I don't know about you, but I'm a little tired of trading the tech names. I mean, I just am. They just, but again, I want to trade where the option volume is. And as long as that is the tech names, I'm still going to continue to trade those by and large. But and the same goes with these oil names that we're talking about. We're going to keep an eye on them. But when I look today and I look at the top 20 names overall, and it's still tech names. It's still tech related stuff. It's still maybe, if it not necessarily energy. If it is energy, it ends up being the alternative energy type of things, the Irons of the world, or the BEs, the Bloom Energies of the world, Oklos. If and when it ends up being energy, it's those names more than anything. But today, when I see the top 20 names, the whole entire market, although we talked about Chevron, Schlumberger, and all those, they don't show up as far as options today. And even when I look back, I still have a screenshot here from the top 20 symbols when you guys were on the morning show this morning. None of them in our crew involved, as far as our people were trading, none of them involved, whether it was the financials. It didn't involve the financials. It didn't involve those oil names. It's still tech, right? It's still Intel, Meta, Coin, Hood, Oklo. It's still those. So until that changes, I'm not going to change.
Yeah, Coin having a nice bounce today. A lot of these crypto connected names are having a nice bounce today. Maybe what we saw over the weekend was what Bitcoin needed to regain some of its chutzpah. I'm keeping an eye on the 94,950 level. We're going to call it 95K specifically. That's the high from December 9th. It also neatly aligns with the 50-day moving average here today. That's at 94,692. Currently, we're at 94,500. So we're on the precipice. If you've been playing this off the lows, you have a multi-leg position. I mean, I have an IBIT position in right now that's been doing absolutely nothing since I put it on with Tony on a market measure prior to Thanksgiving. But if we break out from here, this becomes a point where all of a sudden, okay, what happens to a strategy, right? Ethereum starts to poke up. What happens to the Marathons and the Coinbases and the Riots of the world that haven't exactly had the easiest time here in recent weeks? For the technical enthusiasts among us, here's a double bottom, perhaps. Here's a little bit of divergence in the indicators. Something to work with. But gold, silver, crypto, maybe crypto isn't the thing that people are paying attention to because of the metals. And that way, they finally have covered a rally, Jamal, because they're out of the spotlight. All the pressure's off. They can go back to being the fun. They can go back to being the fun thing as opposed to the serious, disappointing thing.
Yeah, that's definitely got my attention. Gold, silver, the metals, the like. I mean, you wonder what's the next move. Is this the beginning of some consolidation, or is it beginning some consolidation, which I think would actually lead to higher prices, or is it going to be the beginning of a short-term breakdown? Personally, I still think it could be the latter more so than the former, but we'll see.
We're winding down into the final few seconds of the session here, at least the cash equity session. Ultimately, it's your oil names that are the top performers today. OIH, GDXJ, XME, GDX, XLE, IYE. So the top 6 sector ETFs, all related to commodities. Then you get your banks, as you noted, XLF, KRE, top performers in the overall market. Broadly speaking, you have some discretionary showing some strength. XLY here, and SMH, despite the pullback during the U.S. session, will be closing at an all-time high here. Jamal, the worst performer with energy going up, natural gas plummeting. It's the utilities. But you know what? This is just the start of another great trading week, another great trading month. Dare I say another great trading year here in Tasty Live? Am I allowed to say that? I've said it.
Of course.
I'll talk to Beth afterwards. But you know what? We have more things to discuss here today. I want to pick Ilya's brain. He's our geopolitics guy, and the news over the weekend, I'm sure, has him dialed in on some interesting ideas and opportunities. And we're going to talk about that next on Overtime. Jamal, I'll see everyone there in a little bit. Thanks for last calling it with me today.
Yeah, man. Good to see you. See you tomorrow.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
New year feels a lot like 2020. Anyway, this is Overtime. I'm your host, Chris Vecchio, New York. He's Ilya Spivak in San Francisco. We're here to take you through the rest of this half hour as the trading day winds down. Interesting day to kick off the year. First full week of the trading year here on Tasty Live, of course, Ilya. And we were greeted by news out of the weekend, of course, of a major geopolitical event. The U.S. has arrested Nicolas Maduro, the Venezuelan president. Say like 2020 because didn't we go after Soleimani in the first week of 2020? Everyone forgets about that, quickly overshadowed by COVID. So echoes of history rhyming again. The U.S. takes out the enemy of the state, so to speak. Biden put a bounty on him years ago, so it's not like this is a new event. And certainly the markets aren't acting like it's a new event either. Stocks here shrug it off. Volatility flat. S&P up, what now, 0.6%, 0.7 S&P.
Yeah.
The worst performer among the major indexes today, Ilya, with the NASDAQ up nearly 0.8%. The Russell, the Dow Jones, which have some of those energy names like your Exxon Mobil's of the world in them, those are faring a little bit better, up 1.3 and we'll call it 1.6% respectively. But as we were discussing on First Call yesterday, this is less about oil and more about this ongoing evolution in the global economy out of the post-World War II era into the jungle again, where might is right and who can you really trust? And the prime beneficiaries of that world, while today crypto is having a nice time, 4.93%, and part of me thinks this is the Venezuelan RuneScape player base moving some of their in-game gold. That is a very niche reference for some folks out there in the chat. It's all about gold and silver. It's all about copper, palladium, platinum. It's the metals, it's the metals, it's the metals. Gold up 2.9% here. Silver up another 7.2, which of course begs the warning that as we near the 78 level, CME margin hikes could very well be in play again here over the next few days. But Ilya, this market reaction today, U.S. stocks don't care if there's nothing to do with the Fed or the U.S. government spending or corporate margins. Certainly the idea that there's more supply coming at some point in the future is a disinflationary force. if it were to ever come out of the ground. But where does this leave us? Where else does this leave us with looking long the metals at the start of a new year here on overtime?
I mean, I think this reinforces precisely what we said yesterday on First Call when the markets opened and we came on air to start the year, and the words out of our mouth was this matters more for gold than it does for oil. And what do we see here? Exactly as foretold. And that's because, to your point, there's no oil story here as such. Whatever could be disrupted isn't significant. Whatever could eventually come out of the ground is years away, seemingly. So what does this really mean? And what is this really about vis-a-vis oil? Well, it doesn't really matter. It doesn't really change any major oil importers' mix. It doesn't change their prices. It doesn't alter the supply-demand balance in any kind of a meaningful way. Venezuela is not really a player like that. Moreover, I know the clip from the Jack Ryan TV series has been making the rounds today.
But by the way, I guess I owe John Krasinski an apology.
Yeah.
I stopped watching that at the end of season 2.
That was a mistake.
But you know why?
Really good.
What happened at the end of season 2, Ilya? They stormed the presidential palace in Venezuela. And I said, okay, well, this is just, this is just militant fantasy.
This is just ridiculous. This is just ridiculous.
Art imitates life. And
right. Well, and the clip making the rounds today was his whole speech in a classroom setting about how Venezuela has the world's greatest reserves of oil and the world's greatest reserves maybe of gold as well. And
yeah, keep that stuff in the ground. We don't need.
Well, and what we learned, of course, is that these numbers are self-reported, especially the oil numbers, and nobody checks. So some years back,
I have seen a lot of people complain about that today. Josh Young over at Bicep Insights has just come out and effectively said the Venezuelan oil reserve numbers are just total lies.
Well, because the predecessor to Maduro, Hugo Chavez, made it a policy to increase the country's prestige by just making up those numbers because nobody asks. So when you self-report to OPEC, our oil reserves on the basis of nothing, we didn't do any geological studies or anything like this, but here's our number. You go, wait, based on what? Based on Hugo Chavez wants to give you this number.
Based on the times.
Yeah, so even the theoretical importance of what's going on in Venezuela here, the markets aren't swayed by because they don't really buy even the hypotheticals of the numbers, rightly so. So when you look at this, okay, what is this actually about? This is about and everybody's talking about this today. We've been talking about it for months, if not years. Welcome, everyone. Nice of you to catch up. The revival of the Monroe Doctrine. And the idea that what we're building in our separation from China is the Western Hemisphere alternative.
Fortress Americas. As
America. Yes,
Fortress
that's
America.
right. That's right. Because we, unlike, and you have to give credit to the likes of folks like Peter Zeihan here, because they've been talking about this forever also, and have written books about it, saying North America is uniquely positioned compared with other advanced economies in that while they are aging, they don't really have an alternative labor force. We do. Because we, first of all, are not aging nearly as badly as Europe or Japan or Korea are. Certainly nothing like China, which is an utter disaster.
Population's peaked in China.
I mean, we probably a decade ago, if you consider how those numbers get shaded. It probably peaked a decade ago. And so when you look at all of this, the argument goes reasonably enough that we don't need Chinese supply chains. We have all of South America ready and available if only we were to start investing in doing that. And it looks like the administration is very much on that sort of time. By the way, the Biden administration was not in disagreement with this approach. That essentially we need to diversify away from China and substitute Mexico, Canada, and the rest of South America into our own regional hub and make sure that nobody else shows up.
No, that is true. And that's one of the reasons why it was a shift that started under Trump 1. Biden continued it largely in his second term, right? He kept all the tariffs on China and tried tearing down trade barriers.
And put a bounty out on Maduro. One might have imagined this same thing would have happened were we sitting in a second Biden term right now.
Maybe. I would think that maybe you'd have another AUMF that would have to go through Congress under Kamala or Biden, just because they're such institutionalists and how like they.
But in terms of intent and outcome, I mean, methodology, of course, but in terms of intent and outcome, there's not really a meaningful difference here.
Perhaps it's not. That's above my pay grade. The only thing that's within my pay grade here is figuring out how to react to all this stuff.
Right. And so, not surprisingly, the reaction is in gold, because what this speaks to is this idea that we are building Fortress Americas, as it were, and that what this then becomes is a kind of hemispheric front line being drawn, mainly with China on the other side.
Well, and I think the point here, though, is that, you know, in a weird way, when economies interacted, the dollar was the membrane with which those transactions pass through, right?
Yes.
Because if you have euros and you're interacting with like the Colombian peso, you guys both convert to dollars, and like that's the standard.
It's actually cheaper for you to transact through dollars, a third currency, than it would be from Colombian peso into euros, because the liquidity of the dollar is so unrivaled that spreads get tighter.
Exactly. And now if you're bifurcating into a 2 or 3 pronged world, right? I personally don't take Russia seriously as a player. If you're
nor should you.
Like the second that listen, the best thing for Europe's autonomy moving forward could be this tough medicine, if I want to take a very generous interpretation of what the Trump administration is doing here. And I am really trying to be generous with that, calling it tough medicine. But let's say the US decides to take Greenland, which is, again, idiotic because we're a NATO ally and we have bases there already. You know, where does
I'm not terribly worried about that one.
But like, where does the fifth fleet operate out of? Out of Bahrain. We didn't need to take Bahrain to have our 5th Naval Fleet have a central home in the Middle East, and we already have bases up in Greenland, so we have basically free use of the country already. I don't know why we need all of it.
I suspect this has about as much seriousness behind it as building the wall.
I'm just being really generous, like I said. I'm very generous here in this interpretation, and so even with that generosity, stomaching it. Okay, even with that generosity, then. Like, what's the next domino to fall? What's the next path forward? If you want to be generous and say this is a dose of tough medicine for Europe, they federalize, they get their own army, they stop being 27 disparate places, which I don't think will ever happen. There's a reason why all these different cultures are existing in these little enclaves, thanks to the geography, the rivers, the mountains. All right. But let's say all that happens. So you have Europe, China, and the US. What are the membranes now? People aren't going to use the dollar if they don't have to, if they don't trust the US and they see it as an interlocutor that's interrupting global affairs. Okay, I suppose there's an asterisk there. We've been doing that for a long time, but at least it was understood that we were trying to do it for good reasons. So then gold becomes that membrane. Gold is the membrane. People sell their currency, they buy gold with it because they know anyone on the face of the earth will happily accept a gold bar. There's no currency problem whatsoever. I mean, Ilya, I feel great about that 5,000 call I bought in gold right now.
Yeah, I mean, I'm not really thinking about it as saying that the world's not going to want to use dollars. I don't think anything is even remotely close to liquid enough to replace the dollar.
No, people use dollars on this side of the fence.
It's just, that's the thing. You're going to need, if you're a third country, if you're neither in the China sphere of influence nor the US sphere of influence, you're going to want alternative connectivity that basically lets you say, you know what? If the US is telling me that I can't do business with Huawei, let's say, because for this there is very good precedent. The US has done this. It's come out and said, U.S. financial institutions. You cannot do business with Huawei. Now, what is Huawei to do? How is Huawei to settle transactions in a global economy where everything is settled in dollars? What will the other side take if you're Huawei and you're buying whatever, electronic equipment from Korea, say, or from Taiwan, or from wherever your suppliers are?
How are you getting that gold to them?
How are you going to get that stuff?
How are you getting the gold to them?
Possibly
on boats. On boats.
Possibly physically.
On boats that say have to go through U.S. naval water now. Well, I mean, like this to me, the story here, as all the pieces align, given what's happened in Yemen, South Yemen, Somaliland, okay, what's happening now in Venezuela, what we've talked about in Panama, we've heard talk of what's happening in Cuba, in Colombia. The Fortress America idea seems realer than ever. And so there are other knock-on effects of this. If this is the right thesis, the North Star in terms of this view, we're realigning ourselves, we're taking ourselves off the top of the global order. There's still a lot more action around this theme. So I'm worried about silver in terms of a margin hike again. I know that this has been
especially
a problem.
Up against the range high where we got stuck today.
You notice how we get the announcement right near 78 that there's going to be a margin hike, and then we get another one on the 30th. It's coming the next day.
There's something. The market seems to be somehow antsy about that level.
Little scared near 78 right now, but you start to, but you can see then, Ilya, like you get through 78 and the CME doesn't say anything. And it's like, oh gosh, they're not raising margins again. I better get my hands.
Or at least the threshold is different now.
Right? Because, hey, in 2011, I brought this up before, and I think it's really worth reiterating here. When the margin levels were set so that you could get 26-to-1 leverage, and then they knocked it down to 22, and then 20, and then 10. Right? That is a totally different cascading effect from then where they started it. Well, now, when it was like 6-to-1.
Yeah.
And then we're going to 5-to-1. And then for like the deleveraging isn't as painful. You don't have a market that's built on these stilts of just, cheap over levered money. It's difficult to maintain positions, of course, but it's not the end of the world. Like if I have to go down from 4 lots to 3 lots, okay. Going down from like 25 lots to 10 lots, maybe this isn't a trade for me anymore. I can't get the juice that I want to squeeze out of it. So I hear that as a near-term risk. Gosh, gold and silver. New year, same market. The metals look fantastic. In terms of cleaning up the book here, Ilya, I'm going to be cleaning up my gold and silver copper positioning here. The 575, 585 call spread that was put on several weeks ago is now at 22 DTE. It's deep in the money at this point as a result of today's action and the ensuing breakout that we've had over the course of December. I'm going to take this off. I'm going to get ready to put it into a new position if we get a retracement back to that 1 week moving average. We've basically touched it every single day for the past 6 weeks.
Yeah.
Okay. So tomorrow, if we don't touch it, that would be an interesting occurrence. The last time we didn't touch it on a single day was December 26th. Then the next day we went right back to it. So I'm going to look for a little bit of a pullback here in gold. Likewise, maintaining long exposure. The technicals, sir, I think you just take a look at the move off.
Well, I mean, this is that range top that we were talking about yesterday, essentially referencing back to the highs right there. Exactly. And from the looks of it, we have ourselves a little bit of a break. So I added a little bit today, but I didn't do it through the futures. I added through an ETF. An ETF vertical here. I didn't use GLD this time because it was a little bit expensive. So instead, I actually
now.
There is an option. It can be done. I did it with IAU, which is the iShares ETF. It's a little bit cheaper, and you could still get decent 2-to-1 risk reward today on a call vertical, basically from where we are here, 83 out to a new high, which would be 90. a new high for gold. And that can be had for 46 days with better than 2-to-1 risk reward, though vol is admittedly a little bit expensive here. Nevertheless, the trade structure works, whereas in GLD, it's a little bit more crowded and a little bit more difficult to get those kinds of risk reward parameters. I still have the futures on, by the way. I was just looking to add in a way that was a little bit more risk defined, where you got to be a little bit more careful, because this is the first day back. And you want to be careful around liquidity coming back, markets evening back out, positioning, laying out for longer term exposure for the rest of the year. There's all kinds of cross currents here. So just out of an abundance of caution, the way I added here wasn't through just buying more 1 ounce futures, but in a little bit of a more careful way.
Yeah, the move today, obviously, it was more of a knock-on effect for a bunch of the individual companies, more so than what happened in oil itself. Well, natural gas here, it does get off the lows. It was a 6% loss. Now it's 2.9%. I'd like to close the book on a trade that we put on last July, Ilya. BTU. Okay, in the follow page here, BTU was initially put on July 3rd. We paid 19 cents each for 10 contracts, the 25-30 call spread. The first leg was taken off when it was trading at 305. Half the position was sold. So bought at 19 cents, sold at 305. The second half was sold today at $4.37. In terms of percentage return, this is by far the best trade that I had all year. Way better than anything gold or silver related in terms of capital laid out and then profits returned. Why didn't I buy 100 contracts? Great question. Because I had high conviction in July, Ilya, for a very simple reason. We had our new one big beautiful bill, as they call it. A one big beautiful bill that provided tax cuts to coal companies. And at the same time, as the coal companies are getting more favor, what are we seeing happening in the space for renewables? Subsidies are being cut. Heck, I had to rush to get my solar panels installed before December 31st so that I could officially say this was done and take advantage of the federal tax credits. And I did, so I saved the money. But the game has changed now, right? The composition of energy mix that we have available to us domestically in the near future is becoming less renewable and more fossil fuel, more legacy fuel, as they're now rebranding it and calling it, because fossil fuels sound too dirty. In any event, Ilya, from $16 up to now near 31, this trade to me worked out just perfectly, right? We were 11 days from expiration today. That's why I took it off today for the second half of the leg. I am now in a new position though, because the tax cuts for coal companies are still in place. And if we're going into this world of everyone is a little bit less secure over their energy security, and there's a reach for energy right now, Ilya, coal prices might go up. I know Venezuela only supplied like 5% of crude oil to China. But given everything that's going on in Iran and what may happen around the Red Sea and
et cetera, et cetera.
So I'm looking at a new position here, just like the last one, 6 months in, July 17th expiry, looking long the 35, short the 40, another 10 contracts here on the follow page. Ooh, you want to go back to this. Okay. It's another one of these risking. Unfortunately, it's not going to be the same kind of juice as we had last time. The options just don't list us the strikes that I'd like to have, and maybe we'll roll it out further should we get $45 calls put on there. But right now, this is where I'm operating in. It's a little bit better than a 3-to-1. I think that this is a chart that looks pretty good in terms of a triangle breakout and then flipping over the $30 mark. It feels like a line in the sand has been drawn there, which means that this may be a bull flag coming outside of a triangle. And that would point for a return to the high up near just short of 36. So I feel good about this. This was a great trade. It worked out. There's been a lot of other bad trades around here. We're not going to talk about bonds on today's show. But in terms of finding continuation, given this geopolitical event over the weekend, I feel renewed conviction, confidence in staying long something like Peabody Energy, even if, it's not a Chevron or an Exxon Mobil. big picture what's happening right now in the energy space.
I mean, you can certainly make the cogent argument. I mean, the question becomes, how long are you resetting this for, and what's your vision, in my mind? Because you're up against horizontal resistance, the high from November. So the question becomes, okay, well, are you breaking out or aren't you? But more importantly, is this kind of differentiation going to have enough time to work? Because if there is some sort of risk on, risk off toggle that goes off this week, and with NFP on the calendar, with a bunch of other data, certainly the service sector ISM report is something I'm watching closely, and we'll get right into it on macro money right after this. You'd be shocked to know I've brought many, many charts. The story becomes, okay, well, if you give this enough time, yeah. If whatever risk on, risk off kerfuffle washes over the market and this has time to work out beyond that time horizon, okay, yeah, I can understand. I probably would want a break of the range top near 32 before I was convinced. But the logic makes sense. The larger question is, are you betting on this happening nearer term, which I don't think you are.
July.
Right. So there's enough time here.
6 months. And it's a different scale, right? Because when we were at 15 or 16 bucks, looking at the 25-30 call spread, you know, to go from 15 to 25, Ilya, that's not a small move. 66%. Right. So like, this is why these are those madmen trades. Like if we punch one of these lotto tickets, it's going to be a huge winner. And so you don't need to have really many of these work. I think we did 6 madmen trades all last year. This was one of them. We were 1 for 6. And this obviously would subsume all the losses elsewhere. But that's the whole point of them. The high convexity. What if our big view picture is right? How can we take advantage of it in a defined way? 6 months from going from 30 to 35, another less than 20%. That's a much less difficult task. Just like silver going from, say, 75 to 100 is a hell of a lot easier of it going from 30 to 80. Totally different ball game. Totally different frame of mind now as we think about what could happen this year.
Mm-hmm.
But hey, it looks like it's going to be a fun year. If the U.S. intervening in another country's politics is any sort of omen, just like we did in January 2020, then I suppose we're putting a clock down for a new pandemic, which we're not going to entertain.
A sample space of one. Always very convincing.
Well, we have a lot to discuss over the course of this week. We haven't even touched on non-farm payrolls. Who cares about non-farm payrolls when the market's pricing in 63 points between the end of now and now and the end of the week, Ilya? Maybe the market's wrong. And that will be a topic, of course, for tomorrow and other shows. But I know that you have macro money coming up next. I want to thank everyone for joining us here on Overtime and tolerating my presence here on air all day today. Ilya, I just finished up hour 5. It's been the marathon. But hopefully it was a good trading day for other folks, for folks who are in gold and silver. Keep an eye on those CME margin hikes. Another announcement could be coming tonight, just given the price action. Other than that, though, sir, we'll see everyone tomorrow because Overtime's out of time. Always here on Tasty Live, Monday through Thursday, 4 Eastern, 3 Central, right after last call. So for Ilya, I've been Chris. Stick around. Ilya's sticking around himself for macro money. Up next on Tasty Live.
See you there, everybody.
This is... As a kid, I used to always tell my mom, I think I was born with...
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. only at Tasty Trade.
Tasty Trade's active trader interface makes futures markets your arena. Built for the bold, not the board. Trade CME futures with a single click. From micro contracts to major ideas. And go even further with futures options. Tasty Trade lays out multiple ladders and charts for total visibility. Plus, hundreds of built-in indicators for traders who want a broader view. Tasty Trade, pro-level tools, intuitive design, total control.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
The markets don't seem to care that the U.S. has extradited, we'll say, the president of Venezuela. So what is it that they care about? That's what we're going to try to unpick here on Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. We'll take a look at what the markets did today. We'll take a look at what the price action looked like at the end of last week, abridged though it was by the New Year holiday, and then see what we have coming up in front of us here and what things might look like when that's all said and done. So, what did we see today? Pretty lackluster in terms of the news flow. Certainly, risk sentiment ends up looking relatively chipper. S&P 500 up 0.6%. NASDAQ up 0.75%. That's not as strong as it looked earlier in the day. We had bigger gains for the S&P, bigger gains for NASDAQ, as it turns out, toward the end of the day. As volumes come back, and liquidity starts to fill back out. Certainly things were relatively thin last week. We have ultimately a reset on the losses of December the 31st. We finished the year kind of with a skid. And what today's rally does is it resets us. On the S&P 500, we end up with today's move essentially erasing the preceding 48 hours of trade. Markets really didn't go anywhere on January the 2nd, the Friday of last week, but we did get that sell-off on the 31st, and now that sell-off has been erased. In the NASDAQ, the situation is very similar. We don't quite erase the sell-off, in fact, from the 31st, but we certainly erase most of it. It's a little bit more chipper for the likes of the Russell and the Dow, where energy is a larger component of the index, but still broadly range-bound type of conditions. For the Russell, for example, we end up recovering to where we were just ahead of Christmas. So still very much the same range that's dominated price action since about the middle of December, and not very much trend development even there. Yields are a little bit higher, or bonds are a little bit higher, rather. Yields are a little bit lower. U.S. 10-year off by 1.1%, the front end off by 0.7%. But again, not really setting any kind of dramatic steps here in a direction. For the 2-year, this is very similarly to stocks, a reset over the preceding 48 hours. We mostly just oscillate within where we've been over the past 3 to 4 days. The same thing at the long end. The long bond manages a little bit of a bounce here, but it doesn't even erase the preceding 48 hours worth of selling. So we do get these moves. They do look the way they look, but conviction doesn't seem like it is there to be extrapolated from them. The same thing with the euro and the yen. We can see there the dollar is a little bit soggier, but not by much at all. The euro basically flat. The yen a little bit higher. The euro had sold off a little bit over the course of the day, but then came back to erase those losses. So not really a lot of conviction for the dollar and its major counterparts. In fact, even this 4.7% rise in Bitcoin is relatively contained in the context of what's going on, because all that does is bring Bitcoin back to the top of its range that has locked up prices since basically the beginning of December. And so we've come back to the top of the range, but only just. And in fact, if we look at what happened to Bitcoin last year, it was actually a down year. Bitcoin was up dramatically and hitting record highs at one point, but all that was lost. And we actually had an annual decline for last year. What we're doing here over the past 24 hours here is seemingly just resetting again around some of the sogginess toward the end of the year, but not really making meaningful headway this way or that. Perhaps the most interesting, of course, is the action in gold and crude oil. And arguably gold is more interesting than crude oil is, because, of course, we've had this news over the weekend that the U.S. raided Venezuela and extradited Nicolas Maduro and brought him to the U.S. on charges. So one might have thought this is the kind of geopolitical jolt that gets crude oil moving, especially if you believe the hyped numbers around Venezuelan oil reserves, which, according to their own self-reported numbers as relayed by OPEC, are the largest in the world. There's, of course, no basis for saying that. It's not like Venezuela presented some sort of evidence from geological studies or anything of the sort to back this up, at least not that I've seen. In fact, the numbers to OPEC are self-reported. And what seems to have occurred, in fact, is the prior leader of Venezuela, Hugo Chavez, just made those numbers up for prestige reasons. But nevertheless, Venezuela is an oil producer, and it is in that a possible place where disruption might have jolted markets. And we do see crude oil, for what it's worth, is up 1.8% here on the day. But what a soggy rally this actually turns out to be. At one point, the market's reaction looked like precisely the opposite of what seems to be on display here by the close. In fact, the initial reaction from markets was actually to send crude oil lower. And so what we end up seeing here is less so a sort of reaction around the event risk, and more so, again, seemingly a resetting within a range. Crude oil has been essentially oscillating between about 56.5 on the downside, that's per barrel, of course, and about 58.5, give or take. And that's been holding up since essentially right before Christmas. And while the initial response to this raid when the markets opened was crude oil sell-off of 1.7, 1.8%. Those losses have since been erased, and we've now come back to the top of the range. So just like we have a pre-holiday to post-holiday sort of seesaw here around most markets, so too for crude oil. It doesn't look like it particularly cares about what happened in Venezuela. Whereas gold actually seems to be the only market to show some reasonable conviction on this front. It is, of course, up despite a relatively flat dollar, as we can see here, and yields actually going higher, not lower, which in the classic sense would be an environment where gold shouldn't thrive as an anti-fiat and an anti-interest rate kind of instrument. This is not by any means the kind of environment where the gold should have its best up day since the last time that it hit a record high on December the 26th. But nevertheless, here we are. And the reason seems to be that gold is not responding so much to yields or the dollar, and in fact has become a different kind of asset. And now mostly responds around this idea that the US and China are building spheres of influence and building moats around those spheres of influence. And for the US, this seems to be a kind of revived Monroe Doctrine whereby we claim the Western Hemisphere. And this incursion in Venezuela seems to be an example of that sort of a worldview, whereby if we're going to decouple from China, the substitute is the Americans for rebuilding our supply chains. And so, in this kind of move in Venezuela and the subsequent talk around Colombia and a number of other countries in the region, Cuba, all of that seems to be of a flavor. And so, for gold, this seems to be once again a lift from people looking at the situation and going, well, if the US and China somehow have a financial rupture where one side, even for a short period of time, not necessarily in a lasting way, but if one side were to flex its economic weapons against the other again, and we had another kind of few months of escalation, well, then it might start to be difficult to have payments settled in dollars. And so how would one do business with China without upsetting the US by flouting whatever sanctions you might see? Well, you would need a third way. You would need a non-sovereign go-between currency, where as a third country, like let's say Brazil or Argentina or Turkey, you could do business with the US and China without those transactions necessarily touching each other. And the way to do that seems to be gold and metals more general. And so, as a consequence of this Venezuela raid, the thing that seems to care is gold, but as far as its economic impact, as far as its disruptive impact on the markets, that seems minimal and nowhere else seems to particularly care. Now, what is it then that the market actually cares about? Well, certainly few people noticed this today, but we did have a bit of U.S. economic data, and what the market does seem to care about is where that data leads over the course of the rest of the week, because there's more of it in store. We got the ISM, Institute for Supply Management, batch of manufacturing activity data today. And as ever, this is done in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The numbers came out at 47.9 for the manufacturing sector. Services are still pending later in the week. And of course, that's the larger release because services are a much bigger piece of the US economy than is manufacturing. But nevertheless, we do have some early signs here. Another contraction, a little bit worse than expected. 48.3 was what the markets were guesstimating. 47.9 is what showed up. A little bit worse, but not very much, and certainly within the range of recent values. Looking at the internals here, we can see the price component flatlining. And so it looks like we don't have accelerating inflation here, albeit we haven't really made new progress in pushing it lower. The employment index remains well below 50, and so in contraction territory. And we can see that from looking at these yellow bars here, that's the overall index, we've seen now deterioration in the manufacturing sector for 3 consecutive months, and that deterioration is accelerating because the pace of contraction is increasing. New orders, of course, still very much in negative territory, where they've been since about mid-year of 2025. Now, on the face of this, there's not really anything terribly impactful. This doesn't really seem to change the game for Fed policy expectations, where, as we can still see here, we're looking at least a pair of rate cuts this year. Markets are now at 59 basis points. For next year, there's the nominal possibility of a rate hike, though at this point it's erring on flat policy, because 9 basis points is not even halfway to a single rate hike. And so the likelihood that we get one is at this point worse than even. So taken together, what we've got for this year and next, it looks like a pair of rate cuts is what it is, 49 basis points. Now, that interestingly lines up with what the Fed was projecting in its most recent update of the summary of economic projections in December. You can see here 1 cut for this year, 1 cut for the next one, but they're spaced out with a single cut this year and next, whereas the markets want their easing all this year. And so there's a sense of urgency that markets have that the Fed seemingly does not. And this matters because we can see here that as dovish progression on policy expectations stalled in the second half of last year, so too did stocks eventually stall. In fact, we haven't made a meaningful attempt at breaking from this range that we've established since essentially late October. And this, of course, was the October Fed meeting, where it became clear the Fed is no longer in a hurry to deliver more stimulus. And so we can see here, we've essentially gone nowhere. We tried to dip under this range, we tried to dip over it, and we ultimately haven't gone anywhere. And so the markets appear to care about this more than they are caring about anything else. We can clearly see it in the price action. And to the extent that incoming U.S. economic data is going to shape this, we ought to get some sort of a risk response. Now, as it stands, the markets do not expect a rate move in January. 83.9, almost 84% chance of standstill. The cuts are expected to appear in April. Looking at the matrix here, we can see that by April, we have better than 50% odds that there's a cut versus 39% chance that there's not. And in July, this is that second cut where, again, the likelihood that we are at just 1 cut falls down to less than 50%. And so you start to favor that second cut at that point. From that benchmark, we still have U.S. jobs data in front of us, 55K expected for non-farm payrolls, unemployment rate expected to come in a little bit from 4.6 to 4.5%. The 55K number here, discounted by the Fed's calculus, where Jay Powell told us that NFP overcounts by about 60K a month. So the real number is whatever this is minus 60K. And of course, here that would imply a negative result ultimately. But would it change the game here? Not really. The Fed's core argument seems to be that we are running at about a net 20K loss on average for NFP once all these adjustments are made, and this would fall broadly within that spectrum of outcomes, and so probably wouldn't change the Fed's calculus very much. The last number that we have for the week is U.S. consumer confidence figures from the University of Michigan, where the most interesting point starts to be that sentiment has been deteriorating despite falling inflation expectations over the past 4 or 5 months here, which is different than everything that happened in the preceding 4 years, where sentiment was basically a function of whether consumers thought 1 year inflation would be higher or lower. So we can see coming out of COVID, sentiment was deteriorating while 1 year inflation expectations were rising. Then the Fed got busy hiking rates, sentiment improved, inflation fell. Then at the start of the year, we had the tariff scare last year, so sentiment weakened in the first half of 2025 as inflation expectations surged. They then fell back and things righted themselves a bit. But of course, now we're back to where those worrying levels were, both just coming out of COVID and during the tariff scare, and inflation expectations have been falling. So something different is going on here. The consumer is clearly not mollified. And that might be something interesting to have a look at here, because invariably this is going to start to hit spending. Now, what's interesting about the backdrop as it stands? For the third quarter, we can see that consumers were in fact out there in force, and consumption, the biggest component of overall GDP by far at about 68%, it rebounded smartly. The first half of 2025 was worrying because consumption was so weak, even as we got all these tariff-induced gyrations in inventories and in imports. First, a surge in imports and a jump in inventories to front-run the tariffs, then a drop in imports and a drop in inventories because, of course, those stockpiles got spent. But then going into the third quarter, it seemed like things were relatively steady as the tariff regime started to coalesce around something of a coherent vision. And of course, we know that there was a government shutdown in the fourth quarter, but looking at these PMI numbers, here are the last 3 months of the year. This is from S&P Global. We can see there was indeed a slowdown, but not the kind of slowdown that takes us out of the broad sort of post-COVID range for economic activity. In fact, it's kind of mid-range for the whole thing. And so whatever worrying thing could have occurred in the fourth quarter, it doesn't seem to have. So with that in mind, what are the makings of the Fed's calculus here? Well, looking at the ISM numbers and the internals, we have employment shrinking across both services and manufacturing. And at least for December, the services numbers confirmed that in this most recent update. This, of course, was the main logic for the Fed's thinking, that employment has become worrying enough to pay attention and cut rates. Meanwhile, inflation was becoming less of an ongoing concern because it was appearing to cool, and so it goes. Once again, confirmed with the manufacturing numbers today, inflation is in fact cooling. So all of the architecture for the Fed's rate cut logic, it seems to be in place, but none of it seems to be getting away from where the Fed was in December or in September, when it predicted that it's only going to cut rates once this year. So everything seems to be on course, but no greater urgency here to reconcile the difference between the Fed and markets showing up in the numbers. Here's the sort of main components of CPI from the most recent numbers that we got over the holidays. And we can see goods inflation, as the Fed has suggested, is in fact appearing to somewhat plateau after a period of rising since the middle of May, where it was still negative. And then, of course, starting from this year, where goods inflation actually becomes positive. If you wanted to see the influence of tariffs, there it is. Meanwhile, services inflation has been cooling. And this, of course, is still the main component of inflation as a whole. So that, of course, encouraging for the Fed and telling it you can cut, but again, not really changing the landscape with anything dramatic that would get the Fed to cut faster as the markets seem to want. Now, why do the markets want this? Well, we can see here that, of course, last year was a story about the tariffs and trade tensions. In fact, from February to April, we basically erased all of the 2024 rally for the S&P 500, then rebuilt it, and then kept pushing higher. But what we see here is with these worries about the tariffs receding from April and settling back down to give way to what became the equities rally to follow, the volatility around the 7-day and the 30-day moving average of this trade policy uncertainty index clearly suggests that there's a lot more concern about what trade policy could look like. There's a lot more uncertainty. Whereas, for example, we can see coming out of COVID, the index is tightly wound around its averages. Never mind that that uncertainty is generally low. Volatility day in, day out in that uncertainty is generally low. But here, clearly, we are in a different world. And what that volatility and uncertainty does is it ends up being a dampener on activity. In fact, we can see here that we had a dramatic decline in global trade volumes in 2025, the steepest, as a matter of fact, since the 08-09 financial crisis and recession, steeper even than COVID. Why does this matter? Well, of course, we can see that last year, the tech sector vastly outperformed everything else in the S&P 500. It's not even close. That is, of course, a function of this AI boom. And when we look at the architecture of the supply chain feeding that boom, we can see that it is worryingly differentiated. 26% is Asia, 24% is Europe, 38% is North America. That's, of course, the largest piece because all the models are US-based. But this is a very spread out supply chain. And if there is increasing volatility and uncertainty around global commerce that is dampening global trade volumes, well, that's a very meaningful risk to a supply chain where if even one link in the chain breaks down because of some sort of a trade kerfuffle, well, then the entire thing becomes vulnerable and the engine that's been powering U.S. stocks starts to misfire. And perhaps this is why the markets want their rate cuts so bad. They want cheap money to insulate them from something going wrong here. Because if, in fact, you make a mistake and you end up being long when you should have been out, it costs you some money, but then that money is cheap to borrow back so you can go again. Whereas if the money is not cheap, well, then maybe your risk-taking won't be as cavalier either, and then markets start to get soggy. Outside of the U.S., a few minor releases here in the grand scheme of things. Inflation coming out from the euro area, it's expected to come in from 2.1 to 2%. Not really a meaningful number here in the sense that the ECB is not expected to do anything at all this year. So unless there's a wild surprise way out of consensus, then this doesn't mean very much. Also, inflation numbers coming out of China, where things are expected to remain very, very low. And that, of course, speaks to the anemic nature of the recovery there, where the economy has been basically in deflation mode since coming out of COVID lockdowns in late 2022, early 2023. It hasn't had very much demand to speak of since then. As far as exposure is concerned, I am still holding my long gold positions via these 1 ounce futures, and I'm going to continue to hold them because it seems like such as we've had news flow, Venezuela has been supportive there. Still long the pound. I've flipped over my euro position because that's been a little bit soggy today and looks like it might have started some sort of an independent trip lower. But I'm still short the dollar via the Canadian dollar as well. So I'm mostly short dollar, but a little bit long, but only as it pertains to the euro. Still short risk via Bitcoin, Russell, NASDAQ, and S&P, all of them. Put verticals. The one on Bitcoin is obviously not having the greatest day today with this Bitcoin bounce, but with the structure of the trade still there, I'm going to hold it for now. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money returns tomorrow. Happy trading.